Yes, let's start with your ITC chapter. The provision starts at section 16 and it ends at section 21. But the main provisions from where I say is asking questions are section 16, 17, 18 to some extent, not so much. They are not focusing on 18 so much. Yes, there are special situations where it is there. 18 talks about ITC in special scenarios. 19, it talks about job work, not so much. 20 and 21 off late, input service distributor. Yes, IC have started asking the questions. ISD la, IC knows that okay, it is a kind of presentation is very complex, but answer is very simple. Presentation of ISD is very, very complex. But mathematics, the answer is the simplest ever that you can have in your input service distributor. Now, one thing that you have to understand about ITC is the normal presumption is that burden is shifted, and normal presumption is that whenever you talk about ITC, there is a section called section 155. It tells that burden to prove that ITC is eligible is on the assessee. If you are telling that I want to claim this ITC and it is eligible, if you are claiming ITC, you have to prove that it is eligible ITC, which means department can anytime challenge that it is ineligible ITC. The burden lies on you to prove that it is eligible ITC. Now quickly talking about all the small definitions. Inputs, capital goods, input services. Common in all the three definitions is they should be used in course or in relation to, in course or furtherance of business. In course or furtherance of business. That is a common point for inputs, input services, capital goods. Input service means any service. There is no input service and capital service. Any service. Inputs, capital goods. Inputs means any goods other than capital goods. And what is capital goods? Capital goods means goods which are capitalized in your books of accounts. Basic accounting. If it is goods, it can be inputs or capital goods. If you are taking to a trading account, a manufacturing account, trading account, profit and loss account, inputs. If it is taken to your balance sheet, capital goods. Input service, whether it is there in your manufacturing account, trading account, profit and loss account or in balance sheet, it is input service. With respect to ITC, even for capital goods, you can take 100% credit at the time of receipt itself. And friends, we are focusing only and only on inward supply. ITC means focus is on inward supply. It can be by way of receipt of goods or services, by way of purchase, acquisition or any other means. The consideration may be there, may not be there. It is not necessary that you have to pay consideration for taking ITC. May be there, may not be there. Outward supply is the repetition of supply, telling the same thing that you are talking about, the supply of goods or services, whether by way of these 8 examples that are there in supply: sale, transfer, disposal, barter, exchange, license, lease, rental. Same 8 examples are there, and it should be in course or furtherance of business. So it is a repetition of definition of supply given in outward supply. Now input tax again is important. Rather, we were focusing on input tax. What is input tax? This has connection with your conditions as well. Input tax means what? Input tax means supposing there is a supplier who is paying GST under FCM. Whether that is input tax? Yes. Whether it is inside your state or outside your state, it is input tax. So tax on supply charged by the supplier. Tax on outward supply charged by the supplier. If there is a supplier who is under composition scheme, if there is a supplier who is under composition scheme, he will pay composition tax from his pocket. He cannot collect from you. So input tax will not include composition tax. Will not include composition tax. But whether input tax will include RCM? Yes. Input tax will include RCM. Always remember that RCM you pay by one hand, cash ledger you get the credit, and other hand credit ledger. Always remember, it is an inward supply. You first have to pay RCM by cash ledger. Immediately you will get the amount in your credit ledger. So it is your input tax. RCM output is never there. RCM can be only input. RCM input tax you pay by cash ledger. If you are eligible for credit, RCM input tax credit you will get in your credit ledger. Customs, if you are importing the goods, what is the duty that you will pay? BCD, SWS, IGST. On IGST you can take credit. You cannot take credit on BCD, SWS. That is cost. On IGST you can take the credit. That is input tax. These are all input tax. Understand that if you can take the credit on these input tax, they become input tax credit. Not necessarily that on all the input tax you can take the credit. Supposing there is a motor vehicle, car or purchase for that on that there will be input tax, but you cannot take the credit. It will be added to the cost. And ITC always has got two steps. One is availment of ITC and second is utilization. Availment is the first step, second step is utilization. Availment is upon satisfying conditions. Utilization has got no conditions, they have got restriction or sequence. That will be a sequence. Now availment has got a time limit. To take the credit as a time limit. Utilization is not having any time limit. Once you take the credit properly in time, you can use it after 1 month, 5 months, 1 year, 5 years, 10 years, 15 years. That is up to you. These are the two steps. And when you're talking about a registered person, input tax credit means you should be a registered person. You should be for paying output tax, you should be a taxable person, whether or not registered. But for ITC, you should be a registered person, means any person who is having GST number but will not include UIN. And when you talk about zero rated supply, there's a special focus on zero rated supply here. Normally in input tax credit, you have to understand this. If you pay output tax, you will get the credit. If you don't pay output tax, you will not get the credit. But for zero rated supply, which is equal to exports plus supply to SEZ. Exports plus supply to SEZ. Even though you are not paying output tax, you will get the credit. Normally, pay output tax, get input tax credit. Don't pay output tax, you will not get input tax credit. Zero rated supply, that is exports and supply to SEZ. No output tax, but still credit will be there. So zero rated supply is your exports and supply to special economic zone, SEZ. Now talking about the conditions, totally there are 11 conditions for you to take the credit. Totally there are 11 conditions. Condition number 1, you should be registered. You should be registered. Condition number 2, the input services capital goods should be used or intended to be used in course or furtherance of business. Condition number 2. Condition number 3, you should have the tax paying document. You should have the tax paying document. What is the document that is normally there? Normally it is invoice or supplementary invoice. Invoice or debit note. Debit note, the other name is supplementary invoice. These are the normal documents that you have. Suppliers invoice or suppliers supplementary invoice, that is debit note. In exceptional cases, you will have self invoice. RCM, where the supplier is not registered. RCM, where the supplier is not, you have to create your own invoice. Take the credit. Bill of entry, when? IGST portion of customs duty. IGST portion of and ISC document. When you talk about head office giving the credit to branch offices. These are all special documents. These are all, understand that preferably you should have an original document. Photocopy generally is not advisable. Now what all content should be there on your invoice? See, supplier has to put a lot of points. But as a recipient, you should focus on all the points that are required to be there on tax document, or you can focus on limited points. I'll focus only on limit. If I want the credit, I'll not see whether supplier has put everything or not. I'll not see whether supplier has given HSN. I'll not see whether supplier has put quantity. I'll not see whether supplier has put even signature. What I'll see, whether my GST number is there and supplier's GST number is there. Whether description of goods and services is there. Whether there is value, whether there is tax, whether there is place of supply in case of interstate supply. I'll see only these points. I am not concerned with supplier putting the HSN, supplier putting the rate of tax, supplier putting the quantity, supplier putting his signature. Even signature is not required. So if you get a question where one of the point of the input tax credit, that one of the document that I am having is not containing invoice, you can take the credit even of that. I should be worried only of these 5 contents. I can take the credit. That is the third condition. Fourth condition, I should receive the goods or services. For me to take the credit, I should receive the document plus goods or services. Here you have 2 special scenarios. At times, I may allow someone else to receive the goods or services on my behalf. When the goods and services are given to a third person on my behalf, it is equal to I have received the goods or services, I can take the credit. If I ask my supplier to bill to me and ship to my customer or ship to my job worker or ship to anyone, can I take the credit? Yes. He cannot take the credit. He will not have the invoice. I can take the credit. Receipt of goods or services by third person on my behalf is equal to receipt of goods or services by me. Second important point, when the goods are received in loss. This point is only applicable for goods, not for services. First point is applicable both for goods and services. This point is only for goods. When the goods are received in lots or installment against a single invoice, then I cannot take the credit on the receipt of first lot. I cannot take proportionate credit also. I have to take full credit on the receipt of last lot. Unfair, but that is how. Supplier will pay entire output tax before removing first lot. Recipient will take entire input tax after receiving last lot. After receiving last lot. So that is the fourth condition. Now, the fifth condition and the sixth condition, we are saying it together. Now, special point about fifth and sixth condition. Fifth and sixth condition. I am taking the credit as a recipient, but I am dependent on someone else. I am dependent on my supplier. My supplier should have paid output tax. My supplier should have paid output tax. This entire concept of provisional ITC that is given is not there. Even a note is mentioned that it is not applicable. How will I know whether my supplier has paid the tax or not? So this condition will be used by the department when they are doing scrutiny. You cannot find it now. This will be used by the department when they are doing the scrutiny. Right. Sixth condition is also dependent on my supplier. My supplier should have filed his outward supplies return, that is GSTR 1 or IFF. GSTR 1 or IFF. When he is filing his GSTR 1 or invoice furnishing facility, only then I will get the information in my GSTR 2B. GSTR, I am not going to see 2A. 2A is dynamic, it keeps changing. I am going to see 2B. Which means on 14th of next month I have to download. On 14th of next month I will download and see what all credits I have. Whether I download on 14th or 15th or 16th, it will show the same information. Same information. Right. My supplier should have filed his outward supplies, that is GSTR 1 or IFF, so that I get in my GSTR. I get in my GSTR 2B. Previously they gave the question of 20%, then 10%, then 5%. Now no question. Whatever is there in your 2B, only that you can take. Only that you can take. Now certain important points about that particular 2B, you will find the connection there. There is a little refer, note there. Now first important point, this 36, you call it as 36.4. 2B is called as 36.4. It is not applicable for RCM cases where supply is unregistered, for import of goods, that is IGST on import of goods, for IST invoices, for NRTP invoices. What is meant by these? It means these four cases, whether or not I get in 2B, I can enjoy credit. Whether it has come in my 2B or whether it has not come in my 2B, I can take the credit. Balance portion, I can get the credit only if it is reflected in 2B. So first I have to compare. I have to compare my books and 2B. Take out RCM, ISD invoices, IGST and import of goods, NRTP invoices, both from my books, both from both. Only then it will be comparable from both. On that I can always enjoy credit. Balance in my books, balance in my 2B, I have to compare what has come in my 2B and then take the credit. Which means I have to keep a pending track. So there is an example which is given here. Obviously I am not going to test the basic thing. I have to keep a track. I will just test the first part. In June month, I have got 1 lakh credit in my books, but I have got in my 2B only 60,000. So I can take only, I have to keep track of 40,000. Next month I have to see whether I am getting the credit of that 40,000, and based on, so in next month I will be worried about my July credit as well as June credit. So in my July 2B, understand that July 2B will not contain only July 2B transactions. It will contain all the transactions of any month filed after 14th of the next month, before 13th of the next month, before that, after the due date of previous month, before the due date of current month. Right, I have to keep track. Complications will be there, I have to segregate. So my July 3B will contain July transactions, June transactions, it may even contain May, April, so that I have to filter it out. I have to segregate it out. So that way I have to work out and see, and I have to find out whether what is spending of that month. So in the first example, I need to keep track of 40,000 rupees. I need to keep track of. So if you see the entire example, out of 40,000, 35,000 has come in July and 5,000 has come in August. I need to keep track. So a July month, whatever credit I am going to take will be of July plus past month credit, which was not awaited. In August month credit I will take plus of July and June. So if you see this particular example, you will find that when you enter July, you find June and July credit that I am going to take. When you enter August, you find June, July, August credit that I am going to take. I need to keep a check on the unavailed credit of earlier months also. I have to apply the same formula for current month. At the same time, I have to see whether unavailed credit of previous month has come now or not. If it has not come now, I'll again postpone it and see whether it is coming in the next month or not. So that way I have to work. So that is condition number 6. 5 and 6, I am dependent on my supplier. Basically 5, I cannot check it real time. That will be checked by the officer at the time of scrutiny. 6, I can keep a real time track myself. I have to check my GSTR 2B. 7 condition, I have to file my returns. This is my own condition. I need to file my returns. My book may have crores of credit, but only if I file my GSTR 3B, I'll get the credit in my credit ledger. So that is my own condition. Unless I file my GSTR 3B, I will not get the credit in my electronic credit ledger. I need to file my returns as a recipient. Obviously, that will be my inward supply as well as outward supply. But as regards my credit is concerned, only if I file my GSTR 3B, my credit will be reflected. My credit will be reflected. So that one needs to be very, very careful about. This is condition number 7. And one more point that you have to be understanding here is, all these conditions are applicable for FCM as well as. But if you see, condition number 5 is applicable basically for FCM, not for RCM. 6 to some extent only for FCM, because RCM, whether I get in my 2B or not, I can take the credit to some extent. It's only FCM. All the other conditions, it is both for FCM as well as RCM. Condition number 8. I cannot either on my GST portion, if it is my capital goods, either on the GST portion I can take the credit or claim depreciation. Depreciation can be claimed on price, but as far as GST portion is concerned, so 1 crore plus 18 lakhs GST, 1 crore I will claim the depreciation. On 18 lakhs GST, either I can take my credit or add it to the cost and claim depreciation. So that is condition number 8. Condition number 9. Time limit to avail ITC. What is the time limit to avail ITC? Due date of September month return of next financial year, or actual date of filing of annual return of that financial year, whichever is earlier. Due date of September month return of next financial year, or actual date of filing of annual return of that financial year, whichever is earlier. So we are standing in 2022-23. So if it is 2022-23, if at all you miss any credit of entire financial year, whether April 22 or March 23, due date of September 23 return, or annual return for financial year 22-23, actual date, whichever is earlier. That is condition number 9 for you. Condition number 10. I need to make the payment to my supplier within 180 days. Again, this is another condition where it is applicable only for FCM. It is not applicable for RCM. It is not applicable for RCM. If I need not wait for payment. The moment I get the invoice, I will take the credit. If I make the payment within 180 days, I need not do anything. If I don't make the payment within 180 days, when I tell payment it is value along with tax, then I need to reverse the credit with interest. And interest will start from the date of taking the credit till the date of reversing it. Right from beginning till the date of from the date of taking the credit in my return till the date of reversing the credit in my return. And as and when I make the payment, I can re-avail the credit. First I will avail the credit. If I make payment within 180 days, nothing. If I don't make payment within 180 days, reverse ITC with interest. As and when I make the payment, I can re-avail the credit. When I am re-availing the credit, understand that I need not see the time limit. I need not see the time limit is only for availment, not for re-availment. Another point, I can re-avail only the credit. Interest that I have paid is my cost. Whatever interest I have paid, it is my cost. That I cannot do anything. This condition of 180 days is not applicable for RCM Schedule 1 cases. Why? In Schedule 1 there is no consideration. Question of payment does not comes. Also for payment by recipient to third party on behalf of supplier. Why? Because in such cases, recipient has already paid it to third party. Though he has not paid to supplier, he has paid to third party on behalf of. It is equal to payment to supplier. It is equal to payment to. So it is not applicable for that. Right? In these three cases, forget about 180 days. For the third point, be careful. Supposing supplier, I am supplier, you are recipient. You are taking the credit. You have paid me 10 lakhs and 1 lakh to third party on my behalf. GST will be charged on 11 lakhs. Right? If 10 lakhs you are not making me the payment within 100 days, ITC should be reversed with interest. Not about that 1 lakh. Because 1 lakh was already paid. So when you have made the payment of 1 lakh to third party on my behalf, nothing will happen about GST portion on 1 lakh. But GST portion on 10 lakhs, this 180 days condition will apply. And the last condition here, that if supplier has done fraud, fraud definition is section 74, section 129, section 130, which you are going to see. 74, 129, 130. If supplier has done fraud, recipient cannot take the credit on that portion. If supplier is paying extra tax, if it is a bona fide case, he can give a document to the recipient can claim credit. But if supplier has done fraud, section 74 payment, 129 payment or 130 payment, even though he is passing on to the recipient cannot take the credit. That one needs to understand. Now, when you are talking about availment of credit, first step is availment, next step is utilization. Availment, as I said, if it is an intra-state supply, you can take the credit of CGST, SGST or CGST, UTGST. If compensation cess is there, even that credit you can take. If it is interstate supply, IGST. If compensation cess is there, you can take the credit. If it is import, only IGST and compensation cess. You cannot take the credit of BCD, SWS, special import duties. You cannot take that credit. That is added to the cost. How to use the credit? There's a particular sequence. Utilization has got a sequence. It is not talking about condition. It is having a sequence. IGST, CGST, SGST. It is going to go in that sequence. First you have to touch IGST input, then CGST input, then SGST input. Right? Forget about the story. Let us finally get the answers. IGST credit first for IGST output, then for CGST output, SGST output in any ratio, any proportion. Once that is over, then CGST credit first for CGST output, then for IGST output. CGST credit, even if there is extra, you cannot use it for SGST output. Finally, SGST credit first for SGST output, then for IGST output. Even if there is more SGST credit, you cannot use it for CGST output. So that utilization formula one needs to remember. First touching IGST credit, then CGST credit, then SGST credit. And in all these three cases, first they are using for their own output. Right, so that you need to remember. Compensation cess credit is simple. Compensation cess credit can be used only for compensation cess output. Compensation cess credit can be used only for compensation cess output. So that is all about your availment and utilization of your ITC. Now let us focus on your blocked ITC. Blocked ITC, block credit. What all credits you cannot take? Section 70, Section 17 subsection 5 tells the list of items on which you cannot take the credit. Now first let us make it very simple. This entire first page is all about motor vehicles, vessels and aircrafts. It is only and only about that. Motor vehicles, vessels and aircrafts. Now how to bifurcate that? First we'll talk about motor vehicles. Right, then we'll talk about your vessels and aircrafts. Now motor vehicles, understand that motor vehicles, if it is for goods or if it is for any other purpose other than passengers and goods, you categorize motor vehicles into three. Used for passenger transportation, used for goods transportation, used for other than passenger and goods transportation, special purpose motor vehicle. Say dumpers, tippers, they are all special purpose motor vehicle. They are not used for transportation of goods, they are not used for transportation of passengers. So if at all you are talking about motor vehicle for transportation of goods or special purpose motor vehicles, including cash carrying vans, you can take the credit. You can take the credit. Why? They will be used only and only for business purposes. If it is passenger transportation vehicle, passenger transportation, you have to be very careful. Then you have to ask one question. What is the seating capacity? What is the seating? If the seating capacity is more than or equal to 14, if it is more than or equal to 14, take the credit. If it, including driver, if it is less than or equal to 13 or less, if it is 13 or less, basically you cannot take the credit. Basically you cannot take the exceptions are there. What are the exceptions? What are the exceptions? In which category you cannot take the credit? Motor vehicles used for passenger transportation up to 13 seating capacity, including driver, that is 13 or less. You cannot take the credit. What are the exceptions? You are talking about further supply of such motor vehicles. Say dealer of motor vehicle. Dealer of motor vehicle. Or you are talking about transportation of passenger service sector. You are talking about red taxi. You are talking about KPN travels. Right. You are talking about even say Ola two-wheelers. Right. There seating capacity is less, but still they are used for passenger transportation service. They are used for Rapido. It's only two-wheeler, but they are used for passenger transportation service. You can take the credit. That is main item for their business. Or training, driving schools. Driving schools. In all these three cases, without that motor vehicle, you cannot do your business. Therefore, you take the credit. Same thing, exactly same thing is there for vessels and aircraft. Exactly same scenario is there. But what you need to understand is, if you see the first 3 points, these are all exceptions. These are all exceptions. Same points for transportation of passengers, but you are talking about further supply of such vessels or aircrafts, or transportation of passengers. Indigo airline is purchasing that airline for transportation of passengers. They can take the credit. Or imparting training, right? They can take the credit, because for them, without these aircraft or vessels, they cannot do their business. If it is for transportation of goods, you can take the credit. Other than that, now other than that means what? Basically you are talking about, say for example, a helicopter which is owned by Reliance Limited for business travel. Even though it is for business travel, forget about credit. Forget about credit. Or aircraft which is purchased by say SS Rajamouli and his team are purchasing an aircraft for their crew members. Their crew members. No credit. Though it is related to business and all, forget about that story. You cannot take the credit. You cannot take the credit. Are we guys clear with this understanding? That is all about purchase of motor vehicles or purchase of vessels and aircrafts. Now we are talking about what? We are talking about related services. The first related services that you can relate is renting or hiring of such motor vehicles, vessels or aircrafts. Renting. You are not purchasing it, you are taking it on rent. And whether you purchase or take on rent, these services will be always there. General insurance services, servicing and repair and maintenance services. So you understand this in a very simple chart. if there is motor vehicle 1 and motor vehicle 2. Please remember the simple concept. Motor vehicle 1, if you can take the credit, if you have purchased it, then you can take the credit, whether it is on rent, you can take the credit for general insurance service, you can take the credit for repair and maintenance service. And if you are talking about motor vehicle 2, if you cannot take the credit on purchase, then if you take it on rent or lease or hire, you cannot take the credit. Or if you are talking about general insurance service, you cannot take the credit. Or if you are talking about repair and maintenance service or servicing, you cannot take the credit. So that you need to know about. If you can take the credit while purchase, then other areas also you can take the credit. If you cannot take the credit while purchasing the same, then other items also you cannot take the credit. Are there exceptions for this? Yes, there are exceptions for the same. Exception. See, I am not going to talk about exceptions when credit is eligible. I am not going to talk about the exceptions when credit is eligible. I am going to talk about exceptions when credit is not eligible. When credit is not eligible for hiring or renting or leasing, credit is eligible if at all it is a statutory obligation. If at all it is a statutory obligation. You got the point. Normally, if I purchase a motor vehicle, I am not allowed to get the credit. The same vehicle I get on rent or lease or hire, I should not be getting the credit. But there is an exception if it is because of statutory obligation. Statutory, which means I can do tax planning. If in a state where employee transportation at night is mandatory, if I purchase that vehicle, I will not get the credit. But if I take it on hire or rent or lease, I will get the credit. And second exception is for your repair and maintenance and general insurance services. These two persons can take the credit always. One is manufacturer of motor vehicle, aircraft or vessels, and general insurance sector. They can take the credit on repair and maintenance and general insurance service, because for a manufacturer of motor vehicle or aircrafts or vessels, they will never purchase the vehicles. They will purchase the raw materials. They will purchase and for them insurance is very important. You cannot think of Tata company or Hyundai company that they are not taking insurance on their stock in trade. For them, insurance is very, very important. They will get the credit. And general insurance company, there is a concept of reinsurance, right? So, if I am the insurance company giving the insurance to you, a normal business sector for your two-wheelers and cars, you cannot take the credit. But if I am sharing the risk with another insurance company, that insurance company will pay output tax, I can take the credit, though it is for the same motor vehicle. You got the point? So that you are talking about subcontract or reinsurance, I can take the credit. So that is all about your motor vehicles, aircrafts and vessels related ITC. Now others, on what all other items you cannot take the credit. If it is food, beverages, outdoor catering, no credit. If it is beauty treatment, cosmetic and plastic surgery, no credit. Health services, life insurance, health insurance, no credit. On all these items, if you see in any question, forget about the credit. But are there exceptions for the same? Yes. Are there exceptions for the same? The exception is, we are talking about statutory obligation is one of the exception. Subcontract. Subcontract. What is this subcontract concept? It means my inward supply, I'll just take a very basic example with say outdoor catering. If I am doing outdoor catering for Infosys company for its AGM, Infosys company cannot take the credit. But I cannot handle say this big contract. I get the help of another caterer. Right? So I am getting 1 crore from Infosys, I am going to give say 40 lakhs to another contractor. He is going to charge output tax. Can I take the credit? Yes. So one, you're talking about subcontract. So that exceptions, yes, you can take the credit. And second exception is you're talking about statutory obligation. Statutory obligation. So there are two exceptions. One is subcontract, second is statutory obligation. Right. There is another part on the right hand side which is given where you're talking about membership of a club, health or fitness center, travel benefits given to employees, not when they are on business tours, but on vacation, leave or home travel concession. Company is paying for the leave of employees. No credit. No. Only exception is statutory obligation. Here you cannot have subcontract. Only exception is statutory obligation. India obviously does not having any kind of such statutory obligation. But if it is there, then if it is not there, if it may come, then obviously you can take the credit. Just think of the scenario when government of India will tell that every company has to sponsor the vacation of all their employees. Then that company can enjoy the credit. Right, so provision is already there. Now friends, you are talking about works contract or construction. Works contract construction is designed in such a manner that only and only government can enjoy. Government does not want you to enjoy. Right, now why we are talking about works contract and construction together? Please understand this. I am constructing my factory for manufacturing. I have got two options. Either works contract, go to a contractor or builder, tell that goods services you give together, works contract. Or I'll tell that you give me only construction service. I'll get the goods. Whatever items you are telling me, how much quantity of cement, sand, bricks, I'll bring it. Now government tells that whether it is works contract or goods plus construction service, concept should be the same. You have to bifurcate that works contract and construction service plus goods into two categories. I'll make this more simple. One is for civil structure including telecommunication towers and pipeline outside the factory. Second is for normal plant and machineries. So you're talking about both works contract or goods plus construction service. If it is civil structure, that is including factory, branch office or your head office, anything, then what they tell, if you capitalize, no credit. If you take it to profit and loss account, take credit. And plant and machinery, if you capitalize it or take it to your P&L, you can enjoy the credit. So they tell that for normal plant and machinery they cannot play around. So for plant and machinery they tell that whether you capitalize it or take it into P&L account, you can take the credit. But when you capitalize it, make sure that there is an extra condition, it should be used for making outward supplies. There is some connection with your outward supply also, you can take the credit. But if it is normal civil structure including your factory or your branch or anything which is having direct connection with your business, then also you cannot take credit. And wait, when you are talking about capitalization, it's not only first time construction. It can also be renovation, repairs, additions, alterations which are major. So that also may be covered. Normal small repair and maintenance, small additions will all come in P&L account. But if it is major, repairs, renovations, additions, alterations, that also as per your accounting standard needs to be capitalized. Right, so this is the summary chart that you need to remember. And more so over here also they carve out an exception. Same, subcontract means you can take the credit. Which means if I am a builder, I am doing construction of a factory for Tata Motors. Tata Motors cannot take the credit. But there is a huge plant, a huge factory. I am taking the help of another builder. So whatever output tax he is charging, I can take the credit. Whatever output tax I am charging, Tata Motors cannot take the credit. So that subcontract point is mostly there in all these cases. And finally, all other small points. Can you take the credit on composition tax? No. Composition tax is paid by the composition taxable person but never collected. Can you take the credit on goods which are used for personal use? No. When you're talking about NRTP, he cannot take any credit except IGST on import of goods. Except IGST on import. NRTP cannot take any credit except IGST on import of goods. If the goods are lost or stolen, if the goods are lost, credit taken should be reversed. If they are stolen, credit taken should be reversed. If they are destroyed, credit taken should be reversed. If they are written off, credit taken should be reversed. If you write back again, you can re-avail the credit. If they are given by way of gifts or free samples, two options. One, you take ITC, pay output tax, deemed supply. Second option, reverse ITC, no need to pay output tax. No need to pay output tax. And the last point we have already discussed in the conditions earlier. If it is a fraud case, you cannot take the credit. The fraud case definition was section 74, 129, 130. If supplier is paying tax by virtue of fraud, in terms of section 74, 129, 130, even though he is passing on to the recipient, which normally will not happen. But even though if he is passing on to the recipient cannot take the credit. So these are all the cases where you are talking about the blocked ITC concept. Blocked ITC concept. Now friends, we are talking about your next concept, which is proportionate ITC. Proportionate ITC. Section 17, read along with rule 42, 43 basically. Proportionate ITC. When you talk about your proportionate ITC, they again go with a very simple concept. Very basic concept. Right. Proportionate ITC is not impacting the entire business. There will be few inward supplies. Supposing I have two outward supplies. One is taxable, one is exempt. One category is used only for taxable. I will take full credit. Second category is used only for exempt. I will not take any credit. Third category, which is used both for taxable and exempt, I will have problem only there. That brings into the concept of proportionate credit. Right, partly for taxable, partly for exempt. One more category, partly for business, partly for non-business. So if certain items are used partly for business, partly for non-business, I'll enter into the ambit of proportionate credit. Or partly for taxable, partly for exempt, I'll enter to the ambit of proportionate credit. Normally, I'll not go. Don't think that I'll go for proportionate credit for all my input services capital goods. Only for those input services capital goods where it is partly for business, partly for non-business, proportionate ITC, or partly for taxable supply, which includes zero rated, or partly for exempt supply, then I'll go for proportionate ITC. Now, proportionate ITC has got a formula, which is got as rule 42, 43. 42 is for inputs and input sources. 43 is for capital goods. So 42 is for your common ITC for your inputs and input services. Input and input services. I'll make this very simple. Suppose there is a total credit, total ITC. We are talking only about input and input services. Total ITC is say 10 lakhs. Say 10 lakhs. Total ITC. Out of which, supposing 2 lakhs is either blocked or for non-business, blocked or for non-business purposes, or only for exempt supply. Only used for exempt supply. Right. So I will not take the credit on that. Out of which balance, say 3 lakhs is for only business purposes and taxable supply. I will take full credit. Leftover portion is called as common ITC, which is say 5 lakhs. Which is say 5 lakhs. I'm making it very, very simple, easy to understand, easy to work out the questions. Now, understand that this is the breakup of 10 lakhs. I've given the breakup of 10 lakhs. 2 lakhs is what category? No ITC category. 3 lakhs is full ITC category. And 5 lakhs is proportionate ITC category. What will happen is 2 lakhs I will never get in credit ledger. But 3 lakhs and 5 lakhs I will fully get in. I should not get full 3 lakhs and full 5 lakhs. 3 lakhs I should get full, I have got full. 5 lakhs I should not get full, but I have got full. So I will get everything in my electronic credit ledger. So don't you think that I have got more? I am getting more. I was not required to get, but I am getting more. Now I am going to reverse it, the credit. I am going to, this is first step. First step, I will take the credit entire 8 lakhs. Second step is I am going to go for reversal of ITC. Reversal of ITC will be based on only 5 lakhs. Nothing to do with 3 lakhs. Only 5 lakhs. Multiplied by exempt turnover divided by of that month. Of that particular month. Simple. Right. So this is the first type of reversal. Second type of reversal will be that only if a question is giving you that there are certain items used for business and non-business. Used for business and non-business, which is 5 lakhs multiplied by. See, when an item is used for business and non-business, you cannot have non-business turnover. Therefore, they are giving a rate, okay, 5% each. Roughly, reverse 5%. Very important point. This second reversal, we call it as first reversal and second reversal normally will not come in the question. It will come in the question if only the question is giving you a hint that there are few input and input services which are used for business and non-business. First reversal will come always. What is first reversal? First reversal is common credit multiplied by exempt turnover divided by total turnover in that month. Second reversal will come only if there are certain inputs and input services which is having use for business as well as non-business. If question is not giving anything, please do not work out second reversal. Stop with first reversal. Stop with first reversal. That's all about your rule 42. One last point is left out. This you have to do month on month, month on month, month on month, month on month. When you're doing this month on month, month on month, this is exempt turnover by total turnover is of that particular month. Year end, you have to do a cross check. Year end, you have to do a cross check. Sir, how to do the cross check? Same steps. Same steps. Then, sir, why to do a cross check? Cross check will be done to see whether you have done excess reversal or short reversal. Understand that the ratio of exempt turnover and total turnover will not be the same all the months. It will be different for each month. One month my exempt turnover is 50 lakhs, taxable turnover is 1 crore. Second month my exempt turnover will be 2 crores, taxable will be 50 lakhs. So ratio will keep changing. For that I have to do a year end check. In year end check I will do exactly same this thing. Assume these are yearly figures. This would have been the year end check. Month would have been replaced by year. This month would have been replaced by year. If these are the figures, if these figures I have given for my year and year data, I would have done exactly step by step same thing. No change. But monthly data will be converted to yearly data. When I do monthly reversals, say R1, reversal 1 and reversal 2. I'll get certain amount, say 1 lakh, 2 lakhs, reversal, etc., say 3 lakhs. 12 months I'll do the reversal for all the months. This will be done on monthly basis. Yearly basis, I'll do R1, reversal 1 and reversal 2. Reversal 2 only data is there. Yearly reversal will have only one answer. Will have only, supposing monthly reversals, total monthly reversals, I'll make a total and I'll find 12 lakhs. Year end reversals can be either 10 lakhs or say 15 lakhs. It will never ever give me the same answer. For sure. Same answer will never ever come. It will be either less or more. If it is less, then what to do? If it is less, what to do? Reclaim ITC of. I have already reversed 12 lakhs, but I should have reversed 10 lakhs. So reclaim ITC. This I have to do. This I have to do before September of next year. Whenever I am taking up ITC, I have to do before September of next year. If it is 15 lakhs, I have to pay. I have to reverse excess 3 lakhs with interest. Interest in GST is always at the rate of 18%. Now interest, one difference, it will start from 1st April of next financial year till the date of reversal. So they don't tell that I will know the data only on 31st of March. So from 1st April they are starting interest. They don't even give me few days breathing time. I come to know the data only on 31st of March. They start calculating my interest from 1st April itself. 1st April of next financial year means immediate next day. 31st March, the moment it is closed, immediate next day interest starts till the actual date of reversal. That I need to check. That is everything about my rule 42. Now 43, yes, I have to again take the same data, try to explain the same thing, but 43 is a bit cautious scenario. Why a bit cautious scenario? Because 43 has got various permutation combinations. If I were to take this particular data, I'll explain with the help of example directly so that you understand the example and also you are prepared for the exam question. You are very much prepared for the exam question. So I'll directly take with the help of example what you are required to do. Examples itself will be very, very clear. See, same 3 categories. We had 3 categories in inputs and input services. What are they? First, block category, non-business, fully for exempt. Second, only for business and only for taxable. And third, common. Same 3 categories. Same 3 categories. But yes, in addition to that, there are certain changes also. Capital goods which is initially used for exempt, later on may be used for exempt and taxable. So please focus on this master example. You are prepared for 3 times the questions have been asked on this 2 in exams and 1 in your RTP. Right. So the question is worth 8 marks. Question size, believe me, it was hardly 7-8 lines, and that too it was a tabular column. 7-8 lines including the tabular column. Question line was only 2. Then there was a tabular column. Right. Now how to crack that? Understand this example. During April 2020, Tata Limited purchased the following. Capital goods A, GST 50,000 exclusively used for exempt supply. B, GST 1 lakh exclusively used for taxable supply. Capital goods C, GST 1 lakh 50 both for taxable and exempt supply. Now please understand that capital goods A, can I take the credit? Capital goods A, 50,000 I cannot take the credit, I will not get in my credit ledger. I will not get in my credit ledger. Capital goods B, 1 lakh, I will get full amount in my credit ledger. Capital goods C, 1,50,000 is common. Actually, I should not get full, but initially I will get the full amount. Now, this 1,50,000 I should not get full, but I have got full. Now I have to do reversal. I will be telling the difference also. Rule 42 reversal actually is called as reversal of ITC, but Rule 43 reversal is called as addition to output tax liability. You are going to add it with output tax. Presentation will make a difference. Your ITC setup will make a difference. You are going to add this with your output tax liability. Now step 2, what is the common ITC? Common ITC, capital goods, you don't have a year-end check in capital goods like input and input services. Because what was the formula for reversal for input and input services? Common ITC multiplied by exempt turnover divided by total turnover. Same thing here, but one thing extra, multiplied by 1 divided by 60. You're going to do this for next 60 months. Next, say, first month and next 59 months. So it is common ITC multiplied by 1 divided by 60 multiplied by exempt turnover divided by total turnover. So that 1 divided by 60 is there, which means automatically there's no year end check. But the formula changes. You're going to do this for 60 months. So 1 divided by 60. Common ITC multiplied by 1 divided by 60 becomes a constant figure. Multiplied by exempt turnover divided by total turnover keeps on changing month on month. So per month, what will be the reversal? 1,50,000 divided by 60. 2,500. But this is not the reversal. Reversal amount is this 2,500 multiplied by exempt turnover is 1 crore and total turnover is 3 crores. This will be added to output tax liability of that month. Technically, it is not reversal of ITC, it is addition to output tax liability. First month would be basic thing. Now, second month, May 2020, Tata Limited purchases following: extra capital goods. Capital goods D, GST 2 lakhs exclusively for taxable supply. E, GST 2 lakh 50 common both for taxable supply and exempt supply. Extra point: capital goods B now will be used for taxable supply and exempt supply. Capital goods B was initially used for only taxable supply. Now it will be used for taxable and exempt supply. Right. First, forget about capital goods B. First, focus on new capital goods. Capital goods D. 2 lakhs fully will be credited to electronic credit ledger. Fully will be credited to electronic credit ledger. Capital goods E, 2,50,000. Common. You should not get full, but as of now you will get full amount in electronic credit ledger. Now capital goods B, there's a change. First it was used for taxable supply, now it is used for both taxable and exempt supply. You will not get anything in electronic credit ledger. Why? You have already got in the month of April. You will not do rework that. You have already got that in the month of exam. Question will be only a particular month. I am taking all the months to understand. Exam will only focus on either April or May. They will be giving that particular single month. Now what is the common credit? Think and answer. Common credit. Now what are the common capital goods? Common capital goods are, it was C, E and now it is B. C, E and B. So totally C has got 1,50,000, E 2,50,000 and B 1 lakh. Totally common credit now it is 5 lakhs. For monthly basis, what you have to do? Divided by 60. This is not the reversal. This is monthly calculation. And what is the exact reversal? Take this amount multiplied by what is the exempt turnover of this month? 50 lakhs. Total turnover 3.5 crores. So this would be added to your output tax liability. Output tax liability. Right. And talking about the last month. In the last month, June, Tata purchases another 2 new capital goods. F, which is used exclusively for taxable supply, 3 lakhs credit. And G, exclusively used for exempt supply, 3,50,000. F and G is quite simple. Why? F, fully it will go to electronic credit ledger. Whereas G, it will not go to electronic credit ledger. So F and G is simple. In June month, what is happening is capital goods A will now be used for taxable supply and exempt supply. Initially, capital goods A was used for only and only exempt supply. Now it is ulta. Only exempt supply now for exempt supply and taxable supply. Now this is the highest point where ICA has already tested, and many students, rather, I could tell that when it has come long back, it came in, if I am not wrong, May 18 or November 8, May 18 exams or November 18 exams. Not the first attempt, sorry. May 19 or November 19. Right. When it came, This was the very tricky calculation here. Why? Now what will happen with capital goods A? First you did not take the credit then. First you never took the credit then. Correct? So first what you will do? What was the credit portion of capital goods A? 50,000. First you will take that credit. First you will take that credit. First you will take that particular amount of credit. But again, taking full credit is something wrong. Taking full credit, it is not digestible because for some months it was used only for exempt supply. So first you will take that full credit. Then for how much time it was used only for exempt supply? April, May. So part of the quarter. So what you will do? You will per quarter you will reverse 5%. That will be added to output tax liability. So what will happen for capital goods A? Two things. First, 50,000 will be taken to credit. Second, this 50,000 multiplied by 5% per quarter or part thereof. Here it is only one quarter, so 5% only. This 2,500 will be added to output tax liability. No reversal. For capital goods, it is always added to output tax liability. With A, two things will happen. Two things. Then common credit is the next step. I am talking about this moment. Common credit we have not at all entered. See, with B nothing happened. With B nothing happened. But with A two things are happening. Now talking about common credit. What all common credits are there now? C, B, C, E, B, A. A is also joining the party. So 5,50,000. Previously it was 5 lakh, now it is 50,000 is also added. Per month how much it will be? 5,50,000 divided by 60. But this is not the addition to output tax liability. This 9,167 multiplied by current month exempt turnover 50 lakhs. Total turnover 2.5 crores. So this 1834 will be again added to. So in June month there are two additions to output tax liability. One in relation to capital goods A, one in relation to all common capital goods. There are two addition to output tax liability. So that you have to be very, very careful. Theoretically, that explanation would have been very difficult. Directly with the help of example, things are actually quite simple. Right. So that is all about your rule 43. Differences. 42. Technically called as reversal of ITC for inputs and input services. 43. Addition to output tax liability for capital goods. Second, that's a year-end check. In 43, there is no year-end check. Third, 42, there is no 1 by 60. Here there is 1 by 60. Right, there is no 1 by 60 there. Here there is 1 by 60. Fourth, for input and input services, there are two types of reversal. Second type is 5% if it is for business and non-business. Here, even if it is business, non-business, there is no second type of reversal. There is no second type of reversal. So these are all the differences that you have. And rather, fifth point, if you want to add more clarity, for input and input services 42, there is no question of changing over here from here to there, but for capital goods, as it is going to be used for a long time, the possibility of changing from exempt supply to common or for use for taxable supply, now used for both taxable and exempt supply, that possibility is also analyzed. These are all the differences. Now, one thing that they have given for banks in a very simple manner. This you need to understand. Normally, banks will come along with insurance. But here it is only for banking sector. Right, rule 38 is only and only for banking sector. For banking sector, they tell that if you want, you do the complications as per rule 42 and 43, the complicated calculations. See, banks has got the main income which is interest on loan, exempt. Other income, processing charges, documentation charges, etc., which is taxable. So banks will have always common credits. So banks can follow complicated 42, 43 or simplified rule 38. In simplified rule 38, categorize them into three. B. If it is blocked, blocked or non-business. If it is blocked or non-business, no credit. If it is branch to branch, 100%. If it is balance, 50%. That's it. Block category, no credit for everyone, including banks. Block non-business. Branch to branch, HDFC branch, Maharashtra providing services to HDFC branch, Tamil Nadu, and we are talking about Tamil Nadu. Tamil Nadu can take full credit. If it is other supplies other than above, 50%. 0, 100, 50. Block 0, branch to branch 100, balance 50. Balance 50%. But option once exercised cannot be withdrawn for the remaining part of the financial year. So banks will have a very easy life because they can avoid 42, 43 and go for simplified rule 38. They can avoid that 42, 43. So that is all about your proportionate ITC. Proportionate ITC. Now coming to your section 18. Actually basically questions from ITC comes maximum category, comes only from this sector. Whatever we have discussed, it comes only from this area. Section 18, on and off, yes. Section 18, ICA's favorite question, sale of capital goods. If nothing else is there, sale of capital goods. Simplest calculation, very simple calculation, complete it. Sale of capital goods. They will give a very basic question. Sale of capital goods, tell us what amount of reversal should come. Very basic question. Right, so in that context, section 18 with respect to sale of capital goods is quite simple. Section 18 talks about special cases. Special cases means one-time cases. They will never happen very often. On and off. They will happen once in a while. At times throughout the journey of the company it will never happen. There might be cases throughout the journey of the company it will never happen. Right. Now first category here, one is about special case of availment on the left hand side and right hand side special case of reversal. Now there are three scenarios covered here. Let me make it very simple. You are talking about first scenario where you are talking about availment, composition scheme to regular scheme. Composition scheme to regular scheme means ceases to be a person under section 10 means from composition scheme you are coming to regular scheme. Your exempt supply has become taxable supply. Your exempt supply has become taxable supply. The last category is you are liable for registration and you have applied within 30 days for registration, or you have taken voluntary registration, taking new registration. Two categories. You are liable, if you are liable, apply within 30 days, you are covered here. You are not liable, voluntary registration, you are covered here. Right. Opposite scenario. Opposite scenario will be what? If I tell the first case was regular scheme to, composition scheme to regular scheme, here it will be, you are talking about from regular you want to go for composition scheme. If on the left hand side it was exempt supply to taxable supply, here it is taxable supply has become wholly exempt. If on the left hand side the third scenario was taking new registration, here it is cancellation of registration. So there are three cases here, again three cases here, ulta cases, exactly three ulta cases, reverse cases here. The left hand side three cases is all about taking the credit. Right hand side is all about reversing the credit. So when you talk about taking the credit, you can take the credit on what? Simple. Whether it is taking the credit or reversing the credit, it is taking the credit or reversing the credit on stock as on the date of conversion. And stock can be only of inputs and capital goods. Stock can be only of, supposing this all conversion is happening on say 31st of March. Right, so stock as on 31st of March we are talking, it can be only of inputs or capital goods. If it is inputs, understand that my inputs may be lying as such or in form of work in progress or in form of finished goods. I have to apply my costing. Right. So if I am a manufacturer of shirt, fabric is say 1 lakh meters, shirt is 2 lakh pieces, and for one piece of shirt I require 2 meters of fabric. Then what will be my input quantity? 1 lakh meters of fabric is 1 lakh meters of fabric, but 2 lakh pieces of shirt is 4 lakh meters of fabric. How? Input output ratio is 2:1. For one piece of shirt I require 2 meters. Input output ratio is, if I have 2 lakh pieces of shirt, 4 lakh meters of fabric would have been. So that ICA has played with it. Your costing. ICA has played with your costing. So inputs. On that, inputs. Whether inputs are lying as such or in form of work in progress or in form of finished goods. And even on capital goods. Capital goods has a special working which we'll discuss. There's a special working. For inputs, whatever ITC is on those inputs, I'll take it. For capital goods, there's a working. There's a particular working that I have to do. I'll take that working later. There's a working. Now, so why have you given 2 cases and 3rd cases? Because in the first 2 cases, I can take the credit of stock of inputs as well as capital goods. But in case of new registration, I can take the credit only of stock of inputs. I cannot take the credit of stock of capital goods. That's the difference. What is the difference that is very evidently there? If it is composition scheme to regular scheme, exempt supply to taxable supply, I can take ITC on the stock of inputs and capital goods. If it is new registration, only on inputs. But wait, if it is reversal, it's same. It is the same. I have to reverse on my stock of inputs and capital goods, whether it is regular scheme to composition scheme or taxable supply to exempt supply or cancellation of registration. Now, whenever it is all about reversal, government will tell that don't see the logic. You reverse even on capital goods. You reverse even on capital goods. You're getting that difference? Right. Reversal, there's no difference. You have to reverse it on stock of inputs as well as stock of capital goods. But availment, normally you get the credit on stock of inputs as well as capital goods, but for new registration, you get the credit only on stock of inputs. That is the first point that you need to remember. And whenever you get the credit on inputs, you have to see the corresponding invoices and decide. Even for reversal, you have to see the corresponding invoices and decide. So that remains the same. There is no change in that particular analysis. It is the same. For capital goods, there is a separate working which we'll discuss later. Now, what are the other differences? First, we'll try to understand that. Other differences. When you are availing, government is very, very intelligent. Government is telling that when you are availing the credit on inputs or capital goods, the stock should not be older than 1 year. If it is older than 1 year, you bifurcate the stock. Within 1 year, older than 1 year. Within 1 year, you take the credit. Older than 1 year, whether it is inputs or capital goods, no credit. And these points are common for all the 3 categories. Whether it is composition to regular, exempt to taxable or new registration, common for all the categories. But when it is about reversal, no such point. No such. Whether the stock is older than 1 year or within 1 year, you have to reverse it. You have to reverse it. Are you getting that analysis? Right. So availment, government is not happy, they should put set all these conditions. When you avail it, government tells that you have to file a form ITC 01 within 30 days plus extension. Otherwise, you will not get the credit. But when you reverse it, you see no such point. You have to file a form. You file in time, well and good. You don't file in time, pay with interest. You reverse it with interest. When you avail it, if the value is more than 2 lakhs, get it certified from CA. When you reverse it, they don't talk about CA except if at all market values are not available, then you get CA certificate. You cannot link it with invoice, market values are not known, then you link it. but not for the amount. When you avail it, the government thinks that okay, more than 2 lakhs means get CACW certificate. Reversal, whether you get CACW certificate is not important. This is a very special scenario. The CACW certificate is for a different reason. Because you are not aware of the market value. Right, normal scenario, there is no need of CACW certificate. If you do less reversal, they will catch hold of you and ask you to reverse with interest and penalty. So they are telling that we will cross verify. We ourselves will cross verify. Right. Now, when you avail the credit, you will get the credit in your electronic credit ledger. When you reverse the credit, you can pay it from your electronic credit ledger or cash ledger. Supposing you have to reverse 10 lakhs. In your electronic credit ledger, there is 8 lakhs. Pay 8 lakhs using credit, 2 lakhs by cash. But if in your electronic credit ledger, there is 12 lakhs. You have to pay 10 lakhs, it is 12 lakhs. So pay 10 lakhs by credit ledger, there is extra credit of 2 lakhs, right? That will lapse. That will lapse. So that you need to understand. And in case of reversal, if you don't have the invoice, as I said, you have to go with market value, which have to be supported by CACW certificate. And there are forms even for reversal. If you are talking about cancellation, the form is GST Act 10, final return. If you are talking about switch over from your regular scheme to composition scheme, or taxable supply becomes exempt supply, it is IT. There are forms. But whether you file in time or not has got nothing to do with reversal. If you don't file this form also, reversal will be there. If you file this form also, reversal will be there. If you file late, reversal will be there. All is, if you don't do it on time, you have to reverse it with interest. Now, only thing that is left out is how to find out availment of ITC on capital goods. Here we will not discuss. For new registration, you cannot take ITC on capital goods, so we will not discuss. And reversal of ITC in relation to capital goods. We'll take the same data to understand it. Supposing capital goods was purchased on 1st of April. Whatever changes happens on say 15th of July. 15th of July. Supposing ITC on capital, the tax on capital goods is say 1 lakh. This was the purchase date. This is the conversion or transition date. Supposing on the left hand side I write conversion of say composition scheme to regular scheme. On here I write exempt supply, taxable supply has become. So one is all about availment, the second is all about, I'm just taking some random examples. For availment, how much you can avail it? Availment is 1 lakh minus 5% per quarter or part thereof. 5%, how many quarters? 1 quarter and 1 part thereof. So that is 2 quarters. So how much I'll avail? 90,000. I'll avail 90,000. Reversal. Reversal is on multiplication method. Availment is on subtraction method. This kind of reversal is only here. This is else nowhere there in this entire ITC. It is only here. Normally you only go with 5%. Here it is 1 lakh multiplied by balance months. How many months it has been used? It has been used for 3 months, 15 days. So even if I write this 15 days as say 7th July. 3 months, 7 days will be treated as 4 months. So whether it is 3 months, 1 day, 3 months, 2 days, 3 months, 3 days, 3 months, 28 days, it will be treated as 4 months. What is the balance life? 56. 60 minus. Capital goods life is always treated as 5 years, that is 60 months. So balance life is 56 divided by 60. How much amount you will get? 93,333. You getting the answer? The ICA can play with this. ICA can only touch capital goods and play with this. Right. Important aspects of capital goods. Very important aspects. We have already discussed. Just a revision. When you talk about availment, ITC availment on capital goods is only available in composition scheme to regular scheme. exempt supply to taxable supply. Not in case of new registration. But reversal is all there in all the cases including cancellation of registration. Second important point. Availment, you have to see 1 year. It should not be older than 1 year. But reversal, you need not see 1 year. Supposing I tell that the 1 year old was there, availment will be 0. But reversal still will be there. You have to be very, very cautious with the data and the numbers. And the last point to complete this, when you talk about reversal, we have discussed in our supply chapter. When you talk about reversal, cancellation of registration, there's one special formula. Cancellation of registration is deemed supply. Vishal Jain registered is different from Vishal Jain unregistered. So reversal will always be in this way. For inputs also, ITC on invoice or output tax payable, whichever is higher. For capital goods also, that formula that we have taken, multiplication method, or output taxable payable, whichever is higher. Same that multiplication formula, whatever we have calculated now. In our example, it was 1 lakh multiplied by 56 divided by 60. But output taxable. This output tax payable is coming because of deemed supply. It is coming because of? So this will be there only at the time of cancellation of registration, not in first two cases. It's coming because of deemed supply. And that is all about your section 18 first part. Now section 18 other part, small other part, favorite question of ICA. It is a bonus question if you get. Sale of capital goods or plant and machinery. What amount of tax you are required to pay or ITC you are required to reverse. Right, when you talk about capital goods, they always talk about output tax liability only. And strictly speaking, sale of capital goods is technically also output tax only. Right, they tell that you have to pay higher of tax on transaction value. What is tax on transaction value? Normal calculation. Selling price multiplied by rate. First calculation, keep it aside. See the question, see the selling price of capital goods multiplied by the GST rate of capital goods. One answer. Compare it with ITC minus 5% per quarter or part thereof. You have taken multiple times how to subtract that. So whatever is the ITC taken on that capital goods minus 5% per quarter or part thereof. If that capital goods is used for say 22 months. 22 months. What will be the answer? 22 months. Okay, I'll tell in this way. If this capital goods is used from June 22 to April 25. It will be 13. See, June 22, it starts from April only. Big part of the quarter is 1 quarter. So you can start with April 22 to March 25. 3 years. 3 years means 12 quarters. And part of the quarter, April 25. Right. June 22 to? So you are talking about 22, 23, 23, 24, 24, 25 and 1 part. So totally 13 quarters. So it will be 1 lakh minus, supposing amount is 1 lakh, 1 lakh minus how many percentage? 65%. So you'll get answer as 35,000. 35,000 compare it with tax on transaction value. Tax on transaction value. So this you need to easily understand. So very simple calculation. First take the selling price multiplied by tax rate. Second, take the ITC minus 5% per quarter or part thereof. For GST, quarter is calendar quarter. So even June will be treated as 1 quarter. Only even June 22 will be treated as 1 quarter. April 25 will be treated as 1 quarter. Special cases. Now special case means you are talking about molds, refractory bricks, molds, dies, sticks and fixtures. Special capital goods, refractory bricks, molds, dies, jigs and fixtures. First condition. Second condition, they are sold as scrap. In that case, forget about ITC minus 5% and all. Very simple calculation. Tax on transaction. Selling price multiplied with the tax rate. Selling price multiplied with the tax rate. That's it. Right. This happens to be one of the favorite area of ICA, mainly the general case. They'll give the purchase date of capital goods, purchase value, tax, sale date, sale value, tax rate. Then tell you find out what amount you are required to pay. Now the last area of your section 18. Section 18. Right. When you talk about the last area of section 18, you are talking about that transition effect, special cases. Right. I'll make it simple. Totally 4 scenarios are there. Totally, I'll make it very simple. First scenario, you are talking about one person is selling the business to another person. VJ Limited selling the business to PJ Limited. Right. First. So whatever ITC is available with PJ Limited, it can give to PJ Limited. Only condition, transfer of liability. Transfer of liability. PJ Limited should agree to take the liabilities of PJ Limited. Second, VJ Limited and PJ Limited merges into say SRK Limited. Amalgamation or merger. First is a case of sale, transfer, lease or death of proprietor. First was a case of sale, transfer, lease or death of a proprietor. Second is a case of amalgamation or merger. VJ Limited, PJ Limited gets merged into SRK Limited in that scenario. Whatever ITC is there with VJ Limited and PJ Limited, they can give it, simple addition to SRK Limited. Only condition is SRK Limited should take over the liabilities of both VJ Limited and PJ Limited. That's it. We are not discussing about these two simple cases. Now third and fourth case is what makes it interesting. Third case talks about, basically we are talking about demerger. Basically our focus is on demerger. Demerger. And here multiple registration. So company, say Reliance Limited, previously having one registration in Tamil Nadu, decides to go for 10 registration in Tamil Nadu. So you are talking about splitting. One is company actually splitting, demerger. One is company is the same, but now it is going for multiple registration. Now, when there is a demerger, supposing SRK Limited demerges into VJ Limited and PJ Limited, whatever ITC balance is left out with SRK, it will give to both VJ and PJ. But in what ratio? In what ratio? It will be apportioned in the ratio of value of assets. Value of what assets? Value of assets means all the assets, whether or not ITC has been availed on them. Though it is all about transferring the ITC, but when you are seeing value of assets, don't see whether ITC was availed or not availed. So on what ratio it will give? In the ratio of value of all assets given to VJ Limited and PJ Limited. Don't see whether on that asset ITC was taken or not. Though we are talking about transfer of ITC, but when you are taking the ratio, forget the fact that on those assets ITC was there or not, on the basis of value of assets. Value of all assets. Right, so each of the new entity will be getting the ITC. See, first understand that we are discussing this entire scenario. Whether the first scenario, sale, transfer, lease or death of proprietor, or second scenario, amalgamation, merger, simple scenarios, or third, demerger, or fourth, multiple registration. We are discussing only if there is a leftover credit in old company and it is to be given to a new company. Otherwise, we are not discussing about this particular scenario. Now, what is the difference between demerger and multiple registration? In multiple registration also, you are going to transfer the ITC available with Reliance Limited 1 registration to Reliance Limited 10 registration on the basis of value of assets. But it need not be given to all of them. It can be given only to any of them, which means it may decide to keep it itself. Out of 10 registration, 1 registration was already there. So it may decide to keep credit with itself, or it may decide to give it only to 3, or it may decide to give to all the 10. Whenever it decides to give it to 3 or say 4 or 10, then value of assets will be relevant. Only of those 3 entities or 4 entities or 4 registration or all the 10 registration. So that's the difference. What difference? Demerger mandatory you have to give. Here it is optional. Demerger you have to give to all the demerged entities. Here you can give it to any of the demerged entities or all the demerged entities. So that is that in this scenario. And next particular point, whenever you are talking about this demerger, there is always a condition that there should be transfer of liabilities. But in this case, transfer of liabilities cannot be there. Why? Thank you. Reliance Limited remains Reliance Limited. So whether it is 1 registration or 10 registration, it has to pay for all the registration. So there is no question of transfer of liabilities. Whenever there is demerger, they talk about CA-CWA certificate. Here there is no such certification. Because it is after all within same Reliance Limited. 1 registration is now converted to 10 registration. Right. So here they will file a form called as ITC02 along with the CA-CWA certificate, and when the transferee accepts it, the ITC of the old company will go to the new companies. Here there is no question of any transfer of liabilities. There is no question of any CA-CWA certificate. The form that they will file is ITC02A, and if at all transfer is there, first of all transfer is not mandatory. Reliance Limited 1 registration need not give it to balance 9. It will keep it itself, or it may give only to 3, or it may give to all the 10. So whenever that is there, opposite registration will accept it. It will reduce from this registration and go to the other registrations. Right. Now there is a circular which I believe if at all at final level they want to ask, they can ask. Till now they have not tried. Tried it. There is a lengthy circular. In fact, the circular runs into 4 pages, and the crux is only very small. So whenever you are talking about ratios, few important points. Think and answer. Just think and you'll have the answer. Now, first point. This ratio that you are applying is as on the date of demerger date or when you are actually transferring, because there will be a gap. Demerger may happen in April. Actual transfer may happen in December. Actual transfer of credit you may do it on December. So this ratio is on which date? April or December? No. Ratio is on April as on the date of demerger. Because when demerger happens, all the assets will be given. You are filing ITC form later, that is different. So ratio is as on the date of demerger. ITC. As on April it was 10 crores. And in December when they are actually filing the form, it is 3 crores. So ITC actual transfer is of 10 crores or 3 crores. As on the date of demerger or as on the date of filing form. As on the date of filing. Because now it is only 3 crores, you can only give or now if it is 12 crores, you can give all the. You are getting the point. Ratio is as on the date of demerger. But ITC transfer, what amount of ITC will be transferred is as on the date of filing the form. You require both, correct? You require ITC multiplied by ratio. So this ITC what you are taking is as on the date of filing the form. The ratio that you are going to take is as on the date of demerger. 2 special points. Another 2 special points. This is about calculation part. Another 2 special points again about the calculation part. This ratio is not pan-India. It is state to state. Which means a company which was into existence in 5 states is now demerged. It is demerged in all the 5 states. Do you think that when demerger happens, SRK Limited will give VJ Limited, PJ Limited same ratio of assets in all the 5 states? In one state it may give 1 crore to VJ, 2 crores to PJ. In another state it may give 5 crores to VJ, 5 crores to PJ. Ratio will be different. Correct? So these ratios calculations are all state-wise. Why? Forms are also will be filed state-wise. There's no one form. In all the 5 states you are registered. So forms will also be filed in all the 5 states. So ratios will be different in each of the states. In one state the ratio may be 1:2. In other state the ratio may be 1:1. In other state it may be 2:1. So ratios that you are doing, and obviously this ITC is also different in different states. Out of 5 states, 3 states may have ITC, balance 2 states may not have ITC. So you are going to transfer only those 3 states. So this is state calculation, not pan-India calculation. State calculation, not pan-India calculation. And last and the most important point, you have to, when you give it to ratios, now you have understood everything. Supposing in Tamil Nadu, the ratio is 2:1 to VJ Limited and PJ Limited. Right. So value of assets to VJ is 2 crores and to PJ is 1 crore. And ITC is total, ITC in total it's a 10 lakhs. So 10 lakhs will be given in the ratio of 2:1. 2:1, which means it will be 6,66,667 and 3,33,333. So when 10 lakhs ITC is given to VJ Limited and PJ Limited in the ratio of 2:1, this ITC is total ITC. Correct? This ITC is total ITC. Now supposing I give the breakup IGST, CGST, SGST. What ITC was available was, say, 5 lakh, 3 lakh, 2 lakh. How much will be given to VJ Limited? How much will be given to PJ Limited? How much is already decided? Should you apply these ratios to CGST, SGST, IGST separately or not? Is the question. How much should to be given is decided. Inside CGST, IGST, inside IGST, CGST and SGST, you can give anything to the extent what is available. Which means, one scenario, I will tell that 5 lakhs IGST I will give only to VJ, 1,66,667 CGST I will give it to VJ. So total should be 6,66,000. Balance IGST is not at all available. It cannot be given to PJ Limited. Out of 3 lakhs, balance of 1,33,333 can be given to PJ Limited, and entire SGST 2 lakhs will be. So inner calculation you can decide. Outer calculation is fixed. Inner, what you want, what you don't want, that you can decide. Otherwise, if it is not said, you will apply this 2:1 for IGST separately, for CGST separately, for SGST separately. Correct? If this statement was not given, what you will do? You know the ratio is 2:1. So you will apply all the times. You have to apply in totality. Inner workings, you can decide on your own. You can decide, you can plan on your own. Rather than deciding, you can plan on your own. That is all about your section 18. This entire circular talks about 4 important points. First, ratio date, demerger. ITC value as of the date of transfer. State-wise or pan-India? State-wise ratio. Total calculation or inner calculation ratio? Ratio is for total calculation, not for inner calculation. You can decide. You can decide on your own. That is everything about your section 18. Okay, we'll complete this ITC by touching up the last 2 areas, ITC and job work. Job work is a very simple understanding. Why you have special points for job worker? Because when you're giving the goods to job work, it is not supply, neither actual supply nor deemed supply. So what will happen in case of job worker is principal will send the goods to job worker. Now it may happen that principal may directly send the goods from his supplier. So principal will ask his supplier, bill to me but ship to job worker. Bill to ship to concept. Wait, even if it is bill to ship to concept, who can take the credit? Who can take the credit? Only principal can take the credit because billing is to principal. Though the goods are directly going to job worker, who can take the credit? So the credit will be only availed by principal, even the goods are going directly to the job worker. Normally, when you are going to see this provision, section 19 read along with section 143 read along with rule 45 read along with rule 55, 2 sections, 2 rules. They tell that you have to bring back the inputs within 1 year, capital goods within 3 years. Inputs 1 year plus 1 year extension, capital goods 3 years plus 2 years extension. But when you talk about timeline, that timeline of 1 year plus 1 year or 3 years plus 2 years starts from the date of removal from principal place. But in this case, the goods have gone directly. So this time limit will start from the date of receipt of goods by job worker. Normally, the time limit of 1 year plus 1 year for inputs, 3 years plus 2 years for capital goods starts from removal from principal's place. Here, principal has not removed. Directly, the goods have gone from principal supplier. So that time limit of 1 year plus 1 year for inputs, 3 years plus 2 years for capital goods will start from date of receipt of goods by job worker. Now, whether the goods are going directly from principal's place or from principal suppliers, one thing make it clear that the goods will go under challan without payment of taxes because it is not supply, and under delivery challan. Now, when you talk about intimation to proper officer, there is no actual intimation to proper officer. You have to tell the proper officer that I am sending the goods to job worker and getting back the goods in a form called as ITC 04. This intimation is nothing but filing a form called as ITC 04. Right? ITC 04 is to be filed by the principal. He is actually in charge of entire job, principal. If at all his previous year aggregate turnover is more than 5 crores, big person half yearly. Previous year aggregate turnover is up to 5 crores, small person yearly. Small person yearly. Big person means frequency is more, half yearly. Previous year aggregate turnover is up to 5 crores, small person. Small person is yearly, frequency is lesser. Due date for April, if it is half yearly, April to September, 25th October, and October to March, 25th April. If it is yearly, full year, 25th April. 25th April of next financial year. So that is all about this intimation. And when you talk about return of the goods should be returned by the job worker to the principal after completion of work within the time period. And we have already discussed the time period, isn't it? What is the time limit? If it is inputs, 1 plus 1 year extension. If it is capital goods, 3 years plus 2 years extension. There are few capital goods for which time limit is not applicable. Molds, dies, jigs, fixtures and tools. They will not be even found. So therefore they tell that for them, forget about the time limit. We call it as special capital goods. Rather, these special capital goods are also there in sale of capital goods scenario. Right, so molds, dies, jigs and fixtures. Here extra point is tools. You cannot even find them. Where are they? Therefore they tell that returning back is not at all a question. Now, the most important point for which this entire provisions are framed. If these goods are not returned back in the time that is said, they are deemed to be supplied. They are deemed to be supplied by principal. From which date? When they were removed. When they were initially removed or they were directly sent by principal supply to job worker. Right from beginning it is called as deemed supply. Not on the completion of this time. Right from the beginning it will be treated as, which means principal will end up paying GST with interest. For sure he will end up paying GST with interest. Right, so such supply should be reported in principal's GSTR1. He will be paying tax with interest. Obviously, job worker will still after that return the goods. That will be treated as separate supply. Either principal can treat it as supply return, credit note, or job worker can treat it as supply and job worker will give the tax invoice. Huge impact. Huge impact. They want to track where the goods are going. They want to track where the goods are exactly going. If they don't come, it has gone without tax. Therefore, they have this cross check that the implications will be huge. And the last point here is that the last 2 points can the goods be transferred from one job worker to another job worker? Yes. All under delivery challan. All under delivery challan. Right. So principal to job worker DC, job worker 1 to job worker 2 DC, job worker 2 to job worker 3 DC, job worker 3 to principal delivery challan DC. But wait, for these job workers they give an option. Either your own delivery challan, or if they are not doing, principal will raise delivery challan on their behalf. Though he is not sending, he will raise delivery challan on their behalf. Or endorsement of delivery challan. Principal has given one delivery challan, right? So job worker will do the work. The nature of goods may change. On the back side, he will write what is the nature of goods now, and he is sending to whom. Job worker will also do the same. Endorsement is the worst option because the paper will not understand what is mentioned. But endorsement is available only if whole consignment or whole lot is transferred. Entire lot. It cannot be in piecemeal. Right. Endorsement is possible when the entire lot is given by job worker 1 to job worker 2. But the first 2 cases are always possible, whether it is entire lot or part of the lot. And this last scenario, can you ask the job worker directly to your customer? See, in the first case when we started, we saw principal supplier directly giving to job worker. Now, can job worker send the goods directly to principal's customer? Principal's customer? Yes, but wait, conditions. Condition number 1. Either job worker should be registered, or principal should have added job worker's place as additional place of business, or it should be notified goods. So direct dispatch from job worker is possible either if job worker is registered, or principal has added job worker's place as his additional place of business, or the goods are notified by the commissioner. Direct dispatch. The same is not true for principal supplier sending directly to job worker. There are no conditions. Always it can happen, even if the job worker is unregistered. Even if the job worker is unregistered. Now, the last few points. Who is responsible for this entire movement? Principal. The responsibility is on principal. He has to take the responsibility. What about waste and scrap generated during this job working? They give a relaxation. Waste and scrap need not be brought back. You not bring back waste and scrap. They talk about the time limit, but you not bring back waste and scrap. But they put a condition that they can be directly sold from job worker's premises. Either principal will pay GST on it, or job worker will pay. Someone has to pay GST. If job worker is registered, he has to pay GST. If not, principal can pay GST. They tell that waste and scrap we give a relaxation. That please don't bring back. No use. Unwanted transportation. It can be directly sold from job worker's place. But someone has to pay GST. Either principal or job worker. That is everything about your job work. Right. Now, we are talking about the last concept here is input service distributor. ISD is a concept where a company is having multiple registration. When the same company is having multiple registration, whether in multiple states or in the same state. Normally it is in multiple states, or it may be in the same state. ISD is born. What ISD will do? For common services like your audit, so income tax audit services or advertisement services, which is common for the company, not specific to a registration. What supplier will do? Supplier will give the invoice to ISD. Supplier will give the invoice to ISD. So it is the office of supplier which will get the tax invoice from the supplier of audit service or advertisement service. Then it will take the credit. After taking the credit, it will pass on the credit to the branches. Pass on the credit to the branches. When I talk about recipient means they are supplier of goods or services having the same PAN, which means branches. They are distinct persons. They are branches. Right. So this is this entire concept of your ISD. When ISD is giving credit, I said presentation of ISD for writing answers will be a bit lengthy, but it is the most simplest thing that you can have in a question paper. Right. If A company is having branch in 5 states: Maharashtra, Delhi, West Bengal, Tamil Nadu, Karnataka. Right, 5 states. Now, ISD is there in, say, Maharashtra. ISD is there registered in, say, Maharashtra. So 5 registration with the 6th registration of ISD. ISD, how will it will pass on the credit? It will give the credit to all the branches. How it will pass on the credit? If it is to the same state, which means ISD is in Maharashtra and the branch is also in Maharashtra, IGST will remain IGST, CGST will remain CGST, SGST will remain SGST. But if ISD of Maharashtra is giving the credit to branches of other states, being Delhi, West Bengal, Tamil Nadu, Karnataka, then whether it is IGST, CGST or SGST, it will take the color of IGST. It will take the color of IGST. So this needs to be understood. How the color will change. If ISD and the branch is in same state, same color. If ISD and branch is in different state, whatever is the color, it will become IGST. Now on what basis? On what basis? How to give to the branches? If an invoice is received by ISD which pertains only to one recipient, give it to only that recipient. Don't distribute to all. If it is pertaining to multiple recipients, only give it to that recipient's pro rata. Which means if it is related to only one state, give it to that state. 2 states, give it to only those 2 states. If it is related to all, then give it to all on pro rata. So this pro rata is coming only in the second and third case, correct? Pro rata means what? Some ratio. What ratio? In the first case, no ratio is required because it is given only to that particular state. Ratio will be turnover of that recipient to whom it is given divided by turnover of all the recipients which is having nexus. Example number 2. If it is to one state, only that state, no ratio. If it is to 2 states, that ITC multiplied by turnover of state 1 divided by total turnover of state 1 and state 2. Not of 3, 4 and 5. To state 2, numerator will be state 2 divided by turnover of state 1 and state 2. That calculation you do. Normal mathematical calculation. If it is related to all the states, then all the states. Now, when you talk about your turnover, normally aggregate turnover includes everything including all the other taxes. But here, turnover will not include excise, VAT and CST. For entire ITC purposes, even for rule 42-43. Turnover will not include excise duty, VAT and CST. Now, next question will come. So, turnover is okay, but turnover of what? Turnover of preceding financial year. Turnover of preceding financial year. So, this turnover that you are taking is of preceding financial year. So, ICA has asked question only with related to preceding financial year. But, if at all, you are giving the ITC to 5 branches, out of which 1 branch is a new branch. 1 branch is a new branch. That will not have any turnover in the preceding financial year. Then you are forced down to see the turnover of preceding quarter, last quarter. This issue will come up only if there is a new branch, point number 1, and ITC is related to that new branch. Supposing there is a new branch, but ITC is related to 3 states, all that there in last year, then preceding financial year. Supposing ITC is related to all the 5 states, one is a new registration, then you cannot rely on preceding financial year, you have to wait till last quarter turnover is available. So if it is April, you cannot see last financial year, preceding financial year, not even last quarter. So you have to wait till July. You have to wait till July, then you will do calculation together of April, May, June and July. Right, this happens only when you are talking about new branch, not when you are talking about closure of a branch. Because when a branch is closed, supposing last year 5 branches are there, this year only 4 branches are there, you will go with only preceding financial year because for all the 4 branches you had the data in last financial year. Right, so that you need to understand. Now, one thing that you have to fix in your mind, that is always asked by ICA, whatever questions they have asked till now, one point is common. ISD is blind. It will not understand what the recipient is doing. So whether the recipient is registered or unregistered, or whether it is dealing with exempt supply or taxable supply, it will give. You do whatever you want. I will give it. If it is not registered, nothing will happen. It cannot take the credit. If it is registered but dealing only with exempt supply, it will take and it will reverse. ISD will give. ISD is blind. It will give the credit to the all the recipients, whether that recipient is registered or unregistered, whether it is dealing only with exempt supply or tax, it will not see. It will not even bother to see. Now, certain important points which are given here. ISD is governed by, invoice is governed by Rule 54. A speciality of ISD invoices, amount will not be there. Only the tax distributed will be there, and it has to file GSTR 6 on or before 13th of next month. Monthly return GSTR 6. It will only take the credit, pass on the credit. Take the credit, pass on the credit. Ineligible credit and eligible credit have to be distributed separately, so that the recipient is aware that it is ineligible. See, it will not see whether recipient is registered or not, whether recipient is dealing with eligible exempt supplies or taxable supplies, but it will see whether it is eligible ITC or eligible ITC. It has to distribute the credit in the same month. This point is actually challenged, but for your exam, it has to be distributed the credit in the same month. And credit distributed cannot be more than credit availed. ISD cannot avail 1 lakh rupees credit and distribute 1 lakh 10,000. So, very normal point. Wrongly distributed credit will be recovered from recipient with interest. Who has done calculation wrong? ISD. Actually, it is the same company, by the way. But it will be recovered from recipient along with interest, not from ISD. Not from, see, one has got excess credit, other would have got short credit, right? One branch has got excess credit, other branch would have got. It is silent on that aspect. It is telling that if your one branch has got excess credit, you reverse with the interest. Forget about that other branch. Can ISD accept any invoices where RCM is there? No. ISD cannot pay taxes. So what to do then? Supposing it is legal service by advocate pertaining to entire company, ISD cannot pay RCM. So it will ask one of the branch to take the invoice, pay RCM, take RCM credit. That branch will give the entire RCM credit to ISD. Then ISD will distribute the credit to all the branches. So there is a scenario in Rule 54 where it will talk about invoice given by recipient to ISD. This is a scenario. Invoice given by recipient to ISD. See, either in a case where supplier has wrongly given the invoice to the recipient, or RCM scenario, because ISD cannot pay any taxes. It has to ask a branch to pay RCM, take credit, pass on credit, which means reverse credit and give it to ISD. ISD will thereon pass on the credit. Right. And a company may have multiple ISD. North India ISD, South India ISD. It may have multiple ISD if it wants. Now the last scenario here, see, if a supplier is giving invoice to ISD, it will distribute the credit to branches. What if a supplier is now giving a debit note to ISD? Supplier is giving a debit note to ISD. Now, which means excess credit will be now given. Debit note means ISD will now take more credit, then ISD will give that debit note to the recipient, right? But this credit will be distributed on the basis of new ratio. New ratio. What is meant by new ratio? Supposing invoices of financial year 21-22, debit note is of financial year 22-23. So, for invoice which was of financial year 21-22, the ratio was of previous year. It was 20-21. When debit note is in 22-23, the ratio will be of 21-22. New ratio, updated ratio. If both invoice and debit note are in same month, no issues. But if ulta happens means supplier is now giving credit note, which means ISD has to reverse credit. It will ask its branches to reverse the credit. ISD will also give credit note. In that scenario, old ratio, which means invoices of financial year 21-22, ratio was of 2021. Credit note is of 22-23, but still ratio is of 20-21. For debit note, new ratio. For credit note, old ratio. For debit note, new ratio. For credit note, old ratio. And see, this increase or decrease need not be only because of supply giving debit note or credit note. It can also be because of earlier short credit was given. Now ISD will give invoice. Earlier excess credit was given. Now ISD will raise credit note. Not always because of supplier. If ISD has done some error, giving more to one, giving lesser to other, it can rectify on its own. It can rectify on its own. But whenever it is about giving credit, new ratio. When it is about reversing credit, old ratio. Old ratio. So that needs to be understood. So when you see ISD now, this I was telling right, ICAE has started asking questions on the ratios of debit note and credit note as well. Right. So that is everything about your input service distributor as well. So we are done with your entire ITC chapter. Yes friends, now let us go through your another important topic where conceptual questions are asked generally. More importantly, when you talk about your revised tax invoice, credit note and debit note, we are seeing document chapter which is titled as tax invoice, credit note and debit note. Now coming to the chapter, as already discussed elsewhere, documents means what? Document means whether it is a written document or whether it is a printed document or it is an electronic document as per your IT Act 2000. So the document can be written or printed or combination of written and printed or an electronic document which can be sent through mail or say WhatsApp, whatever, as per your Information Technology Act 2000. Coming to documents, we are going to see different types of document in this chapter. So let us quickly go through all these different types of documents that we are going to see so that it will make your revision very quick when you are seeing all these documents. Now understand that what are the documents when you talk about basic documents when there is movement of goods. So if at all there is supply and movement of goods, supply of goods along with movement of goods, we are going to talk about a basic document called as tax invoice or bill of supply. So when there is supply, the document is tax invoice or bill of supply. When there is no supply but movement of goods, the document is delivery challan. E-bill is a supporting document. It's not the main document. The main document is if there is supply, tax invoice or bill of supply. If there is no supply but movement of goods, there is delivery challan. So that is the base document for supply or not supply. Now coming to the next part where you are talking about advances. Understand that when you are talking about advances, the focus is only on supply of services because when we are seeing time of supply only for supply of services, advances attracts tax. So the focus is only on supply of services basically. So when you talk about advances, when you get the advance, it is receipt voucher, and when you refund the advance, normally when you get the advance it is receipt voucher, and if the service is actually given, they will be giving tax invoice against that receipt voucher. But in the worst scenario, if you have received the advance, you have given receipt voucher and the contract is cancelled and you refund the advance, then you will be giving refund voucher. Refund voucher. So at the time of receipt of advance, receipt voucher, if the contract is successful and you supply the service, then you will be giving tax invoice. By any chance, if contract is not successful and the advance is refunded back, then it is refund voucher. The next set of documents we are going to see for RCM. Understand that when you talk about reverse charge mechanism, if at all the supplier is not registered, RCM plus supplier is not registered, you will give self invoice, which means tax invoice given by the recipient. Self invoice is nothing a special document, it is nothing but tax invoice given by the recipient. So RCM plus supplier is unregistered, it is self invoice to be raised by recipient. Normally when you talk about document, it is from the angle of supplier and it is from the angle of opposite person. Now you are creating your own document, so we are calling it as self invoice or purchase invoice. Technically it is still tax invoice raised by the recipient. And when you talk about RCM, when the payment is made, whether the supplier is registered or unregistered, understand that if there is RCM, self invoice is not always there. If there is RCM but the supplier is registered, he will be giving tax invoice and he will be writing that tax will be paid by the recipient. If there is RCM and the supplier is unregistered, you yourself as a recipient have to raise self invoice. But when you're talking about making the payment, when the recipient is making the payment, whether the supplier is registered or unregistered, he has to give payment voucher. Payment voucher. There's only one condition, RCM. Supplier may be registered, may not be registered, payment voucher should be given. And the last category you're talking about documents where you're talking about amending tax invoice. Amending your tax invoices. When you're talking about converting your accounting invoice, that is financial invoice to tax invoice, this happens basically in two scenarios. When you're taking registration for the very first time, or when the suspension which was there is revoked, revocation of suspension. So birth and rebirth cases, you are converting your accounting invoice to tax invoices. It is called as revised tax invoices. Revised tax invoice, please don't confuse with the name that you are revising your tax invoice. No, it is the process of converting your accounting invoice to your GST invoice. It happens two times, birth, rebirth, that is new registration and revocation of suspension of registration. If at all you have raised invoice and you have to change the value or tax on the invoice, whether to increase or decrease, then you do it by way of credit note or debit note. For reducing the value and tax, credit note. For increasing the value tax, that is debit note, which is otherwise called as supplementary invoice. So these are all the documents that we are going to discuss. Now coming to the next point that we are having, there are some general things that you need to understand for this chapter. Understand that all the documents that we have discussed are raised by registered person. Whether it is tax invoice, a bill of supply or delivery challan. Whether it is your receipt voucher or refund voucher, self invoice or payment voucher. Right. Whether it is your revised tax invoice, debit note, credit note. They are all to be raised by registered person. There is only one exception. Delivery challan. Delivery challan can be raised or issued only even by unregistered person. So as far as delivery challan is concerned, even an unregistered person can give delivery challan. Right. All the other documents that we have discussed in a summary nutshell, they have to be raised only by registered person, but delivery challan can be raised even by unregistered person. Likewise, the document chapter entirely is focuses from supplier's angle. So all the documents that are there basically are issued by supplier, including debit note, credit note. So when you're talking about debit note, credit note and GST, you're looking from the angle of supplier. You're not looking from the angle of recipient, because as a supplier, if I give credit note, recipient will give debit note. As a supplier, if I give debit note, my opposite party will give credit note. So you are looking only from the angle of supplier. So documents is to be seen from the angle of supplier in GST. Exception, your self-invoice and payment voucher are from the angle of recipient. So when you talk about RCM cases, your self-invoice and payment voucher, they are from the angle of recipient. So that you need to understand. Now, first talking about the base documents where we are talking about your tax invoice and your bill of supply. So we'll be talking about tax invoice and bill of supply. So when a tax invoice is given, when a bill of supply is given, please understand that tax invoice is given only by a registered person, not under composition scheme for taxable item. I repeat, registered person, not under composition scheme, a regular taxable person giving taxable goods or services. Giving taxable goods or services. Whereas when you talk about your bill of supply, there are two possible scenarios where bill of supply can be given. First scenario, you are talking about composition taxable person giving the goods or services. So composition taxable person cannot collect tax from the customer, but he has to pay from his pocket. So he will be giving bill of supply. Or you are talking about a regular taxable person but giving exempt goods or services. So it is possible in these scenarios. One, you are a composition taxable person. Second, you are a normal regular taxable person but you are giving exempt goods or services. Now, in an exception situation where can there be a combo document? If I am supplying taxable as well as exempt item, understand that for taxable item I have to give tax invoice, for exempt I have to give, exempt supply I have to give bill of supply. But there is an exception. If at all you are supplying to an unregistered person, if the supply of taxable item as well as exempt item, if the supply is of taxable item as well as exempt item is to unregistered person, it is to an unregistered person, then a combo document can be given. When I tell combo document, it is tax invoice come bill of supply. So this is possible only and only when you are talking about condition is the recipient, the opposite person, that is the customer, should be unregistered. If the customer is unregistered, then even if the same supplier is supplying both taxable item and exempt item together to the same customer, he can give a combo document rather than giving two documents for taxable item, tax invoice, and for exempt item, bill of supply. He can give one single document, which is your tax invoice come bill of supply. Right, so this is given in rule 46A. There's some technical problem, this is not being highlighting. Okay, let us talk about other scenarios where you don't require separate independent tax invoice or independent bill of supply. So there is a point where you're talking about the value of the goods is less than 200 rupees, very small. The customer is unregistered. Plus one more scenario. You're talking about a scenario where the customer is not demanding a separate tax invoice or bill of supply. In such a case, at the end of the day, you can raise a consolidated tax invoice or bill of supply, which need not be given to any particular customer, but it is only for your records, only for the purpose of your records and your return filing. So that is also a possibility where you don't require separate tax invoice and separate bill of supply to be given to each of the customer. So supposing I have hundreds of customers, out of it 60 are registered. To them I have to give separate tax invoice, bill of supply. Out of which say another 20, the value is more than 200 rupees. So for them also, though the customers are unregistered, but I need to give separate tax invoice or bill of supply. So 60 separate tax invoice or bill of supply, 20 separate tax invoice or bill of supply. Another 10 customers are those who are unregistered, each of the value is less than 200 rupees including tax, but they are demanding separate tax invoice or bill of supply. To them I have to give separate tax invoice or bill of supply. So balance 10 for 60 separate tax invoice or bill of supply because they are registered. For 20 separate tax invoice or bill of supply because the value is more than or equal to 200. For another 10 separate tax invoice or bill of supply because these customers, though they are unregistered, though the value in each of the cases is less than 200, they are demanding separate tax invoice or bill of supply. For the balance 10, where the customers are unregistered, each of them the value is less than 200 including tax, and they are not demanding separate tax invoice or bill of supply, I can raise a consolidated tax invoice or bill of supply and keep it for my records. I will not be giving this to any of the customers. So this is given, but this provision is not applicable for your multiplex screens. So when you're talking about movies in multiplex screens, they need to give separate tax invoice or bill of supply for sure. So this provision where you're talking about having a daily basis, this consolidated tax invoice or bill of supply is to be given on daily basis. This provision is not applicable for your movies which are shown in multiplex screens. Right, so what we have seen is two important points. One, a combo document, only one condition. There's only a single condition that you need to remember. What is that single condition that you need to remember? It is the customer should be unregistered. The recipient should be unregistered. If the recipient is unregistered, even though you are giving both taxable item as well as exempt item, you can give a combo document which is tax invoice come bill of supply. And the second point that we have discussed here is if you're talking about daily basis consolidated tax invoice, three conditions that we have discussed. Now friends, when you're talking about your due date of issuance of invoice for goods and for services, including continuous supply of goods and continuous supply of services, this entire situation we have already completed in your time of supply chapter. So this we are not going to take again. So whether you talk about due date of invoice for goods, 3 situations, due date of invoice for services, 4 situations, due date for invoice for continuous supply of goods, due date of invoice for continuous supply of services, all of them we have already discussed in your time of supply chapter. Right. Now coming to your tax invoice and bill of supply in special cases. Now whatever we are discussing is for both. Rather, in all the cases, rather than the beginning, whatever we have discussed was for both tax invoice and bill of supply. The provisions that we are going to discuss is not only applicable for tax invoice or bill of supply, but they are applicable for all the types of other documents like receipt, voucher, debit note, credit note, etc. Now, when you talk about banking sector and insurance sector, so when you talk about banks and insurance, they have two special provisions. One, they can give consolidated monthly tax invoice or bill of supply to each of their customer. This is without any condition. Two, their invoice may not be serially numbered and may not contain recipient's address. Name should be there, but address may not be there. And signature is also not required if it is an electronic document sent as soft copy as per Information Technology Act. So there are two relaxations to banking sector and insurance sector. One is, we call it as monthly consolidated tax invoice bill of supply. Second point is very clear, that in the contents of the invoice, you may not have the invoice number. Fine. Recipient's name should be there, but address is not required. And lastly, you're talking about even signature is not required if it is an electronic document as per the Information Technology Act. Now you need to differentiate this consolidated tax invoice monthly basis with consolidated tax invoice daily basis. Please understand that when you talk about consolidated tax invoice or bill of supply, so when you're talking about normal consolidated tax invoice or bill of supply versus consolidated tax invoice bill of supply by banking sector. So this you're talking about general, and this you're talking about banking sector and insurance sector. Normal consolidated tax invoice or bill of supply is on daily basis, whereas this is on monthly basis. And when you talk about normal consolidated tax invoice or bill of supply has got conditions, which is we are talking about values less than 200, the customer is unregistered, values less than 200, and not demanding the that customer is not demanding a separate tax invoice or bill of supply. So not demanding separate tax invoice or bill of supply. It has got all these conditions. Whereas when you talk about your consolidated tax invoice or bill of supply monthly, there are no such conditions, which means the value may be up to less than 200 or more than 200. The customer may be registered or unregistered. Whether he is demanding or not is out of context. It's not at all relevant. And also you need to understand that when you talk about your normal consolidated tax invoice or bill of supply, it is not given to any customer. Whereas this is given to each of the customer. Each customer it is given. And more important point, when you talk about normal consolidated tax invoice or bill of supply, it is consolidating all transactions of all customers satisfying conditions. All transactions of all customers satisfying conditions on daily basis. Satisfying conditions means the three conditions we have discussed. Whereas here it is to consolidate all transactions of a particular customer. On monthly basis, which means a particular customer, there are multiple NEFT charges, RTG charges, check issuance charges, check bouncing charges. To a particular customer, a lot of charges will be there on month. On month end, to each of the customer, whether you are registered or unregistered, bank or insurance will give a separate tax invoice or bill of supply to each of the customer. So this, understand that when you talk about banks and insurance, they are consolidating multiple transactions of a particular customer, and each of this consolidated monthly tax invoice will be given to each of the customer. Supposing banks or insurance is having lakhs of customers, this monthly consolidated tax invoice will be actually given to each of the customers, all the lakhs of customers. Whereas when you talk about daily consolidated tax invoice or bill of supply, it has got conditions where the value is less than 200, not registered customer, and he is not demanding. Then this daily consolidated tax invoice is not given to any of the customer, it is kept for documentation purposes only. So that you need to differentiate. That is all about your banks and insurance, two special relaxations. Now we are talking about your goods transportation agency. When you talk about your GTA, goods transportation agency, you need to understand that they don't have any relaxation. Additional details that they have to give. What are the additional details that they are required to give? The details of consignment note. That is, what are the goods transported? Point number 1. What is the good gross weight of the consignment that is transported? Point number 2. Name of the consignor, consignee. Point number 3. Place of origin, destination. Point number 4. Registration number of the goods carriage, in which vehicle it is going. Point number 5. And last point, who is going to pay? GST, whether consignor, consignee, or whether GTA. So these all extra details are nothing but details of consignment note. Details of the goods transported, gross weight of the goods transported, name of the consignor, consignee, origin, destination, vehicle number, goods carriage number, and who is going to pay GST, that person's name and GST number, extra details. And when you talk about passenger transportation service, again the relaxation is very similar to banks and insurance. The one second point relaxation, your serial number may not be there, recipient's name should be there, but address may not be there, and it need not be signed if it is an electronic document as per Information Technology Act. So any passenger transportation service sector, again there may not be serial number, just like banks and insurance. No need of recipient's address, name should be there, just like bank and insurance. And if at all it is e-document, even signature is not required. So let it be your air ticket or rail ticket or bus ticket, you will find that all these things may not be there. You will not find. In your rail ticket you will find your name, but you will not find your address. So it is only from this particular provision. And finally, when you're talking about cinematographic films, movies, what if it is a multiplex screen? What is the answer? What if it is a single screen? What is the answer? For a multiplex screen, mandatorily they have to give e-ticket. Mandatorily they have to give only e-ticket, and that may not contain recipient's name as well as address. Now, name and address may not be there. Mandatorily they have to give electronic ticket. So e-ticket is mandatory. Whereas when you talk about single screen, understand that they have an option to give e-ticket. They can give normal ticket or e-ticket. So when you go to multiplex screen, you will get an e-ticket where electronic ticket will not have your details, both name and address. This time your name and address may not be there, but mandatory e-ticket to each one of you. To each one of you, mandatory e-ticket. Whereas for single screens, e-ticket is optional. They may give to each one of you e-ticket, or they may give normal tickets. And this single screen has also an option to give separate invoice to each of the customer, or a consolidated tax invoice or bill of supply at the end of the day if the customers are unregistered, value less than 200, and they are not demanding separate invoice or bill of supply. So here e-ticket is mandatory to each of the recipient. Here e-ticket is optional, plus they have an option to give separate ticket to each of the recipient, whether e-ticket or normal ticket, or for multiple recipients who are satisfying the conditions, they can go for daily consolidated tax invoice or bill of supply. So that is tax invoice in special cases. For banks, insurance, we have discussed for GTA, we have discussed for passenger transportation service, and we have discussed for cinematographic films. Now, contents and all, you need not go through everything, not so important, but we have tried to give all the contents in form of a pictorial presentation for all the documents. We will not be seeing the contents. Now let us talk about another very important area where you are talking about your e-invoice dynamic QR code, and you are talking about e-payment dynamic QR code. So we will be talking about your e-invoicing on one side compared with your e-payment on the other side. When you talk about the logic of e-invoice, the logic of e-invoice is mainly to make sure that there is no bill trading, there is no evasion of tax. So it is only to make sure that there is no evasion of tax, and the concept is you are required to first report, then supply. First report the transaction on government portal, then make supply. So all the invoices are registered on a portal called as invoice registration portal before they are given to the recipient. So first, before giving the invoice to the recipient, first they are reported on the government portal, that is the invoice portal. And the purpose of e-payment is to make sure that digital payment is promoted, so that the recipient has an option to make a digital payment. Also, tax evasion at the last limb of the transaction is also checked. Now, when you talk about advantages, what are the advantages when you talk about your e-invoicing. Basically, advantage is only from the angle of government to reduce tax evasion, to make sure that bill trading is not there. But yes, advantages are there even for the registered person. Whenever you are generating e-invoice on your e-invoice portal, automatically the details will go to e-way portal as well as your GSTR1. So automation process is there. Compliance cost will be reduced, because whenever e-way bill is automatic, your return filing is automatic, your compliance cost may reduce. And most important point, from the recipient's angle, the opposite party will be assured of its input tax credit, because it can see on its GST 2A 2B that the opposite party has already reported the invoice, because e-invoice comes with the concept of first report then supply. So as a recipient, you are sure that the opposite party has generated e-invoice, and it is highly possible that it will be reported in GSTR1. So you get the details in GSTR 2A 2B, but it will show that it is only uploaded, not filed. Still you are satisfied that high chances are that e-invoice will be finally reported in GSTR1, and you will finally freeze your ITC in terms of GSTR 2A 2B. So that is the advantage for the registered persons. For department, the main advantage, that is the purpose of introducing e-invoice is only for department, to reduce tax evasion, to make sure that bill trading is reduced, and automatic matching of ITC claim. If supplier has reported the same in invoicing portal, it is highly possible that the same will be reported in GSTR1, and the opposite person can claim the input tax credit. So auto matching is there. Better use of resource of department. So these are all the other advantages. When the invoices are automatically checked, department can focus on something else, and economic activities will be finally drastically increased. If the main thing, evasion, is stopped, all the other 3 points are only added on advantages. Whereas when you talk about the advantages of e-payment, that is e-payment dynamic QR code, for the registered persons there seems to be no direct advantages for the registered persons. Only thing is, the more you promote digital payment, government may give you some payments from lottery scheme, which means government may promote. Government wants you to give the facility to the customers for e-payment, and if at all you are giving the facility for digital payment, and if the digital payments are actually made, if the recipients are actually making digital payments, they may get some benefit from the lottery scheme organized by the government. So those recipients who are making e-payment, digital payment, they might get some lottery benefit from the government. So government is trying to promote it. Rather, the only advantage for the government is they are trying to promote digital payment, so that tax evasion is checked even at the last limb of the transaction, which is B2C. Because e-payment dynamic QR code is only for B2C. Now coming to your e-invoicing, first let us understand the entire process flow, what happens right from supplier to recipient. Now e-invoicing, what actually happens, e-invoicing startingly, the seller is required to first report the invoice, then issue the invoice. So seller should have a system, automation software, or an offline utility to prepare a JSON file for your e-invoicing. So seller will report that invoice in a predefined format e-invoice schema called as INV1. So what is this e-invoice schema? This e-invoice schema is a standard format, whether you use a software or not, or whether you use any kind of software, standard format for all the businesses across India, which is called as e-invoice schema. So there are certain contents which are mandatory, and they shall be reported on your invoice registration portal. So whether you want it or not, there is a particular details which is required to be filled for e-invoice schema, whether you use software or directly, or any software rather, whether you use software 1 or software 2 or software 3 or software 10 or directly, these details are mandated, which means it is a standard details that will go inside. So standard details will always be fetched inside this e-invoice schema. This e-invoice schema is nothing but GST INV1. So whether you're directly feeding in on your invoice registration portal, or whether you're using software X or software Y or software Z, all these details will be automatic, will be mandatorily fed into, and final report will be the same. Right, so that will happen first. Then what will happen is you will be uploading this e-invoice JSON file to invoice registration portal as per your schema. Now understand that when you're talking about invoice registration portal, there are 10 invoice registration portal, right, starting from www.einvoice1.gov www.gst.gov.in till www.einvoice10.gst.gov.in. So any of the 10 e-invoice portal you can use. Rather, when you're directly giving the details of INV1 e-invoice schema on portal, you will be using the first portal www.einvoice1.gst.gov.in. Balance 9 portals are used by the different softwares who will communicate on the back end with the balance portals. Now what supplier will do, will prepare an offline utility. Will directly through a software or through offline utility will prepare the JSON file, that is your INV. Then he will upload the e-invoice JSON file to your invoice registration portal as per your standard e-invoice schema, that is INV. So all the details which are mandatory will be fed in for sure, whether you're feeding it directly or through a software. Then the details will go to invoice registration portal, and invoice registration portal will validate the data, generate invoice reference number, send that invoice to the normal GST system. So it will do what? It will first validate the data, generate IRN. IRN is nothing but your invoice reference number, which is unique for that particular invoice. 64 digit coding will be there, alphabets and numbers will be there, and it will send that invoice to the normal GST system. The normal GST portal will do what? Your normal GST portal will rule out that the same IRN is there in the GST portal. It will just check for the duplication of IRN. It will check the system whether there is any duplicate IRN, because lakhs and lakhs of people will be generating your invoice on the same time. So it will just check whether already this IRN is existing or not. Then it will send the invoice details to the GST system. That is, it will, for the supplier, it will go and automatically sit in GSTR1, and then for the recipient it will go automatically to GSTR2A, auto population. After the same is checked, it will add a QR code. It will come back to your invoice registration portal, a QR code which will incorporate the invoice reference number, a QR code, dynamic QR code which is incorporating the invoice reference number. It will be there, and signature will be done to that e-invoice. Now it is technically invoice. There was invoice registration number which was there. Now it is that invoice registration number, which is a 64 digits number. It will be incorporated within the dynamic QR code. Signature will be done, and it will push the data to e-waybill system if required. If at all automatically you want to push the data, part A will be automatically pre-filled. If we are giving the vehicle details, even e-waybill will be generated. So e-invoice portal, it's talking to normal portal first for checking whether there's any duplication. Then e-invoice is generated. Also to the normal portal, it will go and sit in supplies GSTR1 and recipient GSTR2A. And then if required, if at all you are giving the vehicle details, it will also talk directly to the e-waybill portal. Finally, supplier gets the signed copy of your invoice registration number and e-waybill. If at all you have opted for e-waybill, e-waybill automatically will be generated. Part A will be pre-filled. If you are giving the vehicle details, e-waybill will also be there. It will give you your e-invoice for sure. It will give you back your e-invoice for sure. If at all e-waybill data is also filled, part B details, vehicle details is also filled, or e-waybill number also will be generated. So it is nothing but e-invoice with QR code embedding your IRN. So it is nothing but e-invoice is nothing but that will be a dynamic QR code which will have within itself your IRN. So now you can issue to the buyer. Your GSTR1 is automatically uploaded. Now to the buyer, the moment your e-invoice is ready, buyer can view the details in GSTR2A. Now buyer is very sure about the authenticity of e-invoice. So when the QR code invoice copy, the QR code which embeds IRN invoice copy is given by the supplier to the buyer, or where the buyer can directly see that view the details in GSTR2A, it is only uploaded, not filed. GSTR1 will be filed in next month, but it is only uploaded, even that will be shown in GSTR2A. He is very much rest assured of his input tax credit, because normally when someone is generating invoice, it is normal that he will be reporting that in his GSTR1. So that surety will be there. Now, invoice registration number, as discussed, invoice registration number is nothing but your 64 digit unique reference hash number generated by your invoice registration portal on successful registration of e-invoice. So that is nothing but invoice registration number. E-invoice. So the moment you get invoice registration number, that 64 digit number will be converted to a dynamic QR code. So the moment you scan that QR code, you will get that 64 digits invoice registration number. Now, talking about the difference between your e-invoice QR code, which is also dynamic, and e-payment dynamic QR code. Now, understand that when you talk about your e-invoice will have a QR code which is having your invoice registration number embedded in it. Whereas when you talk about your e-payment dynamic QR code, notified registered persons have to give an option to the recipient for making e-payment. So there you're talking about invoice itself is having a QR code which is having IRN embedded in it, e-invoicing. E-payment dynamic QR code is for notified persons, they are required to give an option to the recipient for making e-payment. Whether the recipient is making e-payment or not is not important. They are just giving an option to the recipient so that they can make the digital payment, for which there will be dynamic QR code. Now when you talk about this e-invoice and e-payment, let us see the difference, all the differences that are there. First, understand that what are the supplies that are covered. Supplies that are being covered. E-invoice is mandatory for B2B supplies and exports, whereas e-payment dynamic QR code is for B2C supplies but other than exports. So your e-invoice dynamic QR code is for B2B plus exports. E-payment dynamic QR code is for B2C other than exports. Next, when you talk about the document coverage, your e-invoice dynamic QR code is mandatory on tax invoice, credit note and debit note. Whereas when you talk about your e-payment dynamic QR code, it is only for tax invoice and bill of supply. Document coverage. Now, other difference that is there is when you talk about your e-invoice dynamic QR code, it is for a registered person whose aggregate turnover is more than 20 crores in any of the preceding financial year, right, starting from 17-18. Whether it is financial year 17-18 or 18-19 or 19-20 or 2021 or 21-22. So if you're starting in financial year 22-23, you have to see all these 5 financial years, right, starting from 17-18 or 18-19 or 19-20 or 2021 or 21-22. If in any of that preceding financial year, your pan-India aggregate turnover, not state turnover, pan-India aggregate turnover is more than 20 crores, it is applicable for you. Whereas when you talk about e-payment dynamic QR code, if same point, the difference is the turnover is 500 crores. If your pan-India aggregate turnover is more than 500 crores in any of the preceding financial year from 17-18, in any of the preceding financial year. So if it is in 17-18 or 18-19 or 19-20 or 20-21 or 21-22, in any of those financial year, if your pan-India aggregate turnover was more than 500 crores, e-payment dynamic QR code is applicable. So here it is 20 crores and the other side is it's 500 crores. Now understand that for certain persons, this both e-invoice QR code and the e-payment dynamic QR code is not applicable. What are the common categories which are not there? So when you talk about insurance sector, banking sector, goods transportation agency sector, passenger transportation service sector, and when you're talking about multiplex streets, these are the 6 cases where it is common: insurance, banks, passenger transport, GTA, passenger transportation service, and multiplex streets. In all these 6 cases, you don't have dynamic QR code, you don't have dynamic, e-invoicing dynamic QR code, you don't have e-payment dynamic QR code. Both are not applicable, and both are actually dynamic QR code. So that you need to understand. Apart from that, there are some special points. When you're talking about government department or local authority, they don't have e-invoice QR code, but they may be required to go for e-payment dynamic QR code. SEZ unit, they are not covered by e-invoice QR code, they may be covered by e-payment dynamic QR code. SEZ developer is not exempted anywhere, so they may be required to follow both. And on the right hand side, you have OIDRS from non-taxable territory to non-taxable online recipient. It is always B2C. So talking about e-invoice does not make sense. You are talking about e-payment dynamic QR code is not applicable. To put in a very simple terms, for certain sectors like banks, insurance, GTA, passenger transportation service, and your multiplex screens, e-invoicing is not applicable, as well as your e-payment dynamic QR code is not applicable. But when you talk about your government department or local authority, you talk about your SEZ unit, e-invoicing is not applicable, but e-payment dynamic QR code is applicable. When you talk about your SEZ developer, special economic zone developer, both are applicable. There is no relaxation for them. And friends, when you talk about OIDAR as online information database and access and retrieval services from non-taxable territory to non-taxable online recipient, understand that it is always B2C. It is always B2C. Always you have this B2C. So therefore, it is only and only about e-payment dynamic QR code, which is not applicable. Obviously, e-invoicing, obviously it is ruled out because it is only for B2B transactions. So that you need to remember. Now, understand what is meant by dynamic QR code, because in both the places there is dynamic QR code. When you go to a shop and you scan and make the payment, generally it is a static QR code, because that QR code connects to the opposite person's only bank account. You have to enter the value. So when you go somewhere to a shop and you are scanning the QR code, which is already printed on somewhere, it is static QR code. So it will only link you to the bank account of the opposite party, but amount and details you have to enter. Whereas dynamic QR code means for each of the transaction, there will be a separate QR code. So when I go to a shop and the shop owner showing me a system with a dynamic QR code and I scan it, not only it will be connected to the opposite person's bank account, but also it is connected to the invoice or bill of supply. Value will also be pre-printed. I need not even type the value. Value is also that. Whatever is my invoice value, if my invoice value is 5,555, automatically value also will be there. It is already connected to the opposite person's bank account. I need to just confirm it. So that is dynamic QR code. Now understand that when you talk about your e-invoice QR code, it is nothing but QR code with IRN embedded in it. And when you talk about e-payment dynamic QR code, it is a QR code which is linked for making payment to the opposite party. It is an option given by the registered supplier for making digital payment by the recipient. Recipient may make digital payment, may not make. That is his option, but supplier has to give that option. Also understand that this dynamic, e-invoice QR code has to be generated only on e-invoice portal that we have discussed. 10 portals are there. Whereas this e-payment dynamic QR code is to be generated on own software or own application. There is no portal. It is to be generated on own software or own application. Now please understand the other aspects. If at all you are not complying with your e-invoice QR code, then the invoice itself will be treated as invalid invoice. If at all e-invoice is not given, you are covered but you are not given, the invoice itself is invalid. The recipient may not be able to take your input tax credit because it is invalid invoice. So problem to the recipient. For the supplier, there may be a penalty under section 122, which is supply without invoice. Also there may be detention of goods and penalty under section 129 for transportation without proper document. So for the supplier, there may be a penalty as per section 122 and 129, supply without invoice and transportation without proper documentation. And for the recipient, the problem is he may not be eligible to take ITC, though there is a mistake done by the supplier. When you talk about though you are covered by e-payment dynamic QR code but you are not generating, there may be a general penalty as per section 125, which is CGST maximum 25,000, SGST maximum 25,000. So that is all about both the points. One small aspect which is given in the end. Can you be relaxed from e-invoicing? Yes, commissioner may relax you from e-invoicing. But when you talk about can you be relaxed from e-payment dynamic QR code? Now understand that if the payment is already made by cash or using digital QR code, so as a supplier I have an option that I show the digital QR code on my system to the recipient, he scans and he makes the payment. So his payment is already made. Then rather than giving him a printout of invoice with a dynamic QR code does not make sense because he has already made the payment. Then I can give the payment reference number on the tax invoice or bill of supply rather than that dynamic QR code. See, there are two options. One option, the recipient has already made advance payment. So showing him dynamic QR code on the system or on the printout of invoice does not make sense because already payment is made. Just write payment reference number on the invoice. Or he is yet to make the payment. I've shown him dynamic QR code on the system itself. He scans and makes the payment. Then when I'm taking the printout, again that QR code may not be there, I can write the payment reference number. Or the last option where he has not made any advance payment, he has also not made payment when I've showed him the dynamic QR code on the system, or I never showed him dynamic QR code on the system. Then on my invoice there should be dynamic QR code. Right? Understand that if at all there's already an advance payment, no need of dynamic QR code on the invoice, just write the payment reference number. If no advance payment but I'm showing the dynamic QR code on my system itself and payment is made, then when I'm taking the printout of the invoice or bill of supply, I can write the payment reference number and take the printout rather than having that dynamic QR code. So friends, that was all about your e-invoice QR code and e-payment dynamic QR. Now we can discuss about the other documents where you're first going to focus on your receipt voucher and refund voucher. Friends, as already discussed, this receipt voucher, refund voucher is basically for your supply of services only for supply of services advances are taxed. You've seen that in time of supply that only when you talk about supply of services advances are getting taxed. When this receipt voucher is to be issued at the time of receipt of advance payment, when this refund voucher is to be given. Now conditions are very important for refund voucher. Understand that there was receipt of advance, you have given receipt voucher, but there is no supply made thereon, plus there is no tax invoice which is given, and the advance received is refunded back. In that case, refund voucher will be given. So there are three conditions basically. No supply is made, no tax invoice is given, and the advance received is refunded back. Then you are going to give refund voucher at the time of refund of advance. So you received the advance, you gave receipt voucher. There was no supply made thereafter, no tax invoices was raised, and finally, important point, whatever advance you have received, you have given back refund voucher. Now understand that when you talk about receipt voucher, we are not going to see the contents of any of the documents, but few important points about receipt voucher. When you are receiving the advance, if you are not sure of the rate of tax, which means if you are not sure which item you are going to give, because you are dealing with multiple item and the rate of tax is separate. If you are not sure with the rate of tax, you have to go with 18%. If tax is not determinable, you have to go with 18%. And supposing if you are not sure with the type of supply, whether it is intrastate supply or interstate supply, because your customer is located in multiple states, you don't know whether it's going to take in the same state where you are or he's going to take the goods or services in other state. If you're not sure with the place of supply, then you have to pay IGST. So if you're not sure with rate of tax, go with 18%. If you're not sure with whether it is CGST, SGST or IGST, go with IGST. Now, there's a circular which has explained many things and we are going to see that particular circular. Now, understand that when you're talking about advances, the second part of the circular talks about your credit note. So, we'll be discussing that later. So, we are focusing on the first part of the circular. When you talk about advances, what are the options that you have? So, you have received advance for your supply of services. The contract gets cancelled before the supply is given. So you're discussing about a scenario where you have received the advance and the contract is cancelled and you're going to give the refund of that advance. Now Option 1, you have raised receipt voucher in the beginning. If at all you have raised receipt voucher in the beginning and you have paid GST, then later on you have to give refund voucher. If you have initially given receipt voucher and paid GST, later on you have to give refund voucher. But the important point here is, when you are giving refund voucher, it will not be automatically adjusted in your return. You have to apply for refund of excess payment of tax. You have to separately apply for refund, which is a bit complicated, expensive also. But if at the time of receipt of advance, you give tax invoice and paid GST. See, whether you give receipt voucher or whether you give your tax invoice, you have to pay GST. But assume that if you have given tax invoice and you have paid GST, later on you can give credit note, and rather than applying for refund, even here you can apply for refund, but rather than applying for refund, you can adjust it against your GST liability in the month in which credit note is given, which means automatic adjustment by yourself can be done in returns. So if you have raised the invoice in April and credit note is given in December month there will be reversal of your output tax. Whatever is the tax payment in December month, that will be reduced by this tax in the credit note. So it is highly clear that giving tax invoice is highly better, because when you talk about advances, if at all, if you have received the advance and if you have given receipt voucher and paid GST, later on you have to give refund voucher at the time of cancellation of contract and giving the refund. You have to apply for refund. Automatic adjustment is not there. But in case where you have given tax invoice initially and paid GST, later on either if you want refund you can go for refund, but no one will go for that. Better option is you can adjust this against your GST liability in the month of in which credit note is being given. So that second option is always a better option. Now the circular also talks about credit note. So this part actually does not deal with your receipt voucher, refund voucher. It is a separate thing. If at all the goods are returned back, if at all I am talking about a scenario where the goods are returned back, so there is only one option. Initially you have to give your tax invoice and pay GST. Later on you have to give, there is no two option. Later on, initially if at all the goods are supplied, you have given tax invoice, paid GST. Later on the goods are returned back, you have to give credit note, and in credit note as discussed there will be two scenarios. Either apply for refund, which is not a wise option, or adjust it against the GST liability in the month in which credit note is given. So if at all the goods are supplied, you will be raising tax invoice and paying GST. When the goods are returned back, raise credit note and adjust it against the GST liability for the month in which credit note is being raised. Now talking about the other documents which you have already completed when we have already discussed your initial introduction, self-invoice and payment voucher. So when you talk about self-invoice and payment voucher, it was very clear that self-invoice and payment voucher are very special because they are raised by the recipient. Normally all the documents are raised by the supplier, but these are the documents which are raised by the recipient. Self-invoice is nothing but tax invoice given by the recipient, right? So when you talk about self-invoice, there are two conditions: that it should be an RCM case, that should be RCM applicable. Second, you are talking about a scenario where the supplier is unregistered, so it should be an RCM case and supplier should be unregistered. If supplier himself is registered, he will be giving tax invoice, though he will not be collecting and paying GST. He will be giving tax invoice mentioning the fact that recipient has to pay this tax under RCM. So in self-invoice there are two conditions. Recipient will raise self-invoice, condition number 1, RCM, condition number 2, supplier is unregistered. For payment voucher there is only one condition, and that condition is it is an RCM case. It should be an RCM case. So only one condition is there where you are talking about your payment voucher, that it is an RCM case. Supplier may be registered, may not be, may be unregistered. That really does not make any difference when you talk about your payment voucher. So payment voucher, there is only and only one condition, that there is an RCM. Supplier is registered or unregistered, not relevant. Self-invoice is raised at the time of receipt of goods or services, and payment voucher is raised at the time of making the payment. So that is all about your self-invoice and payment voucher. And as regard you are talking about your invoice of ISD, as already discussed in your ITC chapter, Normally ISD will give invoice to your branches, that is units. Understand one important point, that ISD, when it is giving invoice, it will not write the value, it will only write the amount of credit distributed. Only and only amount of credit distributed. Also understand that if at all the ISD happens to be a banking sector, right, in that scenario, if ISD is a banking sector, serial number is not required. Serial number is not required. This relaxation is not for insurance, only for banking sector. So this is normally the invoice given by ISD to the branches for distribution of credit. At times branches can give invoice to ISD. Normally when it happens, when the supplier is wrongly billed to the branches instead of ISD, or when it is an RCM case where ISD cannot pay RCM, one of the branch has to pay RCM tax and take the credit, then give the credit to the ISD, and ISD later on will distribute the credit. So two scenarios are there. In this scenario, understand that you have to, this branch has to give the details even of the supplier who is giving that particular invoice, because the branch has got that invoice wrongly, or branch has paid RCM, took the credit and again transferring to ISD. So it has to give the details of the supplier as well. Right. Other contents are not so important. Other contents per se is not important for your exams. Now let us discuss about your revised tax invoice. When you talk about your revised tax invoice, you need to understand that revised tax invoice is there in two scenarios. One at the time of taking registration, and the other at the time of revocation of suspension. Revocation of suspension. So birth and rebirth. So when you're talking about taking registration, this is applicable for those who have applied for registration within 30 days from the date they are liable. So this first you need to understand that this will be applicable only and only if you have applied for registration within 30 days from the date you are liable for registration. In that case, your effective date of registration is right the date when you are liable for registration. So for all the supplies made between the date you are liable for registration, which is your effective date of registration, till the date of grant of registration, you would have given accounting invoices without GST. Now, within 1 month after the date of grant of registration, you can give revised tax invoice. Now let us see this in this scenario. Supposing you have started your business on 1st of June, and you have crossed the turnover of say 20 lakhs on 10th of September. So you are liable for registration on 10th of September. Supposing your threshold limit is 20 lakhs. You have applied for registration on 25th of September. You have applied within 30 days. You have applied for registration within 30 days. So your application for registration was within 30 days, which means your effective date of registration is date when you are liable for registration, 10th of September. Now, for all the transactions, between the date when you are liable for registration till the date registration is granted. Supposing registration is granted at a later point of time, which is 2nd of October, till that time. So for all the supplies made between the date when you are liable for registration, 10th of September, till the date you are getting the registration certificate, which is say 2nd of October, you will be converting your accounting invoices to your revised tax invoice, and that revised tax invoice has to be given within 1 month of 2nd of October. That is, it has to be given on or before 2nd of November. Also understand that in this case, whenever you are taking new registration, you will be filing your first return. First return will contain the details right from 10th of September till your 31st of October. Not only 2nd of October till your 31st of October. Now also understand that these are all special points. You will be having something called as first return containing all these details. When you apply for registration within 30 days, you can take the ITC on inputs as on the date you are liable for registration. So as on the stock which was there on 9th of September, even that ITC can be availed. All these points will be there. Now if I make a small change, you started your business on 1st of June, you crosses the threshold limit of 20 lakhs on 10th of September, but the change is you did not apply for registration within 30 days. You did not apply for registration within 30 days. You applied on 15th of October and you got it on 20th of October. So now your effective date of registration will not be the date when you are liable for registration. It will be the date of grant of registration. So your effective date of registration is now date of grant of registration, that is 20th of October. Can you give revised tax invoice? No. Can you take the stock ITC of the stock of inputs as on 9th of September? No. But still you will be filing your first return. But first return will have all the output tax details right from your 10th of September till 31st of October, because you have got the registration certificate on 20th of October. So that output tax will be the same, but input tax credit you will be eligible only from 20th of October. So if you talk about the previous example, you will be giving the details of output tax as well as input tax credit right from 10th of September. Whereas in the second example, your output tax will start right from 10th of September, but your ITC will be eligible only from 20th of October. Your ITC will be eligible only from 20th of October. That you need to remember. Now talking about the second scenario where you are going to have revised tax invoices, suspension of registration followed by revocation of suspension. So who is covered here? The persons whose registration has been suspended. And also understand that during the period of suspension you would have made supplies but without GST. Now once your suspension is revoked, it is retrospective revocation. You have to issue revised tax invoice within 1 month from the date of revocation of suspension. Right. So again understand that we are talking about a person who has obtained registration on 1st of June. His suspension is his registration is suspended on 10th of September and it is revoked on 2nd of October. So for all the transactions between 10th of September to 2nd of October, he would have given normal financial invoices without GST. Now he can give your revised tax invoices. He is required to give your revised tax invoices, and that needs to be given within 1 month from the date of revocation, which is 2nd of November. Also, when you talk about revocation of suspension, again first return will be that for all the transactions right starting from 10th of September till 31st of October, not 2nd of October, the month end, till 31st of October, first return will be there for group of months. Also understand that when you're talking about this suspension of registration may not be revoked. So you obtained registration on 1st of June, your suspension was there on 10th of September, and finally there was never any revocation of suspension. Your registration itself is cancelled on 2nd of October, which means once your registration is cancelled, there is no need of converting accounting invoice to revised tax invoice. There is no concept of first return. So that is again given here. Right. Now other small aspects of your revised tax invoices, between the time of your date of liable for registration till the date of grant of registration in the first case registration, and during the period of suspension in the second case where you are talking about suspension followed by revocation of suspension, you have given accounting invoices. Now you are converting that into GST invoices, which is nothing but revised tax invoice. Now should you give separate invoices? Again you have to understand that if at all it was B2B supplies, the supply is to registered person, whether it is interstate or whether it is intrastate, you have to give separate revised tax invoice to each of the customer for the tax invoice already raised. For each of the transaction you have to give separate revised tax invoice. So if it is B2B, whether interstate or intrastate, each of the accounting invoice has to be converted to separate single revised tax invoice. But if it is B2C, then you have to ask a question whether it is intrastate or interstate. If it is intrastate, irrespective of whether the value is up to 2.5 lakhs or more than 2.5 lakhs, you can give a consolidated revised tax invoice. Because B2C recipient is not worried, you can give a consolidated revised tax invoice for all the supplies given to that particular recipient. Consolidated revised tax invoice for multiple transactions, single consolidated revised tax invoice for your records. If at all it is interstate supply, then ask yourself a question whether the value is up to 2.5 lakhs or more than 2.5 lakhs. If it is more than 2, if it is up to 2.5 lakhs, again you can give consolidated revised tax invoice for all such transaction in that state-wise. It is to be seen state-wise. Consolidated revised tax invoice for each of the state. So if we are interstate supplies in 10 states, where in each of the states there are few transactions which are up to 2.5 lakhs, for all the transactions you can give a single consolidated tax invoice for that particular state, each of the state. And if it is B2C and it is interstate and the value is more than 2.5 lakhs, then you have to give separate tax invoice to that particular recipient. So understand that if it is B2B, separate revised tax invoice. B2C, within the state, consolidated revised tax invoice. B2C, interstate, amount up to 2.5 lakhs, consolidated revised tax invoice. B2C, interstate, amount is more than 2.5 lakhs, then you are talking about revised tax invoice to each of that particular recipient. So that is all about your revised tax invoice. Now finally you are talking about your debit note and credit note. So when you are talking about your debit note and credit note, understand that there are few points that we have already discussed in other places. Nevertheless, we'll again come back here again and see. Understand that credit note and debit note is from the angle of supply. Don't forget that. So when you talk about credit note, what are the scenarios where you are talking about credit note? There is decrease in value, there is decrease in tax payable, the goods are returned, or the supply is found to be deficient. 4 scenarios. Either there is decrease in value, or there is decrease in tax, or the goods are returned back, or the goods or services are found to be deficient in quantity or quality. Whereas debit note, there are only 2 scenarios. There is increase in value and there is increase in tax payable. Only 2 scenarios. You have to look from the angle of supplier, not from the angle of recipient. Now understand that when you talk about credit note, it is a decrease in value followed by decrease in tax. Credit note is optional, because it will reverse you are going to reverse the output tax and government is going to get a lesser revenue. Whereas debit note, which is otherwise called as supplementary invoice, is mandatory because it is going to increase the government's revenue. Now the other points, when you talk about your credit note, there are conditions. What are the conditions? That first is time limit. You have to give your credit note within September month of next financial year, or date of filing of annual return of that financial year, which was earlier. So last date for credit note is September month of next financial year, or actual date of filing of annual return of that financial year, whichever is earlier. One more condition is you can reduce your output tax liability only if the recipient has reversed proportionate ITC. So there are conditions. Whereas when you talk about your debit note, there are no such conditions. There is no time limit. Obviously, there's no such condition that if you're paying extra output tax, ask your recipient to take extra ITC. He can take it, but there's no such condition. The other name of debit note is supplementary invoice. So there are no conditions, 0 conditions. Right? For credit note, when you're reversing output tax, give within time, September month of next financial year, or actual date of filing of annual return of that financial year, which was earlier. If supplier, you are reversing output tax, make sure that the burden is not shifted to the recipient, and recipient is reversing proportionate ITC. Whereas debit note has got no such conditions. Can a supplier give consolidated debit note and credit note for all the supplies for made during that year? Yes, supplier can give consolidated credit note for all the supplies made in a financial year. Supposing for multiple invoices, a discount is given together. So supplier need not give discount against each of the invoice. He can give one consolidated credit note for all the invoices in that financial year against which discount is given. Also, supplier can give one consolidated debit note for all the supplies against which the price is increased. So normally debit note and credit note are linked to invoice. But for multiple invoices, if you are giving credit note, multiple invoices, if you are giving debit note, is it possible that you can single credit note, single debit note? Yes. But those invoices against which credit note or debit note is given, which is consolidated, single means consolidated, the invoices should be of the same financial year. So that you need to remember. So these are all the points about your debit note and your credit note. Friends, finally we are talking about the last set of document, which is all about your delivery challan. So when you talk about your delivery challan, one thing we have made it very clear in the beginning itself is delivery challan is a document which is given when there is no supply. So delivery challan is given at the time of removal of goods for transportation. In what all cases? One, you are talking about supply of liquid gas where the quantity at the time of removal from the place of business is not known. There is supplying the quantity, but you are not sure of the quantity, how much quantity. Where you are supplying a liquid item or a gaseous item where the quantity at the time when the same goods are removed from the place of business of the supplier is not known. You are not sure of the quantity. Second, the goods are sent for job work. Again, when the goods are sent for job work, it is not supply. Third, the goods are sent for reason other than supply. Fourth, any other notified case by CBSE. If you see all these four cases, you will find that there is no clear-cut supply. So first is a case where there is a liquid item, gaseous item, where you are not sure of the quantity, how much is the supply at the time of removal. So delivery challan. Principal to job worker, there is no supply, delivery challan. Transportation of goods other than by way of supply, delivery challan. Notified case. One of the notified case is a very special scenario which is given here. Supposing the goods are given in semi-knockdown format or completely knockdown format or in batches or lots against a single invoice. So they are given sent in installments but against a single invoice. Before the dispatch of first lot, what you have to do, because it is a single transaction, you have to raise a tax invoice before even the first lot is dispatched. So supplier has to pay the entire output tax right in the beginning. Supposing it is going to go in 9 installments right from April to December. So before the first lot is removed, supplier has to pay the entire output tax because he has to raise the invoice before the dispatch of first lot. But when actually each of the lot is going, supposing each of the truck is going, 9 trucks are going, right? Each worth say 1 crore. But the problem is the invoice is worth 9 crores, but each of the truck will have 1 crore value. So what to do? For the first 8 trucks, first truck and the next 7 trucks, for the first 8 transactions, consignments, what you have to do? You have to give a delivery challan for 1 crore rupees along with a certified copy of tax invoice, not the original invoice. Delivery challan giving reference to tax invoice along with certified copy of tax invoice. If at all that is EO bill, that EO bill will be corresponding to delivery challan, not tax invoice. So tax invoice is say for 9 crores, but this delivery challan will be for 1 crore, EO bill will be for 1 crore. Right, and you have to, along with that, you will be giving a certified copy of tax invoice. Understand that there is supply, but the truck which is going is supply is for 9 crore, but the truck is containing goods only for 1 crore. So you will be giving a certified copy of invoice of 9 crores, but the truck contains only 1 crore goods. So you will be giving delivery challan for 1 crore along with EV bill for 1 crore, and that delivery challan will give the reference of tax invoice that it is supply, but this truck is not full supply; it is only part of the supply. Therefore, you are going with delivery challan and EV bill. Same is true with the last truck also, last lot also. The only change that is there in the last lot, same thing. You have to understand that there will be delivery challan giving reference to the tax invoice, but in the last lot you will be giving the original copy. For the first 8 lots, only certified copy will be there. For the last lot, original copy. Understand that supplier will pay tax on the entire 9 crores right in the beginning, April month. But recipient can take credit only at the time of receipt of last lot, when he has received all the lots. So therefore only in the last lot original copy of invoice will be given. So that you need to understand. Now there are other points which is given. Now what is the other point that is given? So if you see this next point, tax invoices versus delivery challan, assume there is a scenario where the goods are transported for the purpose of supply. You are actually supplying it, but tax invoice was not given. The goods are given for the purpose of supply, but you fail to give tax invoice. But you fail to give tax invoice at that point of time, at the time of removal of goods. So the supplier at that time of supply, he has not given tax invoice, he has given delivery challan. Immediately after delivery of goods, he shall issue a tax invoice. So this is only a clarification that there was supply, but for some reasons you could not give a tax invoice. So there was clearly supply, but for some reasons tax invoice could not be issued at the time of removal of goods. The moment the goods are delivered, please raise tax invoice. So that is the point which is given here. Another point which is telling that it is, what is it is telling, when the goods are being transported on delivery challan in lieu of invoice, the same shall be declared in EU bill. So when you are transporting the goods on delivery challan in lieu of invoice, the example that we have discussed, which means you are talking about there is a supply, but supply was for 9 crore, but you are giving only 1 crore item. So you are giving delivery challan in lieu of invoice. You have to give invoice. Invoice is already given. Certified copy of invoice is for 9 crore, but what is transported is only 1 crore. So now you are giving delivery challan in lieu of invoice. So delivery challan will have the reference number of invoice. That should be clearly mentioned on e-way bill as well. So that is also given here. Now friends, we are done with all the different types of documents, whatever is there in this particular chapter. Now let us discuss about the circulars which are there. If you see the circulars, you will find that the initial set of circulars are for your delivery challan. So circular 1 to circular 4 are for delivery challan. Circular 5 and 6 are for your e-payment QR code, dynamic QR code. And the last circular is all about your mainly basically about your documents and input tax credit note and input tax credit. So when you see the first circular, it is telling that in a scenario where you are supplying something to your customer through a dedicated pipeline, you are dedicatedly giving say 100 units to your customer, but you don't know whether he is going to accept 100 or not. At the end of the time, he is accepting say only 15 units. So you have supplied him 100 units dedicatedly. Every morning you supply him 100 units. You don't know whether he is going to accept 100 units or not. At the end of the day, he tells that I want only 15 units, say for example, and finally 85 units are returned back. So what is the document? When the initial 100 units went, they were not supplied, so it is delivery challan. So for the initial 100 units, there is delivery challan. When the 15 units are accepted at the end of the day by the recipient, then for that there will be a tax invoice. When the 85 units are returned back, again there will be delivery challan. So when you are sending something to customer but you are not sure how much it will be accepted, it is not supply, delivery challan. When he has accepted some quantity, say 15 units out of 100, for those 15 units alone, tax invoice. When the balance 85 units are returned back, again there will be your delivery challan. Now second point talks about a scenario where you are talking about chain sales. Supposing I am taking 10 sets of jewelry to say Joy Alucas. I don't know how much they are going to accept. They select say 2 sets of jewelry and they keep with them. So I have supplied them 2 sets. And when I come out of their premises, I have only 8 sets of jewelry. So what will be the documents? So when I go from my place to Joy Alucas, I will be raising delivery challan for 10 sets. Why? When I don't know how much will be accepted by the customer, there is no supply. So that is delivery challan. So when I am taking 10 sets to Joy Alucas without knowing how much they will accept, there will be delivery challan. When 2 sets of jewelry accepted by Joy Alucas, for that I will be raising tax invoice, for which I have to carry a manual invoice book. I don't have an option, but I have to carry a manual invoice book for a very simple reason that I may be having all my invoices on my software. But when I came out of Joy Alucas, I will be having only 8 sets of jewelry. So if an officer is stopping me, I have to explain. I have to tell that 10 sets of jewelry I brought from my office, delivery challan for 10 sets. 2 sets accepted by Joy Alucas, supply was there, tax invoice. So I have to carry a manual invoice book where I am going to give tax invoice to Joy Alucas at that point of time itself. Again, later part of the day, I may go to my system and I may put that invoice on my software as well. So that is a different story. But I need to carry manual invoice book. So this is not only true for jewelry sector, this is true for all the sector where you have the concept of chain sales, where you go to customer place, door to door, but you don't know how much quantity they are going to accept. On the next circular, this is all about second circular. The next circular is all about artist and art galleries. Supposing you are talking about an artist who is exhibiting his paintings in art galleries. Now understand that normally art galleries are like agents who will get commission. So when artist is sending his paintings to art gallery, there is no supply, delivery challan. When say hundreds of paintings are sent to art gallery, there will be delivery challan. One set of painting is selected by one of the customer. So there will be tax invoice. So artist to art gallery, there is no supply, delivery challan. When one set is selected, then there is supply by artist to the customer, tax invoice for that one painting. So that is first scenario. But what if I tell that art gallery is acting like special agent as per schedule 1, which means art gallery has the right to raise invoice under their own name. Then artist becomes the principal, art gallery becomes the special agent as per schedule 1. Then artist to art gallery, 100 paintings. It is not actual supply but it is deemed supply. I have to give tax invoice for 100 paintings. One painting is selected by the customer. Then art gallery to customer, there is tax invoice. Understand the entire flow changes. If it is normal agent, if art gallery is normal agent, then for 100 paintings by artist to art gallery, there is no actual supply, no deemed supply, delivery challan by artist. For one painting that is selected by the customer, artist to customer, tax invoice. So artist to art gallery, delivery challan, artist to customer, tax invoice. Now, if I tell the art gallery is a special agent as per schedule 1, which is having the right to raise invoice under their own name, artist to art gallery, it is not actual supply but it is deemed supply. Artist will give tax invoice for 100 paintings. And art gallery to customer, because now art gallery will be acting like the owner of the goods. Customer will always think that art gallery is the owner. Art gallery to customer, art gallery will give it tax invoice to customer. So entire flow changes. This you already discussed in your supply discussion. Now the last circle about delivery challan. When you're taking something outside India for exhibition purposes, understand that when you're taking something outside India for exhibition purposes, taking goods outside India for exhibition purposes, there is no supply. When there is no supply, the document is delivery challan. So when you're taking goods outside India for exhibition purposes, there is no supply, delivery challan. Understand that when there is no supply, there cannot be zero rated supply. Right? So whether you are going on payment or under LUT does not make any point. So again, talking about delivery challan, when you are taking goods outside India for exhibition purposes, there is no supply, so the document is delivery challan. When in the exhibition few goods are selected, then there is supply. Supposing you are taking 100 units outside India for exhibition purposes, for 100 units delivery challan. Out of 100 units in outside India, say in USA, 10 units are selected. For those 10 units, you have to give tax invoice. But understand that when goods are taken on approval basis, the time limit which is there is 6 months. Within 6 months, either you have to sell it or again bring back the goods. So 6 months is the time limit which you have seen in due date of invoice for goods right at the time when we have seen your time of supply. So when you're talking about you are taking the goods outside India for exhibition purposes, no supply, delivery challan, 100 units. Out of 100 units, 10 units are selected, there is supply, you have to give tax invoice. Initially when there is no supply, there cannot be zero rate supply. So on payment or under LUT does not make sense. Later point of time, 10 units there is supply. So then it becomes zero rate supply. Going on payment is not possible because going on payment can be done only when you're filing shipping bill. Shipping bill was filed some time back. So now only under LUT is the option. You can go only under LUT. When the balance 90 units are brought back, again there's no supply. Delivery challan is only the answer. These are all the 4 circulars which are dealing with your delivery challan. Now the 5th circular and the 6th circular are dealing with your e-payment dynamic QR code. As already discussed, if the payment is already made in advance, whether by cash or UPI payment or any other means, before raising the invoice, then on the invoice dynamic QR code need not be there. Payment reference number is sufficient. For prepaid invoice, there need not be dynamic QR code because payment is already made. Payment reference number is sufficient. That we have already discussed earlier. Also, next point is about when you are supplying through ECO, and ECO has already complied with your e-invoice dynamic QR code. Whether supplier is also required to give this e-payment dynamic QR code? Yes. Supposing I am supplying through Amazon, and both of us are covered by e-payment dynamic QR code. Understand that this clarification tells that both your electronic commerce operator as well as the supplier, both on their invoice have to give dynamic QR code. So technically it does not make sense because when you are supplying through ECO, payment will be made to ECO, then ECO can give dynamic QR code. At times payment will be made to supplier, then supplier can give dynamic QR code. They want to avoid confusion. They don't know who is going to get the payment. So they are telling that if for both of them the provisions are applicable, both the supplier whose goods are being supplied through ECO as well as the ECO through which the platform the goods are being supplied, both of them need to give dynamic QR code. E-payment dynamic QR code. Now, there are certain circulars about basically documents as well as ITC. First is all about free samples and gifts. Free samples and gifts, as already discussed, you have two options. Either reverse ITC, no need to pay output tax. Reverse ITC not only on that item but also on related input sources, or have ITC and let it be deemed supply as per schedule 1 para 1 and pay output tax. If you take ITC, pay output tax, deemed supply schedule 1. If you are reversing ITC, then no need to pay output tax because it is not deemed supply. So that is about your free samples and gifts. Buy one get one free. Understand that when there is a buy one get one free or buy two get three, it is technically not free, because when I am having a marketing strategy where I am selling two and giving one free, technically it is not free. When technically it is not free, it is only marketing strategy. When technically there is nothing free, there is no need of reversal of ITC. So here the important point is ITC need not be reversed, right? And as far as rate of tax is concerned, say buy 2 get 1 free, or buy 3 get 1 free, or buy 1 get 1 free. Understand that it is not free. It is not like free gifts or samples. There is no need of reversal of ITC. You are going to pay output tax, no need to reverse ITC. And when you are going to pay output tax, see whether it is a composite supply or mixed supply. Accordingly apply the rate of tax. So that is clarified. Now next is about buy more, save more, volume discount and secondary discount. So it is all about discounts. So it is all about credit note. So what are they telling? If the discount is given on the invoice, then you are going to pay GST on net selling price directly. If the discount is not on invoice, later on discount is given by way of credit note, you have two options. Either give GST credit note where you have to reverse output tax and recipient has to reverse proportionate ITC, or you have an option to give financial credit note where you need not reverse your output tax, recipient need not reverse input tax credit. So understand that whenever you are talking about discounts, whether at the time of invoice or later on, at the time of invoice there is no issue at all. Directly it is on the invoice, you pay GST only on the net selling price, so recipient will get only the corresponding ITC. But if it is later on, so when you are talking about giving credit note later on, you have two options. Giving GST credit note, you reverse your output tax, recipient will reverse proportionate ITC, or you give financial credit note because credit note is optional. GST credit note is optional. You don't reverse output tax, recipient need not reverse any proportionate ITC. Now certain other common provisions which are common for all the documents that we have discussed. Section 32 and section 33 have to be read together. Section 32 tells that unregistered person cannot collect tax. Section 33 tells that registered person only can collect tax, and that too as per law. Also, it should prominently indicate what is the tax amount on all the documents. So, section 32 tells that unregistered person you cannot collect tax. 33 tells that registered person you can collect tax as per law, and please show the breakup of price and tax separately on all the records, all the documents. Is there any format of any of the documents? No. There is no format of any of the documents that we have discussed. Contents are there, and that is not important for your exams. What is important to know is when you talk about all the documents, there will be serial number or the invoice number or the debit note credit number or the credit note number, which is a maximum of 16 characters. So your serial number of invoice or delivery challan or credit note or debit note etc. maximum is of 16 characters. It can contain alphabets, numbers, but only two special characters, which is dash, which is nothing but hyphen, and slash. Hyphen and slash. So maximum serial number can be of 16 characters containing alphabets, numbers, and only two special characters, hyphen and slash. And the last part of this chapter is all about document by the department. This entire chapter we have discussed document by the assessee. Now we are talking about document by the department. For every communication that department is having, department should mention document identification number in all their communication, including emails. Right, so department is said by CBSE that any communication that you have with the assessee, including mail communication, please have document identification number, which will make sure that recipient is aware of the genuineness of the document. So recipient need not be worried that it is a fake document or something someone is trying to play a fool out of that assessee, or someone is trying to manipulate something. Now, there is an exception given. What is that exception given? If at all there is a communication by the department, it is not having DIN, normally it is treated as invalid. But there is an exception. So normally if there is a communication by the department without DIN, it is invalid. That is an exception. What is the exception? There is technical difficulty in raising document identification. First exception is there's some technical problem. Second exception is the communication is to be given at short notice on an urgent situation, and the officer who has to raise DIN is outside office for his official duties. So in these two situations, whether there is some technical problem, portal issues is that DIN is not being generated, so there is a system issue, or this communications is to be given to the assessee on a very short notice or an urgent situation, and the officer who is giving communication is not in his office, is outside office for his official duties. Then you can give the communication to the assessee without DIN. But even in that exception, they are very clear. In the above two exceptions, one thing is very clear: DIN has to be generated within 15 days. So you have given a communication to the assessee without DIN. Now you have to give that DIN, and under these two scenarios, you have to give DIN within 15 days, and you have to get the approval of the senior officer, post facto approval of the senior officer. So in these two situations, you can give a communication to the assessee without DIN, but even in these two cases, make sure that within 15 days you generate DIN and take the approval of the senior officer. So that is everything about your document chapter. Okay friends, now let us quickly go through your e-waybill provisions, which is all about inspection during the movement of goods. Covered by your section 68, read along with rule 138 is the main rule. 138A, B, C, D, E are all other rules. Now, when you talk about your e-waybill, the portal which governs e-waybill is www.ewaybillgst.govin.in. So this is the portal from where e-waybills are being generated. So this portal only functions for e-waybill. Now understand that e-waybill is the supporting document. It is not the main document. It is a supporting document. Not section 68 is telling. It is telling that the person in charge basically means the person who is having control over the truck over when the goods are being transported, or either truck or railway or airplane, as the case may be. Now, if the consignment value in that particular conveyance exceeds a particular limit, understand that the wordings are consignment value. We'll be discussing what is consignment value. So where the consignment value of the goods which are going in that particular conveyance is exceeding a particular limit, person in charge shall carry the documents and devices as prescribed. Now what are the documents and devices that are prescribed? Understand that the document that they are telling is the base document and the supporting document. So when you talk about documents, let us see documents mentioned here. So the moment you are talking about documents and devices are given here in rule 138A. Document is basically the main document. The base document is either tax invoice or delivery challan or bill of supply. If there is supply, you are talking about tax invoice or bill of supply. If there is no supply, you are talking about delivery challan. This is the basic document. Primary document, tax invoice or bill of supply. If there is supply, if there is no supply, delivery challan. And the supporting document, which is from government portal, is e-waybill. Now understand that certain clarity about the base document and the supporting document. Certain other points. This is the base document and this is a supporting document. So you have to be very clear with what is base document, what is supporting document. Base document, as discussed, when there is supply, it is tax invoice or bill of supply. When there is no supply, it is delivery challan. Now certain clarifications. Now, if at all for those persons who are covered by e-invoicing provisions, they will not give a normal invoice, they will be giving invoice with IRN, QR code containing IRN. So they will be giving e-invoice. Normal person will give invoice, but the persons who are covered by e-invoicing, they have to have QR code which is embedding the invoice reference number. So that is a special point. Another special point, when the goods are imported, the base document is bill of entry. So that is the second special point. That is for the base document. When you talk about the supporting document, friends, as I said that the document, supporting document is e-waybill, which is through government portal. Please understand that when you talk about the supporting document, either you can write the e-waybill number on the main document, or there can be a physical copy of e-waybill. So normally e-way bill is a physical copy, or if you want, e-way bill can be mapped on a special device that is called as radio frequency identification device, which is embedded on the conveyance, which is fitted on that particular conveyance. So either have a physical copy of e-way bill or have the e-way bill number which is embedded on a particular special device, which is radio frequency identification device, which is fitted on the conveyance. And there's a note mentioned when we are going to see in the end of the chapter. There may be certain cases where e-way bill may be relaxed. So we are going to see the list of exemptions where e-way bill is relaxed. Now talking about the device. This is a device which we have discussed just now. e-way bill can be a physical copy of e-way bill, or it can be mapped on a special device called as radio frequency identification device. Now this device is not required to be fit by everyone. This device is required to be fit by only transporters who are notified by the commissioners. They should have a particular device called as radio frequency identification device, which is there on the conveyance. And before the movement of the vehicle starts, all the e-way bill should be mapped on the radio frequency identification device before the movement of the goods or before the movement of the conveyance starts. So this point, understand that this radio frequency identification device is not for all the transporters. It is only for notified transporters by the commission, which means big transporters. What they will do, they will have a special device on each of their conveyance, which is called as radio frequency identification device. And every time when the conveyance starts, each time when the conveyance is starting, there will be the goods, lot of goods inside the truck. So every time, whatever e-way bills are there for the goods inside the truck, they will be mapped on that particular device, so that the officer at the check post will have a device reader. He can easily find out what are the e-way bills for the goods carried by that conveyance. So that is the entire objective. Now talking about the other point mentioned in section 68, please understand that what is the power given to the proper officer with respect to section 68 read along with rule 138. This is trying to tell that proper officer has the power to intercept the conveyance and check the documents and devices that we have discussed now. He can check the documents and devices, whether documents are proper, whether it is a base document or the supporting document, and he can, if required, he can inspect the goods. If he is having not satisfied with the documents and devices, he can even open the goods and inspect the goods. More powers. Just not stopping at the normal part, going into the depth and finding out what goods are inside, what goods are mentioned on the document and what goods are actually inside the container. So that is also possible. Now talking about your basic provision of e-way bill, that is rule 138, what it is trying to tell. Understand that when you are talking about your e-way bill, it is all about consignor, consignee. The person who is starting the transportation or who is starting the movement of goods is a consignor, and the person who is getting the goods is a consignee. E-way bill is required for specified movement of goods. It is not for all the movement of goods, it is required for specified movement of goods. Now what is specified movement of goods? If the movement of goods is specified, then e-way bill is required. If the movement of goods is not specified, e-way bill is not required. Now, movement of goods that we have in your syllabus is only interstate movement. Interstate movement. We are not talking about intrastate movement, we are only talking about interstate movement. Why we are not talking about intrastate movement? For a very simple reason, that intrastate movement limit will be different for each state. So for your exams, they cannot talk about intrastate movement. They will focus only on interstate movement. It is not that e-way bill is not required for intrastate movement. It is required. Say for example, for interstate movement, the limit fixed for e-way bill is 50,000. Intrastate movement within the state of Maharashtra, or say within the state of Tamil Nadu, or say within the state of Delhi, the limit will be different. So for your exams, the limit is relevant only for interstate movement of goods. Now understand that for e-way bill, please make one thing very clear. We are focusing on movement. We are not focusing on supply. This point, please make it very, very, very clear. It's movement, it is not about supply. Now this can be explained clearly with the help of a point which is given below. We'll come back to specified movement of goods. Please understand that if at all that is a supply by domestic tariff area to special economic zone. So DTA to special economic zone in the same state. So when you are supplying to special economic zone, it is always interstate supply. IGST will be there. But the movement is intrastate. The movement is not interstate, but the movement is intrastate. So we are talking about, supposing I am there in domestic tariff area, I am supplying to special economic zone. It is an interstate supply. IGST will be taxed. But the movement is intrastate. It is intrastate. So you have to say the intrastate limit. Likewise, supposing from a particular state, so Maharashtra, I am going via Gujarat and coming back to Maharashtra. So I am starting from Mumbai, I go to Ahmedabad and come to Pune. So the supply is from Mumbai to Pune. Supply is from Mumbai to Pune, which is intrastate supply. So goods are going from Mumbai to Pune, which is within the state of Maharashtra, but it is touching state B. In transit, it is going via Gujarat. Now understand that supply is intrastate. Why? Supply is in Mumbai and recipient is in Pune, so both are in Maharashtra. It is CGST, SGST. But while the goods are going, the truck is going via Gujarat for some reasons. Now it is interstate movement. It is interstate movement. So that point you need to understand. E-way bill is all about movement. It has got nothing to do with supply. So we are taking two extreme examples where the supply may be interstate but movement is intrastate, or where the supply may be intrastate but the movement is interstate. Also understand that when there are three parties involved, which is called as bill to ship to. When there are three parties involved, which is called as bill to ship to, which means I am Mr. A, you are Mr. B, and the supply is to Mr. at the moment delivery is to Mr. C. So I am supplying to you, you are supplying to C. So A to B, B to C. But B, you are telling me that directly you hand over the goods to C. So what is happening? What is happening? It is like a triangle. So I am supplying to you, you are supplying to C. Now I am there in say Tamil Nadu, you are there in say Maharashtra, and C is there in say Delhi. So supply, there are two supplies. There are two supplies, A to B and B to C. There are two supplies, but movement is only one. Directly you ordered me to give the goods from A to C. This is called as bill to ship to. This is called as bill to ship to. Now understand that who has to generate e-way bill. Supposing I have sold you for 10 crore plus GST, and you have sold for 11 crore plus GST. So I have given you tax invoice for 10 crore plus GST. You have given tax invoice for 11 crore plus GST. Who is to require to generate e-way bill? Please understand that e-way bill is only for movement. So there are two supplies. There are two supplies. Supply 1, supply 2. But the movement is only one. So e-way bill is only required for movement. So there will be only one e-way bill. That is first option. What you can do? First option, e-way bill can be generated by Mr. A. Now when Mr. A is generating e-way bill, he will go for bill to ship to concept. Bill to Mr. B, Maharashtra, and ship to Mr. C, Delhi. Mr. A generating e-way bill, that is option 1. Now this option is very risky because in this option when Mr. A is generating e-way bill, that will show the value of 10 crore plus GST, which means C may know that what is the profit of B. So that is very, very, very risky. There is another option, option 2, where Mr. B can generate e-way bill. Right, when Mr. B is generating e-way bill, he will go for bill from dispatch from option. Bill from, it is Mr. B's place, its own place, bill from Maharashtra. Billing is happening from Maharashtra. That is Mr. B's billing. But dispatch is happening from, the goods are moving from Tamil Nadu. So there are two options. Option 1, either Mr. A will generate e-way bill to ship to. But the risky part is Mr. A is generating e-way bill. The profit element of Mr. B will be known to Mr. C. Therefore, option 2 is always a better option, where Mr. B can have confidentiality. He can hide both Mr. A and Mr. C from each other. So he can generate a bill from, he'll bill from Mr. Billing will happen from Maharashtra, Mr. B, but dispatch will happen from Tamil Nadu. So when you are giving dispatch from, you have to give only the address of Tamil Nadu. Even the same is true for ship to. When you are giving ship to, you have to only give the address. Right, so that is a very safe option, and obviously in the second case, This e-way-bill will be for value of this, because Mr. B is generating, it is for value of 11 crore plus GST. So confidentiality is maintained. For practical purposes, second option is a better option, but obviously you have two options. Again, the summary here is e-way-bill is for movement. You are only seeing the movement. Though there were two supplies, there was only one movement, only one e-way-bill. Either bill to ship to option by Mr. A or bill from dispatch from option by Mr. B. Now coming back to specified movement of goods, for your exams we have to discuss only interstate movement. This interstate movement, there may be supply, there may not be supply. If there is supply, the base document is tax invoice or bill of supply. Supporting document is e-way bill. If there is no supply, the base document is delivery challan. Supporting document is again e-way bill. Now movement can be by way of what? It can be by way of road, rail, air or water. It can be by way of anyone. Either by way of roadways or airways or waterways or railways. But when it is by way of roadways, it should be by motorized conveyance. Non-motorized conveyance, e-way bill is exempted. So conveyance should be motorized. So if the goods are going via bullock cart or by hand delivery, there is no e-way bill. Now generally, who is required to generate e-way bill? It is registered consignor who is required to generate e-way bill. So e-way bill normally is to be raised by the registered consignor, but if at all the consignor is unregistered and the consignee is registered and the consignee is known before the commencement of movement, then consignee will generate. There are three conditions: consignor unregistered, consignee registered, and consignee is known before the commencement of movement of goods start. Which means it is very clear that the goods are going to go to that particular consignee. In that scenario, registered consignee will generate e-way bill. Right, so that is the important point. Now for what value? Now understand that we are only discussing interstate movement. So interstate movement, the consignment value which should be there should be more than 50,000. Now what is consignment value? Consignment value is nothing but your transaction value as per section 15 plus GST. You are going to add GST. So when you are seeing consignment value, you have to see including GST. But consignment value will not include value of exempt goods. It will not include value of exempt goods. So if you are transporting two items, item A and item B, if you are transporting two items, item A and item B, item A is 45,000 plus your 5% GST, item B is for 15,000 and there is no GST. Consignment value will not include item B value because it is exempt. It will include 45,000 plus GST, which is 5%. So 2,750. In our example, this will come out as 47,750. So consignment value includes GST but excludes the value of exempt goods. So our consignment value will be 47,750. If it is interstate movement, e-way bill is not required because it is within the limit. Intrastate movement, you have to see state by state. Now coming back to exceptions here, please understand what is meant by exceptions. Exception means even if the consignment value is less than 50,000, e-way bill is mandatory. When the goods are sent by principal to a job worker outside the state, e-way bill is mandatory irrespective of value. When I am telling exception, it means that whether the value is more than 50, consignment value is more than 50,000 or up to 50,000, e-way bill is mandatory. So principal of Maharashtra sending the goods to job worker of Delhi, there is no supply, but Delhi challan will be there. E-way bill is mandatory, even if the value is less than or equal to 50,000 rupees. If at all the movement happens within the state, then you are going to see the limit. But for interstate movement by principal in one state to job worker outside the state, even if the value is less than or equal to 50,000, e-way bill is mandatory. Second exception, interstate movement of handicraft goods for a person who is unregistered who has taken the benefit of section 23. If you recall registration chapter, if at all you are dealing with notified handicraft goods, even though there is an interstate movement, but if your turnover limit, but if your aggregate turnover is up to 40 lakhs, 50 lakhs, 10 lakhs, as the case may be, you need not take registration. Now, what is happening here? There is interstate movement of notified handicraft goods by an unregistered person, which means you are getting relaxation from registration. There is no requirement of registration, but e-way bill will be there. This we have already discussed in your registration chapter. Though you are unregistered, but you are mandated for generating e-way bill, which means even an unregistered person can generate e-way bill. Here also it is mandatory e-way bill. Whether the value is more than 50,000 consignment value or up to 50,000, e-way bill is required when there is an interstate movement of handicraft goods and the movement is by unregistered person. Now this is all about specified movement of goods. Now coming back to when you have to generate e-way bill is very clear. Now what will be the content of e-way bill? So when you are filling up e-way bill form, which is e-way bill 01, there's part A. When you fill up part A, you will get e-way bill unique number, and part B, which will finally generate your e-way bill number. So part A is unique number, part B is your e-way bill number. Part A will contain the details of the base document. Part B will contain the details of the vehicle in which the goods are being transported. So part A will contain the details of the base document, which means it will contain the details, whatever details are there in your tax invoice or bill of supply or bill of entry or delivery challenge will be there in part A. Copy paste replication. Part A. Normally, if at all you are using software, the moment you generate your invoice or your delivery challan or your bill of supply, automatically part A will be filled. Part B will contain your vehicle details. So it will have the details of vehicle number. So when the movement is by road, it will have the details of vehicle number. When the movement is by your rail, air or your ship, then you'll have transport documents. So if the movement is by road, that is only vehicle number. But if the movement is by railways or airways or waterways, then you'll have the transport document. Right. So you're talking about document of title to goods, railway receipt or airway bill or bill of lading. Now, who is required to furnish part A and who is required to furnish part B? Understand that when you talk about part A, who is required to furnish part A? It is the register, the consignor or consignee, the person who is causing the movement of goods. Even part B is required to be filled by person who is causing the movement of goods. Normally it is the consignor. In case the three conditions are satisfied, consignor is unregistered, consignee is registered, and consignee is known before the commencement of movement of goods starts, then it is the consignee. So normal situation is the person who is causing the movement of goods, which we have discussed. But please understand that when you talk about part A, normally it is the person who is causing the movement of goods who will fill up part A as well as part B. But part A, the person who is causing the movement of goods can authorize either a transporter or a courier agency or EGO through whom the supply is made. So there can be authorization given by the person who is causing the movement of goods to transporter, or when the goods are supplied through courier agency or electronic commerce operator like your Flipkart, Amazon, etc. You don't know through which vehicle the goods are going to go. So you can authorize courier agency or electronic commerce operator through whom the supply is being made. So this is specific authorization. Transporter or courier agency or electronic commerce operator through whom the goods are being supplied. Now part B. Please understand that part B, automatically when you are authorizing these three persons for part A, they are automatically coming for part B. But normally part A is only filled by the person who is causing the movement of goods. So normally part A authorization is rare. It is maybe there, but it is very rare. It is generally filled up by the registered person causing the movement of goods. But part B, there is an automatic authorization. What is this automatic authorization? Transporter can fill up part B. Here you are talking about automatic authorization, can fill up part B condition if the movement is by road first, plus if the details of such transporter are given by the person who is causing the movement of goods while furnishing part A. So this is automatic authorization. This is automatic authorization, which means if I am filling up part A and if the movement is by road and if I have given the transporter details while filling up part A. So when I am filling up part A, I tell that BR Logistics is the transporter. Automatically the portal will, the details will go to BR Logistics and he can automatically fill up part B. So this is called as automatic authorization. This is automatic authorization, automatic. But the conditions are the movement should be by road and while filling up part A, the registered person has given the details of the transporter. Why is it so? Because the registered person will not have the vehicle details through which the goods are going to go. That being the case, it is automatic authorization. So if you see part 8, normally it is fully filled by the registered person who is causing the movement of goods. Rarely there will be a special authorization to the transporter or courier agency or electronic commerce operator through whom the supply is made. Now part B, there is an automatic authorization if the movement is by road and the registered person while filling up part A tells that he is the transporter who is going to transport the goods and I don't know the vehicle number. Automatically transporter will fill the vehicle details while filling up part B, automatic authorization. Now coming back to the next question, when should e-way bill be generated? We have discussed when e-way bill is required, what is part A, what is part B, who will fill up part A, who will fill up part B. Now we are discussing when should it be generated. Understand that e-way bill should be generated before the commencement of movement. If at all before the commencement of movement e-way bill is not filled, then the movement itself is invalid. So normally e-way bill should be filled up before the commencement of the movement of goods starts. Now there is a point where they are giving exception. What is this exception? They are telling that movement will be valid with part A, which means you have to fill up part A before the goods are being moving starting. Part B is not required in following two cases. The first is a scenario where you are talking about road. In the first scenario, the discussion is only about road. In the second scenario, the discussion is all about your rail, air and waterways. The first scenario, they are telling that if at all the movement is by way of road, and the movement is between the consignor and the transporter. So from consignor to transporter in the same state and the distance is up to 50 kilometers. So the movement is by road between consignor and transporter within the same state and up to 50 kilometers. Please understand that it does not mean that e-way bill is relaxed. It is only telling that before the movement of goods starts, normally they tell that fill up part A, part B. But now they are telling that fill up part A before the movement of the goods starts. Part B will be filled later on. Many of them confuse this with relaxation or exemption of e-way bill. No. This 50 kilometers no relaxation for e-way bill, no exemption for e-way bill. Rather, this 50 kilometers is a point which is talking about very specifically about certain conditions. And it is telling that part A you fill it before the movement starts. Part B you may fill later on. Right, and that too the conditions are movement is by road between consignor and transporter, nothing else. If the movement is between the consignor consignee and the distance is only 200 meters, forget about kilometers, 200 meters, e-way bill is mandatory, both part A and part B is mandatory. So there are conditions by road between consignor and transporter, because consignor is not knowing which vehicle transporter will use. Consignor will send his goods in his own vehicle and then transporter will change the vehicle. So they are telling that consignor, you don't give your vehicle details, otherwise validity will start. Let the transporter fill the details, vehicle details, his vehicle details directly in part B. So it is by road, consignor, transporter, same state, 50 kilometers. Part B, you don't fill it now, don't give your vehicle details. Part B can be filled later, but fill up part A. So part B, when the transporter is taking the goods in the vehicle decided by him, he will fill up part B. Now second exception, as I said, it is for railways, waterways and airways. For railways, waterways and airways, you can fill the part B later on, but for railways they have said very clearly, generally when they will fill up part B, on receiving the documents, that is railway receipt, airway bill and bill of lading, you will fill up part B and generate e-way bill. They are telling that you will not have the details of railway receipt, airway bill or bill of lading, therefore you cannot fill up part B. Before the movement starts, fill up part A. Later on you can fill up part B when you get the railway receipt, airway bill and or bill of lading, as the case may be. And they are putting a caution for railways that railways will not deliver the goods without e-way bill. So when the movement starts, it is only part A, but when delivery will happen, specifically railway department, they will give delivery, making sure that e-way bill is finally generated. So before the consignee takes the delivery of goods, you should have entered the railway receipt details and e-way bill should have been generated. Please understand that for railways, airways, waterways, one point is common. Before the movement starts, fill up part A. Part B can be filled later when you get the railway receipt, airway bill or bill of lading. Now the second point is only for railways. Railways, there is a special point telling that railway department will hand over the goods to you, but e-way bill should have been generated. So when you are filling up part B later, they are giving you a deadline. Before the consignee is asking for delivery, part B should have been filled up, e-way bill should have been generated. So that is the point which is mentioned here. Now coming back to one very important area, what is the validity of e-way bill? Now understand that validity of e-way bill is split into two parts. One part you are talking about over-dimensional cargo, which means the cargo cannot be, this particular over-dimensional cargo cannot travel on the roads of the city. They will be generally on highways, multi-dimensional cargo. It will be like a railway, a big truck in form of railways. So big truck cannot be traveling in your city limits. So over-dimensional cargo or multimodal shipment, which means the goods are transported by multiple modes. At least one mode is shipped. The common point is this over-dimensional cargo or multimodal shipment where at least one mode. Supposing multimodal shipment will also cover road and rail. It is not covered here. Road, vessel is there, which means it is covered here. At least one mode is by way of ship, then you get extra validity. The validity is more because the movement will be slow. And not other cases. Other cases means you are talking about either it is only and only by road, it is not an over-dimensional cargo, plus there may be multimodal shipment, but it is road plus rail or road plus air. So that is all covered in normal scenario. So two scenarios, validity is more. Over-dimensional cargo, the cargo is such that it is having multiple dimensions, not a normal truck, a lengthy truck which you see on highways, and multimodal shipment where at least one mode is vessel. In that scenario, they are telling that for every 20 kilometers, 1 day, every 20 kilometers of part thereof, 1 day. And if at all it is a normal case, for every 200 kilometers or part thereof, 1 day. Every 200 kilometers or part thereof, 1 day. So if at all I tell that you are talking about 320 kilometers and 390 kilometers, 310 kilometers, 390 kilometers. If it is over-dimensional cargo or multimodal shipment where at least one leg is by vessel and other cases. So if I talk about over-dimensional cargo or multimodal shipment where at least one leg is by vessel, 310 kilometers, you will have 16 days. 390 kilometers, you will have 20 days. Other cases, 310 kilometers, you will have only 2 days. Even if it is 390 kilometers, you will have only 2 days. And from when this will start? From when this time limit will start? Understand that first day will always be more than 24 hours. Other days are all 24 hours. So, if I generate e-way bill on midnight, say supposing e-way bill is generated on 13th March and one is e-way bill generated on 14th March. 13th March 11:58 PM, 14th March 12:02 AM, and assume that the validity is say 3 days. Assume whatever. This is second example. Assume that validity is 3 days. Now in this scenario, 1 day will end on. 1 day will always. First day will always be more than 24 hours. So first day will end on this 13th, 14th midnight is going on. So first day will not end on 14th, 15th midnight. First day will end on 14th, 15th midnight March, because 2 minutes is extra. Second day will end on 15th, 16th March midnight, 12 midnight. Third day 16th, 17th midnight. First day will have 24 hours 2 minutes. So it will end on 16th, 17th March. But here first day will end on 15th, 16th March. First day will be more than 24 hours. Second day 16th, 17th March, and third day 17th, 18th March. Why? First day here it will be 24 hours and rather not 24 hours, rather it will be 47 hours 58 minutes. First day now will not end on 14th, 15th March because it has started. 14th early morning only it started. So first day will end on 15th, 16th midnight. So first day will be more than 24 hours. Second and third day will always be a second, third, fourth, fifth, sixth and all 24 hours. So you here always will understand that first day will always be more than 24 hours. So difference was only 4 minutes, but the validity is changed up to your 1 day. So that you need to remember. Now, can this validity be extended? Yes, this validity can be extended by commissioner for notified goods. Also, transporter can extend the validity himself in exceptional situations. Supposing there is an accident or breakdown of vehicle, or there is a strike, or there is a lockdown. So, within 8 hours of the expiry of validity, in exceptional circumstances, transporter can apply for extension, but within 8 hours. So, that is extension of validity. Now, when you talk about other small aspects of your e-way bill, when you talk about first part A is filling up of base document details. Part A validity is 15 days, which means within 15 days you have to fill up part B. Within 15 days you have to convert unique number into e-way bill number. Understand that validity will be counted only from part B filling up. Validity will not be counted from part A, it will be counted only from part B. Validity will be counted only from part B, only when you fill up part B. Now, understand that when you talk about part A, it is unique number. You will give the base document details. Part B will contain the vehicle details. Right. So, now understand that you are talking about communication between different portals. Communication between different portals. If e-invoicing is applicable, when I tell rule 48.4, e-invoicing is applicable, e-invoice portal will communicate to your e-way bill portal, and that will automatically go to your normal portal as well, which means whatever you have given in e-invoice portal, that is INV01, will go and sit in your part A of e-way bill 01, also go and sit in your GSTR1. So your e-invoice portal is communicating to e-way bill portal as well as your normal portal. If e-invoice is not applicable, obviously, then INV01 is not filled up. Whatever details you give in part A of EW01, now you will be giving the details in part A of EWB01, that will automatically go to your normal portal GSTR1. So now there are only two portals, e-way bill portal talking to normal GST portal. So that is all about auto communication between different portals. Now, can part B be uploaded multiple times? Can you update part B? Yes. Every time whenever you are talking about your conveyance number changes, vehicle number changes, you can update part B. So once the goods are transferred from one conveyance to another conveyance, you can update part B. You have to update. You don't have an option. You have to update part B. So supposing the movement is between Mumbai to Delhi, and in say Ahmedabad there is a change of conveyance, you have to update part B. You have to update part B. So you have to understand that part B will be updated every time when the conveyance changes. Now there is one relaxation or exception. Part B need not be updated for the last journey. What is the last journey? The same type of conditions that we have seen. If the movement is by road, now ulta, it is from transporter to consignee for the last delivery. Transporter to consignee, same state and 50 kilometers. So here it is ulta. You need not update, which means when the goods have reached the destination Delhi, now the consignee will go to the transporter's place and take the vehicles in his goods. Then the last leg of the journey, where it is from transporter to consignee within the same state and it is up to 50 kilometers, e-way bill is already generated. Now you need not update part B. So friends, when the movement is from say Mumbai to Delhi, if the conveyance is changing in Ahmedabad, obviously you have to update part B, because again from Ahmedabad it is going to go to Delhi. But when the conveyance goods have reached Delhi at the transporter place and consignee is going in his vehicle and getting the goods, so you are talking about transport to consignee's movement within the same state up to 50 kilometers, you need not update part B. Now here there is no relaxation in not filling up part B, because part B is already filled up, e-way bill is already generated. You need not update part B. So if it was ulta scenario, starting of movement, end of movement, starting of movement consignor to transporter, same state 50 kilometers, part A you fill, part B may be filled later on. Now end of journey, transport to consignee, same state 50 kilometers, already part B is filled, e-way bill is generated, you need not update part B. There was You may fill part B later on for the first scenario. Now you need not update part B. So that is the difference in both the cases. Now the other small aspects. Can e-way bill be cancelled? Yes. If at all e-way bill is wrongly generated, then e-way bill can be cancelled within 24 hours of generation or verification in transit, whichever is earlier. So if at all you have given wrong details in e-way bill or there is a wrong generation of e-way bill, whatever reason, then you can cancel it. The moment it is incorrect, you can cancel it. Condition is it should be done within 24 hours of generation of e-way bill or verification in transit, whichever is earlier. This is from the angle of the person who is generating e-way bill. Can the opposite party reject the e-way bill? Can the party who has generated e-way bill cancel it? Yes. Can the opposite party reject the acceptance? Yes. The opposite party can accept or reject the e-way bill on portal, but for them also there is a time limit, 72 hours or actual delivery of goods, whichever is earlier, you have to reject it. Now, supposing I am generating e-way bill, from my angle, it is all about cancellation, 24 hours or verification in transit, whichever is earlier, I can cancel it. Supposing you are the opposite party, you are not generating e-way bill, so it is not about cancellation, it is either about acceptance or rejection. Now, you can reject it within 72 hours or actual delivery of goods by you, whichever is earlier. Otherwise, if you don't take any action, it is deemed to be accepted. So that is the point. Can e-way bill be assigned to some other transporter? Yes, assignment is also possible. See, one was updation, now second thing is assignment, which is more than updation. Can BRL Logistics hand over the goods to Navkar Transport? Yes. Assignment is also possible, for which updation will be done. Either it is by a registered person to transporter or one transporter to another transporter. Right, so there is nothing but updation of part B. But what is happening is with the only vehicle changes but the transporter is the same, it is normal updation. If the vehicle changes, transporter also changes, it is assignment. Once you assign it, it cannot be further assigned to any other transporter. So that is important point that you have to note. Now, the last scenario you are talking about, consolidated e-way bill, which is optional. This is only for a transporter. Please keep in mind this consolidated e-way bill is optional and it is only from the angle of transporter. So, once all the goods are uploaded up in a conveyance and e-way bills are generated in that single conveyance, if the transporter wants, supposing there are 10 consignments in a particular truck and there are 10 e-way bills for each of the 10 consignments. If transporter wants, he can consolidate all the e-way bills for all the consignments before the commencement of movement starts, and he can do it. Normally, no transporter will do it. It is a headache. Already, there are 10 consignments in the truck for which already e-way bills are there. If he wants, he can consolidate all 10 e-way bills into one e-way bill. That can be done only by transporter. Why transporter will go for it? First of all, it is optional. Why transporter will go for it? To make sure that if at all there is an updation in part B, supposing the vehicle changes in between, it will be easy for him. Rather than changing the vehicle number in all the 10 e-way bills, it will be easy for him to update in one consolidated e-way bill. So this facility is optional. This consolidated e-way bill, which is EWB02, is only for transporter and it is optional. All the e-way bills inside the truck can be made into one e-way bill, which will help the transporter while updating part B. So normally no one would actually go for it, but there is a facility given for the transporter. Now friends, we are talking about the list of cases where e-way bill is being exempted. E-way bill is exempted. You don't require e-way bill. The list of cases where you don't require e-way bill. So we are talking about LPG gas cylinders. If you see the first scenario, you are talking about household LPG cylinder and non-domestic exempted category. Either household LPG or non-domestic, but it is exempted category. So normally if it is non-domestic, non-exempted category, you require e-way bill. So LPG, household, no need of e-way bill. Non-domestic, exempted category, no need of e-way bill. Non-domestic, other category, you require e-way bill. Second, you are talking about empty cylinders for packing LPG. Now you are not talking about LPG gas, you are talking about packing that empty cylinders. Right, let me make it one thing very clear. So if a particular person is bringing LPG gas along with the cylinder to you, for that gas cylinder and the gas inside it, e-way bill is not required because it is household. When he is taking the empty cylinder back, e-way bill is not required. Supposing if the same cylinder is for hotel, When he is taking the gas cylinder with gas in it, e-way is required. But when he is taking an empty cylinder, e-way is not required. So one gas cylinder is coming to your house, one it is going to your hotel. So when it is coming to your house, when the gas and the cylinder comes, no e-way. When the empty cylinder goes, no e-way. When it is going to hotel, gas and the cylinder, e-way is required. But when empty cylinder is taken, no e-way. Next, kerosene sold in public distribution system, that is ration shop. If kerosene is sold in normal shops, e-way is required. Used and personal household effects. So if you are shifting your home and you are transferring your used and personal household effects from first house to second house, e-way is not required. But if you are shifting your office and all the old goods from old office to new office are transported, e-way is actually required. Currency. For money, e-way is not required. You are talking about precious stones and metals, jewelry sector, e-way is not required. Even gold and silver silkwares, it is not required. And one more special item, worked and unworked coral, e-way is not required. So special goods, let it be currency or jewelry sector, goldsmith, silver silkwares or coral, whether worked or unworked, e-way is not required. Non-GST goods and Schedule 3 goods, which means for alcoholic liquor for human consumption, no e-way. For your petroleum, 5 notified petroleum products, no e-way. Schedule 3 listed items, 8 cases, no e-way. Exempted items other than de-oiled cake, no e-way. Postal baggage, which is Department of Post, postal baggage, no e-way. Empty cargo containers inside a vehicle. Supposing you are transporting fish or vegetables in a vehicle, so there will be a refrigerator or special container. So when the vehicle is going along with the refrigerator and the vegetables, e-way is required. When the vehicle is coming back with the empty cargo container, so vehicle will still contain empty cargo container. For that empty cargo container, e-way is not required. So this was all about your goods based exemption. Now when you are talking about person based exemption, only government is covered, but two special points are covered. When you are talking about Ministry of Defence, whether Ministry of Defence is acting as consignor or consignee, whether the movement is by way of road, rail, air or vessel, e-way is not required. Confidentiality, secrecy is required when you talk about Ministry of Defence. When you talk about other department of government should be acting as consignor and it should be in rail, then e-way is not required. See, when you talk about taking the goods to Ministry of Defence or bringing the goods from Ministry of Defence by road or by rail or by air or by vessel, no e-way. But when you are talking about other department of government, if they are acting as consignor, if they are sending the goods by rail, e-way is not required. If they are receiving the goods, e-way is required. If they are sending the goods by road, air or vessel, e-way is required. So that is the difference that you need to understand. Area based exemption. When you talk about area based exemption, if the goods are under customs control, both the origin and destination both are under customs control, e-way is not required. So if the goods are going from customs port to inland container depot, both are under customs control, e-way is not required. If the goods are going from customs station to special warehouse, both are under customs control, e-way is not required. But if the goods are going from customs station to importer's place is not under customs control, e-way is required. The goods are going from customs station to public warehouse or private warehouse, public warehouse, private warehouse are not under customs control, e-way is required. Transit cargo from what to Nepal, Bhutan. Assuming that the goods are coming from Nepal, Bhutan or going to Nepal, Bhutan from some other country. So if the goods are coming from Myanmar to Nepal, Bhutan or from Nepal, Bhutan to Myanmar and it is only going via India, touching India and going back, e-way is not required. And notified areas by government. So in a state there may be area where net connection is not there. In that area, e-way may not be required. Not relevant for exams. Miscellaneous exemption. If at all, the movement is between consignor's place and Weighment Bridge. Understand that this relaxation is very specific. The movement is between consignor and Weighment Bridge and the distance is up to 20 kilometers. And obviously that movement will be on Delhi rich land because there is no supply, then e-way is not required. Now friends, this 20 kilometers is exemption from e-way. We have seen 50 kilometers, that was not exemption from e-way, that was relaxation from part B. Now this 20 kilometers is exemption from e-way. But understand that this 20 kilometers is not exemption for everyone. The movement should be from consignor place to Weighman Bridge or from Weighman Bridge to consignor, only between them, and the distance should be up to 20 kilometers. And finally, we have already discussed this point. If the goods are going in non-motorized conveyance like your bullock carts or tricycle or by hand delivery, e-waybill is not required. So goods-based exemption, person-based exemption, then we have seen area-based exemption, then other miscellaneous exemption for e-way bill. Now you are talking about your other points where e-way bill is where the vehicle will be intercepted and where you will be having some problems. Now understand that what rights officer has got to do when you are talking about interception. Now first point, when you are talking about interception and verification of e-way bill, any authorized officer, that is authorized by commissioner or authorized by an officer empowered by commissioner, who can stop and check the e-way bill, who can check the documents. It should be either an authorized proper officer. Who's authorized proper officer? Authorized by commissioner or authorized by an empowered officer by commissioner, he can stop do that. Who can physically verify the conveyance? That is the next step. See, first step is only checking the documents. Second step is checking the conveyance and the goods. Generally, it is done by authorized proper officer, that we have discussed, authorized by commissioner or authorized by empowered officer by commissioner. But if it is specific tax evasion case, which means a particular officer who is not an authorized officer, who is not a squad officer, he is having special information about tax evasion, he can get approval from the commissioner or empowered officer and do that. So normally there are squad officers who will do the verification of conveyance and the goods. But there is a special tax evasion case, we have a special tip. So you are not a squad officer, you can take the approval of commissioner or empowered officer and you can do and check the conveyance and the goods. Now please understand this point, this is a very basic thumb rule. Once physical verification is done, further physical verification will not be done in that state or any other state. So once physical verification is done in say Maharashtra and the goods are going from Maharashtra to Delhi, for the second time physical verification of conveyance will not be done except where there is a special tax evasion information available. So what they are trying to tell, once your physical verification is done in say Maharashtra, then again second time physical verification cannot be done in Maharashtra, cannot be done in any other state, exception that second officer having a very special tip that there's a special tax evasion case which is there. Now there is some reporting to be done by proper officer, because once they are, see, one is a basic check, document check, second is a special check, opening the conveyance, checking the conveyance and the goods. So once the conveyance is checked and goods are checked, officer is required to report it. Officer has to report two things. One is a summary report which is to be given within 24 hours of inspection, and one is a final report which is to be given within 3 days plus 3 days extension by the commissioner. So whenever there is a physical verification of conveyance and the goods, then officer is required, officer has to do something more. He has to give the report, summary report within 24 hours and final report within 3 days plus 3 days extension given by the commissioner. And officer may misuse his powers when this e-way bill provisions are seen into. So they have said that person in charge, if your vehicle is stopped or detained for more than 30 minutes without giving any proper reasons, you can report it on portal in EWB 04. Obviously this is not generally used, but yes, the person in charge, the transporter has a power. If his conveyance is detained for more than 30 minutes, reason is also not mentioned, it is harassment, then what he can do, it is detained for more than 30 minutes without any proper reasons, he can report it on portal in EWB 04. So that is given in your rule 138B, which is all about your inspection of document and conveyance goods. 138C, reporting by proper officer. 138D, reporting by person in charge. Now friends, let us discuss about the consequences of not carrying the required documents or not having the proper devices. What will happen if the goods are being transported without proper documents or devices? It may be a scenario where tax invoice itself is not there, or tax invoice is there but e-way bill is not there, or e-way bill is improper. So section 129 penalty will come into picture. Initially what will happen is goods will be detained or seized and they shall be released on payment of penalty or giving surety or security equal to penalty. So goods will be detained, kept with them, and if you pay the penalty or give surety equivalent to give security, not surety, give security equivalent to penalty, then the goods will be released. So either if you want the goods, pay the penalty or give a security equivalent to penalty. Now how penalty is given in this situation, you need to understand. They have given it separately for taxable goods and they have given it separately for your exempt goods. For taxable goods as well as exempt goods, the categorization is multiple. If owner is coming forward, then owner will pay a particular penalty. If owner is not coming forward, then transporter will be treated as deemed owner and he has to pay the penalty. Now let us first understand about taxable goods. If owner is coming forward, he has to pay a penalty. There is no tax now. He has to pay a penalty of 200% of tax payable. Understand that there is only penalty payment. So penalty is equal to 200% of tax payment. If owner is not coming forward, then penalty is 200% of tax payable on the goods or 50% of the value of goods, whichever is higher. 50% of value of goods, whichever is higher. Please understand that if it is CGST, SGST case, directly calculate penalty. If owner is coming forward, if CGST tax is 1 lakh, SGST tax is 1 lakh, then CGST penalty is 2 lakhs, SGST penalty is 2 lakh because 200% of tax payable. And the IGST penalty, always have the habit of calculating CGST penalty, SGST penalty and adding that. Don't calculate IGST penalty directly, because if owner is not coming forward, let us take the same numbers. If CGST penalty is, if the CGST tax is 1 lakh, SGST tax is 1 lakh, then the penalty is CGST 2 lakhs or 50% of the value of goods, whichever is higher. SGST 2 lakhs or 50% of the value of the goods, whichever is higher. IGST, you have to have the habit of adding CGST penalty, SGST penalty. Do not calculate IGST penalty directly. Assume that what if it was a CGST, SGST transaction, calculate the penalty, then IGST penalty, you just add that. Remember, if owner is coming forward, it is 200% of tax. That is the penalty. If owner is not coming forward, penalty is equal to 200% of tax or 50% of the value of the goods, whichever is higher. This is given for CGST and SGST. For IGST, calculate CGST, SGST, thinking that it is intrastate transaction and then add both. Now for exempt goods, there will not be any tax. For exempt goods, the penalty, if owner is coming forward, it is 2% of the value of goods or 25,000 rupees. This is CGST penalty. SGST is copy paste, 2% of the value of the goods or 25,000, whichever is lower, not higher. IGST always have the habit of adding up CGST penalty, SGST penalty. So penalty is equal to 2% of the value of the goods or 25,000. CGST penalty, SGST penalty copy paste, IGST penalty add both. If it is IGST case. If owner is not coming forward, then penalty is lower off. Again, it is not higher off. 5% of the value of goods or 25,000, whichever is lower. Understand that here the wordings are lower, not higher, which is very, very important. Many people will go with higher. Here it is, which is lower. 2% of the value of the goods or 25,000, whichever is lower. When owner come forwards, this is for CGST penalty, copy paste SGST penalty. If it is IGST, add both. 5% of the value of the goods or 25,000, whichever is lower. Beg your pardon, it's not which is higher, which is lower is CGST penalty. When the owner is not coming forward, copy paste SGST penalty, IGST penalty, add both. Now what is the procedure? First there will be notice and order being given. Proper officer will give notice within 7 days of seizure of goods and conveyance specifying the penalty, and after our notice is given in 7 days, order should be given. So after seizure is done, within 7 days you have to give notice, and after giving the notice within 7 days you have to give the order. Now if the person is paying the penalty or giving a security equal to penalty, within 15 days from the date of order, all the proceedings will be concluded and conveyance also will be released. Goods and conveyance both will be released. If the penalty is not paid within 15 days from the date of receipt of order, then the goods and conveyances will be sold to recover the penalty. They will be sold to recover the penalty. Understand that this 15 days will be reduced for perishable goods, hazardous goods or goods likely to depreciate with time. Right. But if you don't, if at all the person whose owner of goods is not paying the penalty within time, but if the transporter wants to get his conveyance can be released on payment of penalty or 1 lakh, whichever is lower. So if the goods are seized or detained, but the transporter wants his conveyance, he is nowhere involved. He is telling that okay, I at least release my conveyance, that is possible. He has to pay the lower of penalty or 1 lakh, whichever is lower, and take the conveyance. So goods may be still be there, but conveyance will be released. Now, if at all you are not paying the penalty within 15 days, what is the sequence of usage of sale proceeds? Because then your goods and conveyance will be sold. First, that sale proceeds will be adjusted against the admin cost of recovery. There will be some administrative expenses for recovery that will be first taken back. Then it will be adjusted for penalty, which is the main penalty that is being discussed here. Then it will be adjusted for other dues under the CGST Act. Balance will go to the cash ledger or bank account of the, if you are registered, it will go to cash ledger. If you are not registered, it will go to the bank account. If you are not able to, if you cannot be located, if the person who has made the payment cannot be located, then it will go to consumer welfare fund. So it is against administrative expenses, then against penalty, then against other dues under the GST law. And if there is any balance thereafter, if you are registered to a cash ledger, if you are unregistered to a bank account, if you are not able to, if the department cannot locate you, then it is consumer welfare fund. Now there are certain clarifications which are given here, which is very important. The first clarification is all about silly mistake. It is all about related to your section 129 penalty. Section 129 penalty, which is a draconian penalty, cannot be levied for minor mistakes. For petty mistakes, the maximum penalty that can be there for CGST is 500, SGST can be for 500. Now, what are the examples of minor mistakes? There is spelling mistake in the consignee name, or a pin code error, but that is not changing the validity of EV bill. So, spelling mistake in the name of the consignee, pin code mistake, 641002 is written as 641001, but validity remains the same. Consignee address, there is small mistake in consignee address, other exact location and other details being correct. So instead of say 142 or 143 so and so street, it is written as 141 so and so street. It doesn't change anything else. There is a HSN error, but the first 2 digits of HSN are correct and the rate is correct. So HSN code can be 4 digits, 6 digits or 8 digits at times. So first 2 digits you are perfectly right and the rate is correct. The other 3rd, 4th digit or 5th, 6th digits is incorrect. That can be ignored. Error in 1 or 2 digits of the vehicle. Supposing the vehicle number is MH07 1413. Instead of MH07 1413, it is written as 1433. So 1 or 2 digits of vehicle number mistake, no problem. Error in 1 or 2 digits of the document number. The invoice number of yours is REL-001011. Instead of that, REL-001111. Instead of 1011, you have written as 10. Instead of 1011, you have written as 001111. 1 or 2 digits of the document number. These are all silly mistakes. For this, the officer cannot invoke draconian 129 provisions for all these silly mistakes. 6 examples of the silly mistakes are given. Maximum CGST penalty 500, SGST penalty 500. Now certain other aspects. Can you generate or cancel your EV bill by SMS? Yes, possible. Second, EV bill generated in one state is valid throughout India. EV bill is required for goods inside the coaches of the railways, but not required for the coaches. Supposing I am taking a coach on lease. That leasing of coach by me from railways is EV bill is not required because that coach will be moving again and again with the railway. But for the goods inside the coach, for which I am appointed to collect the transportation charges, the EV bill will be required. So that is another clarification. Now, the last part of this EV bill where you are talking about Rule 138E, where they are telling that your EV bill will be blocked. You cannot touch your Part A. Right? No person, whether you are talking about consignee, transporter or e-commerce operator or courier agency, is allowed to furnish Part A. When you cannot fill Part A of EV bill, you cannot obviously fill Part B. Right? For the outward movement of the goods. Now what are they trying to tell? If at all you are a composition taxable person and if you have not filed your CMP 08, quarterly CMP 08 for 2 consecutive quarters, If at all you are other than composition taxable person and you have not furnished your GSTR1 for 2 consecutive months or quarters. GSTR1 can be on monthly basis or quarterly basis, either 2 consecutive months or 2 consecutive quarters. If you are other than composition taxable person, if you have not furnished your normal returns for 2 consecutive periods, supposing you just can classify this into 2. If you are a composition taxable person, if you are a regular taxable person, or you are a casual taxable person, if you are NRTP, or if you are talking about your other categories. Generally these will be the categories which are required to file their returns. OIDRS is also a category, but that is only dealing with services, so we will not cover this. If you are a composition taxable person, you are not filing your CMP08 for 2 quarters. If you are a regular taxable person, if you are NRTP, you are not filing your GSTR5 for 2 months. If you are a regular taxable person, you are not either filing your GSTR1 or you are not filing your GSTR3B, either or, for 2 months or quarters as the case may be. Right. So, if you are a composition taxable person, you have not filed a CMP08 for 2 quarters. NRTP not filed GSTR5 for 2 months. RTP or CTP not filed GSTR1 for 2 months or 2 quarters, or see, it is either or not filed GSTR3B for 2 months or 2 quarters. Then you cannot generate your EV bill. This is the first category. Second category, you are talking about your registration is suspended. Suspension of registration. Suspension of registration. If your registration is suspended, you cannot generate your EV bill. Now, what is happening? What is this point trying to tell? This point is focusing only on the outward movement, which means if the consignor is A and consignee is B, if defaulter is A and person who has to generate EV bill is A, if defaulter and the person who has generated EV bill is A, then you cannot generate EV bill. EV bill cannot be generated. A cannot generate EV bill. If consignor is A and consignee is B, the person whose defaulter is A and person who wants to generate EV bill is B. Now for B it is inward movement. For B it is inward movement. So can he generate EV bill? Yes, he can generate. B can generate EV bill. So EV bill generation now it's possible. This EV bill generation will be by B. Now if the consignor is A, consignee is B, defaulter is B. Defaulter is B and A is required to generate EV bill. Can A generate? Understand that if there is a mismatch between the defaulter and person who is required to generate EV bill, then for surely you can generate EV bill. Now in this case, Mr. A can generate EV bill. In the last scenario, if at all you are talking about consignor being A, consignee being B, defaulter is B and person wanting to generate EV bill is B, which means both defaulter is B and B wants to generate EV bill. Even then EV bill can be generated. Why? Because it is for inward movement. It is for inward supply, inward movement. It is not for outward movement. Inward movement generation of EV bill is allowed. So understand that when it is restricted, when the defaulter is A and person wanting to generate EV bill is A and it is for outward movement. So conditions are defaulter and the person who wants to generate EV bill should be the same. Second condition, it should be for outward movement. If both these conditions are satisfied, then you cannot generate EV bill. In other cases, generation of EV bill is possible. If we see the last case, it is some other case. Consignor is A, consignee is B, defaulter is A or B. A or B. Can transporter generate your EV bill? Can a transporter generate EV bill? Yes, he can do. Right. Understand that you have to be very, very clear. The defaulter and the person who wants to generate EV bill should be the same person. Condition number 1. Condition number 2. It should be for outward movement. So if the defaulter and the person who wants to generate EV bill are not the same, you can generate EV bill. If they are the same but it is for inward movement, again you can generate EV bill. So that is everything about your EV bill. Yes friends, when you are talking about your registration, you can categorize the registration chapter into 4 parts. 1. Basics of registration. 1. Taking registration. 1. Amending registration. And finally, cancelling registration. So whenever you are registered, you have to ensure that you are putting your name board. On your name board, you are putting your GST number in all places of business. In all places of business. So on your name board there should be GST number not only at your principal place of business but also at all other places of business. What is principal place of business? Any place of business that you have selected as principal place of business on your registration certificate. It can be any office. It cannot be head office. It can be any office. What is additional place of business? All the other place of business becomes your additional place of business which are also reflected on your registration certificate. And inside all these places of business, you have to display your registration certificate. Supposing you have 10 places of business. First, in all the 10 places of business, on the name board there should be GST number. And when you enter inside in a prominent place, there should be copy of registration number. Copy of registration number, GST IN. Right. Next. Definitions, whenever it is relevant, we'll be taking the definitions and completing that. Now we'll first touch the basics of your registration. Your GST number is PAN based. Without PAN, you cannot have GST number. Are there exceptions? Yes. Yes. When you talk about your TDS number or TCS number, it is not based on your PAN, it is based on your income tax TAN. Your GST, TDS, GST, TCS number is not based on your income tax PAN, it is based on your income tax TAN, tax deduction account number. Second, when you talk about your NRTP, non-resident taxable person, who is not having any place of business or residence throughout India, who is not having any place of business or even residence throughout India, who is coming to India for permanent purposes or temporary purposes. Occasionally, he is coming to India for occasionally having supply of goods or supply of services. Occasionally. Now, he will not have any place of business in or residence in India. Obviously, he will not have even PAN. So, his registration number is not based on his PAN. It is based on PAN of authorized signatory. Another person, PAN of authorized signatory who should be an Indian resident and a valid PAN card holder. Who should be an Indian resident and a valid PAN card holder. So NRTP registration is not based on his PAN. It is based on PAN of another person, authorized signatory. UIN, unique identification number. For certain UINs, that is international bodies, you can get UIN without even PAN. And finally, you are talking about OIDR services from outside India, non-taxable territory, providing services to non-taxable online recipient. They will not have their GST number based on PAN. They don't have PAN. So they will get the GST number without PAN. These are the 4 cases where GST number is strictly not based on PAN. Next concept is when you talk about your GST number, it should be based or it should be linked with Aadhaar. But understand that it is not so strict like PAN. It should be linked with Aadhaar. There are certain notified persons where linking with Aadhaar is not at all mandatory. So when you talk about that notified person, basically they are government and UIN. Government is exempting itself and UIN. So when you see, if you want to see the list of notified persons, you will find that you are talking about non-citizens. If you are not a citizen of India, obviously you cannot have Aadhaar, so linking with Aadhaar is not there. Or if you are talking about department or establishment of central government, state government or local authority or a statutory body or a public sector undertaking. So this area, government is relaxing itself. Government is relaxing itself. Department or establishment of central government, state government, or a local authority, or a statutory body, or a public sector undertaking, the government is relaxing itself. No need of Aadhaar authentication, no need of Aadhaar linking. And obviously, when you talk about your unique identification number, again, Aadhaar authentication or linking is not required. See, if you see the first and the last category, first category is non-citizens. Again, you can have an example here. OIDRS, outside taxable territory. So when you talk about OIDRS, outside taxable territory, they will not have any Aadhaar. So Aadhaar linking for them is not required. Again, you find OIDRS outside taxable territory and UIN. For them, Aadhaar authentication is not required. Plus, government related bodies. Aadhaar authentication is not required. Aadhaar authentication is not required. For others, you do require Aadhaar authentication. Now, for others, when I tell you do require Aadhaar authentication, if you are an individual, Aadhaar authentication is of individual itself. If you are not an individual, if you are HF, Aadhaar authentication will be of Karta. If at all you're talking about partnership firm, Aadhaar authentication will be of partners. If you're talking about a company, Aadhaar authentication will be of managing director or whole-time directors. If you're talking about a association of persons or trust, Aadhaar authentication will be of members of managing committee of association of persons or board of trustees for a trust. Are you clear on this understanding? Plus. In addition to all of them, whether you are an individual or HF, etc., for what all other obligations required, we have discussed. In addition to it, if some other person is authorized signatory, if some other person, see, if individual himself is authorized signatory, it is already authenticated. If one of the partners is already authorized signatory, then it's not required. If some other person is authorized signatory, authorized representative or authorized signatory, for him, you should do Aadhaar authentication. Supposing for a company, general manager is authorized signatory. So managing director, whole-time director should do Aadhaar authentication plus that general manager should go for Aadhaar authentication. You're getting that point? But if you tell that no, the managing director himself is authorized representative or authorized signatory, then that is automatically done. So you need to understand that. But I was telling that Aadhaar authentication is not so strict. Why? Now you know that there are certain categories of persons for whom Aadhaar authentication is not at all required, and others for whom Aadhaar authentication is required, we have discussed. But for others, if you don't go for Aadhaar authentication also, need not worry, you will get the GST number, but after physical verification of premises. After mandatory physical verification of premises. My physical verification of premises is optional. But if you are not linking your Aadhaar, then before grant of registration, mandatory department will do physical verification of premises. This is different. Without PAN, you cannot have GST number. But without Aadhaar linking, you can still have GST number. What you have to do is physical verification of premises. Now, as we are talking about physical verification of premises, we'll try to cover even that concept of physical verification of premises. When you talk about physical verification of premises, if you don't go for Aadhaar application or if you are not opting, both are different. If you are not opting, right from the beginning you are very clear that I don't want Aadhaar linking. Or if you are trying but it is not successful, in both the cases, physical verification is mandatory before grant of registration. In other cases, physical verification may be there. First it is optional and it is generally after grant of registration. It is optional and generally it is done after grant of registration. And whenever physical verification is done, officer should make sure that he is giving the report along with photographs within 15 days. After physical verification, that report with photographs is uploaded on portal. So you have to be very clear with this concept of physical verification. Now there's another small concept of Aadhaar authentication that you have to be very clear of. Aadhaar authentication, that's one concept which is given for Aadhaar authentication, that if at all you are not doing Aadhaar authentication, then that is fine, but they will ask for Aadhaar authentication later on. I'll just complete it. It is given elsewhere. Normally, if I'm not doing Aadhaar authentication, that is fine. I'll be getting GST number after physical verification of premises. But even after I get GST number, for 3 cases, without Aadhaar authentication, it will not happen. I cannot go for refund, normal refund or special refund for export cases, or I cannot go for revocation of cancellation. So if I want to go for normal refund or special refund, that is refund of IGST on export of goods, or I want to apply for revocation of cancellation. This I can do only after Aadhaar authentication, which means I can enter inside GST without Aadhaar linking after physical verifications are. But if I want to apply for refund, whether it is normal refund or special refund, RR, and third R, revocation of cancellation. So RRR, normal refund, special refund and revocation, that I need to do it only after Aadhaar authentication. So even after I get GST number, there are certain things which can be done only after Aadhaar authentication. Now coming back here, the next category, state-based registration. GST number is state-based. GST number is state-based. Again, the same 2 exceptions. These 2 points keeps on coming. What are the same 2 points? OIDRS, non-taxable territory, UIN. In both these cases, they go for Pan India, one registration. Pan India, one registration. So when you're talking about OIDRS category in non-taxable, from non-taxable territory to non-taxable online recipient, Pan India, they'll have one registration. Certain UIN means international representatives, they'll have Pan India, one registration. Pan India, one registration. Again, these 2 exceptions comes. Now, one more special category is, see, this we have discussed about Pan India, one registration. Now, within the state, can you go for multiple registration? Yes, within the state, you can go for multiple registration. First is a category where if you are having special economic zone, you have to mandatorily take multiple registration. And if you are not having special economic zone for other places of business, if you want, you can take multiple registration, optional multiple registration. Say for example, you are working in Maharashtra and Delhi. You have 4 places of business in domestic tariff area and 2 special economic zone in Maharashtra. You have 5 places of business in domestic tariff area, means other than special economic zone. 5 places of business, normal places of business in Delhi and 2 special economic zone in Delhi. Now how many registration will take? First you need to understand that it's state based. If I did not tell anything, if I just said you are working in Maharashtra and Delhi, answer would have been 2. I have to take 2 registration. Now how many registration you have to take? Minimum. What is the minimum registration that you have to take in Maharashtra? Minimum is 2. Why? 1 for all the 4 places in DTA and 1 for 2 special economic zone. And how many minimum registration in Delhi? 2. 1 for all the 5 places of business in Delhi and 1 for both the special economic zone. What can be the maximum number of registrations? What are the number of places in Maharashtra? Maximum, totally 4 in domestic tariff area, 2 special economic zone. So maximum is 6. 4 for all the 4 DTA place of business and 2 for both the special economic zone. And maximum registration in Delhi, 7. 5 for each of the DTA place of business and 2 for each of the special economic zone. Right. Here we are covering, in this example we are covering mandatory multiple registration in the state as well as optional multiple registration inside a state. Right, so that you need to understand. And this we have already discussed in your return filing chapter, that whenever you are registering in three capacity. Either as a taxpayer when you are talking about a regular taxable person or a casual taxable person, or a NRTP or OIDRS from outside taxable territory or composition taxable person, or as a tax distributor ISD, or as a tax deductor collector TDS TCS. Right. Now, what is the structure of GST number that you have? It is a 15-digit number. First two is the state code. Next 10 is the PAN number. 13th is entity number inside a state. It is not always 2. Supposing you are there in Maharashtra and Delhi. In Maharashtra, 13th number will be 1. In Delhi also, 13th number will be 1. Entity number inside a state. This will be sec 2, 3 only if you are having multiple registration inside a state. 14th is alphabet Z as of now default, and 15th is a random checksum digit. It can be alphabet or a number. Can be an alphabet or a number. Random checksum digit. Now whether GST number is tax based? No. You do not need register separately in Tamil Nadu or in Maharashtra, separately for CGST, separately for SGST, separately for IGST, separately for compensation cess, isn't it? When you are registering in say Tamil Nadu, you are registering for CGST, Tamil Nadu SGST, IGST, compensation cess. When you are registering in Maharashtra, you are registering for CGST, Maharashtra SGST, IGST and compensation cess. So that concept you need to understand. That is all about your basics of GST registration. Now you are talking about taking registration. Taking questions comes from this area for sure. Right? Questions normally comes from section 22, 23, 24 because it is all about whether to take registration or whether not to take registration. We have already completed your section 22 entire concept when we were discussing about small dealers, composition scheme, 20 lakhs, 10 lakhs, 40 lakhs, we have already completed. Turnover based registration, section 22. Now we are focusing on not requiring registration 23 and compulsory registration 24. Now you don't require registration in certain cases. Where in a state you are exclusively dealing with non-taxable supply or exempt supply, irrespective of a turnover, in that state you need not take registration. You need not take registration. Second, if you are talking about an agriculturalist, to the extent of supply of agricultural produce out of cultivation of land, you need not take registration. Which means if I am an agriculturalist, agriculturalist means what? Only individual HUF, not a company. Individual or HUF. So you have to be very clear when you are talking about agriculturalist, you are talking only about individual and HUF. You are not talking about a company doing the same agriculturalist work. Individual and HUF. So agriculturalist to the extent of cultivation of land. What is the relevance of to the extent of cultivation of land? Agriculturists may have supply of agricultural produce and other supply. Even though if he is registered, he will not pay GST on supply of agricultural produce. He will pay GST on other supplies. Other supplies. He will pay GST on other supplies. But wait, agriculture means he has to produce. He has to do cultivation. Supposing I am an agriculturist, you are a reseller of agricultural produce. I am an agriculturist, I am having two supplies. Supply of agricultural produce, other supplies. Even though I am registered, I will not pay GST on supply of agricultural produce. I will pay GST on other supplies. Now you are also having two supplies. Supply of agricultural produce and other supplies. Now you will pay GST on both. Supply of agricultural produce and other supplies, because you are not an agriculturist. You are a reseller. You are a reseller. So that you need to understand. Next, notified categories. There are certain notified categories. Notified. So when you are talking about notified categories, you cannot understand them in isolation. You have to read it along with section. You have to read it along with section 24. You have to read it along with section 24. Now section 24 first tells that interstate outward supply, compulsory registration. Interstate, outward supply, compulsory registration. Be very clear, focus, so that all the ifs and buts are clear. But there is a relaxation. That is a relaxation. Basically, there are 3 relaxations. 2 for services, 1 for goods. 2 for services, 1 for goods. Now let us understand 3 relaxation in a very simple way. Focus. If you have interstate outward supply of goods, first you are focusing on goods. Normally, compulsory registration. Normally, compulsory registration. Special case, notified handicraft goods. Notified handicraft goods. You are not required to take compulsory registration. You go with turnover based registration. You go with, when I tell turnover based registration, you go with 40 lakhs, 20 lakhs, 10 lakhs. Turnover based registration. But for notified handicraft goods, there are 2 extra conditions. You should, when you are not required to take registration, when you are going under turnover based registration, you should be having a PAN card and compulsory e-way bill. Compulsory e-way bill. Are you clear with this understanding? So when you talk about interstate outward supply, first categorization goods. For goods, if you have interstate outward supply, normally compulsory. For notified handicraft goods, turnover based registration. And until turnover based, 40 lakhs, 20 lakhs, 10 lakhs. But condition, you should have a PAN card, and though you are not registered, but you have to generate e-way bill compulsory. So even an unregistered person can generate e-way bill. Right. Now, interstate outward supply of services. It is ulta. It is reverse of goods. Interstate outward supply of services. Normally, you have to go with turnover based registration. Which means you can enjoy the limit of 20 lakhs and lakhs. 40 lakhs is not for services. You can enjoy the limit of 20 lakhs, 10 lakhs. 20 lakhs, 10 lakhs. So normally for services there is a relaxation. You can enjoy the limit of 20 lakhs, 10 lakhs. So even though you have interstate outward supply of services, you are required to take registration only after crossing 20 lakhs, 10 lakhs. Normally there is a relaxation. Special scenario. Job working for jewelry sector. Job working for other sector will come in normal category. Job working for jewelry sector. Job working for jewelry sector, compulsory registration. If you are job worker of jewelry sector and if you have interstate outward supply, compulsory registration. Compulsory. See, it is very different for goods and services. For goods, normally interstate outward supply, compulsory. For services, normally interstate supply, turnover based registration, 20 lakhs, 10 lakhs. For goods, special category, notified handicraft goods, turnover based, 40 lakhs, 20 lakhs, 10 lakhs. For services, special category, job worker for jewelry sector, compulsory registration. Compulsory registration. Right. Next, you are talking about CTP, NRTP. CTP, NRTP, normal understanding is compulsory registration. But there is a relaxation for CTP. CTP, NRTP, normal understanding is compulsory registration. So CTP, NRTP itself means you have to take compulsory registration. But one relaxation for CTP. That relaxation was there even for interstate outward supply. When you are dealing with notified handicraft goods, if you are CTP, even then you can enjoy the limit of 40 lakhs, 20 lakhs, 10 lakhs. This relaxation is only for CTP. Right. So you have to read this notified handicraft goods in 2 manners. Supposing I am in Tamil Nadu and I am going to Gujarat for participating in business exhibition as a CTP. I am in Tamil Nadu, I am going to Gujarat for participating in business exhibition as CTP. I am in Tamil Nadu, I am a regular taxable person. But in Gujarat, I am CTP. So when I am taking the goods from Tamil Nadu to Gujarat, it is interstate outward supply, but still I can enjoy the limit of 40 lakhs, 20 lakhs, 10 lakhs. Because of relaxation for notified handicraft goods. In Gujarat, I am CTP. Normally it is compulsory registration, but still I can enjoy the limit of 40 lakhs, 20 lakhs, 10 lakhs because of this relaxation. But wait, this 40 lakhs, 20 lakhs, 10 lakhs is not for each state. It is aggregate. It is for both the states together. My turnover should be up to 40 lakhs, 20 lakhs, 10 lakhs as the state, as the case may be. Right. Now, next category. RCM. If I am required to pay RCM, compulsory registration. If I am required to pay RCM under section 9(3), compulsory registration. I don't have an option, but I have to take. There is no relaxation now. That is compulsory registration. If I am required to pay tax under 9.5, 4 categories we have discussed. If I am required to pay tax under 9.5 as an eco, compulsory registration. Now eco, there are multiple categories. Please focus. Eco, if I am required to pay tax under 9.5, compulsory. If I am not required to pay tax under 9.5, then I have to ask myself a question. Whether TCS is there or TCS is not there. If TCS is there, eco will take compulsory registration. Eco will take compulsory registration. Even person who is supplying goods or services through eco will take compulsory registration. See, if 9.5 is there, TCS will never be there. So if 9.5 is there, eco has to take compulsory registration. Supplier will go with normal concept. Eco has to take, when I tell normal concept, they have to see the turnover, other areas, other things and all. If 9.5 is there, eco has to take compulsory registration. Supplier of goods and services will go under normal category. If 9.5 is not there, again, wait, ask a question. TCS may be there, TCS may not be there. If 9.5 is not there, but TCS is there, eco will take compulsory registration. Supplier of goods and services also will take compulsory registration. But wait, for services they have given a relaxation. Supply of services through eco, where TCS is there, they can enjoy turnover based registration. That is, they can enjoy 20 lakhs, 10 lakhs. Now understand this way. There are 3 categories. 9.5 is there. 9.5 is not there, TCS is there. 9.5 is not there, TCS is not there. 9.5 is there, eco, compulsory registration. 9.5 is not there, but TCS is there. Eco, compulsory registration. Supplier of goods through eco, compulsory registration. Supplier of services through eco, that supplier of services can enjoy turnover registration 20 lakhs, 10 lakhs. Third category, 9.5 is not there, TCS is also not there. Then, whether it is eco or supplier of goods to eco or supplier of services to eco, turnover based registration. Turnover based registration. Turnover based registration. Right. Next. Now there is no relaxation or straightforward points. If you are making supply on behalf of another person acting as special agent. If you are a special agent as per schedule 1, compulsory registration. Special agent as per schedule 1, compulsory registration. Assuming that principal is a taxable person. If you are a special agent, obviously principal will be a taxable person. Either he will be registered or he will be liable for registration. So if you are a special agent as per schedule 1, compulsory registration. So here the focus is on special agent as per schedule 1. Input service distributor, compulsory registration. IST need to take compulsory registration. Government who is required to deduct TDS. For TDS they have to take compulsory registration. Normal GST number they will decide, but for TDS they have to take compulsory TDS registration. OIDRS from outside India. This we have been discussing for long. He is having no option. OIDRS from outside India to non-taxable online recipient. It is taxable for sure and it is under SCM, compulsory registration. Forget about turnover, compulsory registration. Other categories, there are no other categories. So these are all the cases of compulsory registration. What we have done, we have seen this compulsory registration along with relaxation as per section 23. Relaxation as per section 23. That is all about when you have to take registration, when you are not required to take registration. Now, when you are talking about certain other areas of compulsory registration, basically when you are switching over the business, there are special cases. If there is a succession of business including death of a proprietor, sale of business including death of a proprietor, who has to take compulsory registration? The other person has to take registration, and he is liable for registration from the date of transfer or succession. When I am telling he is liable for registration on the date of transfer or succession, he has to apply for registration within 30 days from the date of transfer or succession. And when you are talking about amalgamation or demerger after the High Court order or tribunal order, the new amalgamated company or the new demerged companies will take new registration. They are liable for registration not from the date of amalgamation or demerger. It is not from the date of amalgamation or demerger. It is from the date where ROC issues a new certificate of incorporation to the new amalgamated company or to the new demerged companies. From that date, they have 30 days time to apply for registration. So from these days, 30 days will start. This is the date when they are liable. From these dates, 30 days will start. Now, basically, when you're talking about registration, we have discussed. When we discussed 22, 23, 24, we were trying to understand when you are liable for registration. Can it be a scenario where you are not liable for registration but you have taken registration? Yes, very much. Voluntary registration. Once you are registered, payment is must. Then forget about turnover, forget about compulsory endowment. Once you are registered, payment is must. And we have discussed that if you are liable for registration, you have to apply within 30 days. If you apply within 30 days, when is your effective date of registration? If you apply within 30 days, your effective date of registration is date when you are liable for registration. If I am liable for registration on say 1st of October, if I apply within 30 days, say 15th of October, my registration will be effective from 1st October. If I don't apply within 30 days, date of grant, which means if I apply on 15th November and I am getting the registration on 15th December, my registration is effective from 15th December, date of grant of registration. So when I am liable for registration, I have to apply within 30 days, very important. Otherwise my ITC will be under great risk. I have to pay output tax right from beginning, 1st October. Whether I apply in time or don't apply in time, output tax will start from 1st October. But ITC will be decided based on when you have applied. If I applied within 30 days, my effective date of registration will be date when I was liable, which means in my example 1st of October, I will get ITC from 1st of October. But if I don't apply within 30 days, supposing 15th November, I am liable on 1st October, but I am applying on 15th November and I am getting registration on 15th December. So my effective date of registration is 15th December. I will get ITC only from 15th December onwards. I cannot get ITC from 1st October to 14th December. Though I will pay output tax from 1st October to 14th December, but no ITC. If I am voluntary registration, I am going for voluntary registration. My effective date of registration is always date of grant of registration. Date of grant of registration. Right. Now, when you are talking about all the other points here, we have already completed in our basics. Mandatory, multiple registration within the state, mandatory option, we have all completed in our basics of registration. Now let us talk about the timeline. A basic timeline, MCQs you can have. Normally, you have to apply within 30 days. You are required to apply within 30 days. So, assessee has to apply within 30 days. Department has got how much time? It depends. If they have to do physical verification, which means you have not done Aadhaar authentication, either you have not opted or it is failure, then they have 30 days time. Because Aadhaar authentication is either not opted or failure. If Aadhaar authentication is exempted or it is successful, then there is no need of physical verification. That is 7 working days. 7 working days. Are you clear with this understanding? So department is having 7 working days or 30 days depending on if the physical verification is mandatory, then 30 days. If it is not required, why? It is Aadhaar authentication is successful or it is exempted, then it is 7 working days. And if department is satisfied, it will either grant the registration. If it is not satisfied, it cannot reject. It has to give a show cause notice. Second innings will start only if department is not satisfied. It will give a show cause notice, and as assessee you have to reply within 7 working days. After you reply, department will have 7 working days time, either now this time to This time to either grant or reject. Either grant or reject. Now if department is not doing the work within the first innings time limit, 7 working days or 30 days or second innings time limit. Thank you. 7 working days. Then it is deemed to be approved. Deemed to be approved. So that is the timeline. That is the timeline. Right. Now one thing you have to understand when you are talking about the first innings time limit of department. First innings time limit of department which is 30 days, 7 working days. Just think and answer logically. When this 30 days and 7 working days will start? I'll give you 4 scenarios. You have opted for Aadhaar application. It is successful. That 7 working days for department will start from where? From the date you have applied for registration or when Aadhaar application is successful. When Aadhaar application is, you have applied earlier but Aadhaar application is successful after 4 days. So department will start their work after 4 days. 4 days. So in that scenario, 7 working days will start from the date of Aadhaar application being successful. If it is exempted, 7 working days will start from the date of submission of application because it is exempt. If you have opted but not successful, now it is 30 days. The 30 days will start from where? You have opted but not successful. So department will wait for 15 days. Which means you have opted it. It may take some time to link it. Now department will wait for how many days to see whether it is successful or failure? 15 days. So after 15 days of submitting form B, you have opted it, but it is not successful. So department will wait for 15 days. And thereafter, the time limit of 30 days will start. Thereafter, time limit of 30 days will start. Fourth category. What is the fourth category? You did not opt. You never opted. So department is very clear that there will be no Aadhaar authentication. So 30 days in that scenario will start from date of submission. See, if you have opted and it is successful, 7 working days will start from Aadhaar authentication being successful. If it is exempted, 7 working days will start from submission. If it is opted but failure, now it is 30 days. 30 days will start after 15 days of filing part B. If you have not at all opted, 30 days, not 7 days. 30 days will start from date of submission. That is a normal thing that you need to remember, which is given or explained here. Now, we are done with registration, entire thing by assessee. By department is a small area that is left out. By department will give you registration. Department will give you registration because you are liable for registration but you are not going for registration. Department will tell that you are liable but you are not going for registration. So department will give you temporary registration number. As assessee, what option you have? You have 90 days time. Either to convert temporary registration to permanent registration, file all the documents and do, or file appeals. File appeals in appellate authority telling that I should not have been given temporary registration because there is no opportunity. Department will tell you are liable and department will give you temporary registration number. Now 90 days time you have to convert TR to PR, temporary registration to permanent registration, or to file appeals. If at all you convert to PR, the chapter closes that. If you file appeals, then second innings will start. If appeals order is in favor of assessee, temporary registration will get cancelled. If it is in favor of department, then assessee is not having any option. He has to convert TR to PR within 30 days of the appeals order. 30 days of the appeals order. Right. So there are two timelines. First initial timeline is 90 days to convert TR to PR or to file appeals. Next is 30 days after the appeals order is against the assessee. Now only one option to convert TR to PR. Right. Now one last scenario which is left out in your first part, registration, is what all documents you normally submit. Normal documents. You submit your photographs, proof of constitution of business, and the main proof of place of business, and bank account proof. Other documents include authorized form if at all you are appointing someone as authorized signatory. These are all the normal documents that you file Main document, actually the main document is, just look at this angle. Documentation depends on the person. So person related documents you have to give on the place of business. On the place of business. The main documentation will be the place of business. The lease deed or the rental agreement or the ownership document if you are owning the property, along with the supporting proofs, property tax receipt or EB card, these are the documents. And one more important document from the government angle is bank account. But for bank account they are giving a relaxation, a kind of relaxation. When you open a bank account, bank will tell that we want GST number. When you go to GST, they tell that we want bank number. So what they do? They tell that you can come and take GST number without giving bank account number, without giving the current account number. We are not talking about SB account, we are talking about current account, without giving the current account number. But once you get the registration, you have to update the bank account details within 45 days from the date of grant of registration or first due date of first return, whichever is earlier. So after you get the registration, grant means after you get the RC, not the effective date. After you get the RC, calculate 45 days from the date of grant of registration or the due date of filing of your first return. Supposing you get the RC on say 20th of October, 45 days will get over on October, will have 11 days and balance 30 days. So 45 days will get over on somewhere 4th of December. And due date of first return is, if I get the RC on 20th of October, 45 days will get over on 4th of December. Due date of first return, my October return is 20th November. So before 20th of November, I have to update my bank account details. If I get the RC on 3rd of October, then 45 days will get over on 3rd of October. So October is having balance 28 days and 17th November. 45 days will get over on 17th November. Due date of first return 20th November, which is earlier 17th November. Update my bank account details. Else my registration will be liable for cancellation. Department can cancel my registration. So that is all about your registration. So we are done with your two concepts: taking registration, basics of registration, taking registration. Amendment is quite simple, very simple, one liner. So when you talk about amendment, there can be two categories of amendment. One is core field, one is non-core field. Now core field will talk about person related change, place related change, legal name change, core field. If you are changing anything with person or place or legal name, core field. If you are changing anything with your trade name, legal name of PAN card remains the same. Trade name, you are adding trade names, changing trade names or mail ID, mobile number, then that is non-core field. Non-core field does not require any approval. Automatic approval will be given. Core field requires approval. Right, now what is the timeline? Whenever there is a change, you have to apply within 15 days of the change. 15 days of the change. This is your timeline. Officer will have 15 working days to either accept or give show cause notice. If he is not doing anything, deemed to be amended. If he is giving notice, then second innings will start. If he is accepting it, chapter closes that. If he is giving notice, you will have 7 working days to reply to the show cause notice. After you reply, officer will have 7 working days, either to accept or to reject. If his officer is not doing any work within the time limit, deemed to be approved. Right, so this point you need to understand. Now, amendment is required when you are talking about the same PAN. Supposing there is change in constitution of a partnership firm. ABC company becomes DEF company, but the PAN number is the same. PAN number is you have changed the legal name, you have changed the partners. You will go for amendment. You will go for 2 amendments. One is change of legal name and one is change of partners. But if I tell ABC and company is changed to DF and company and both are having separate PANs, then DF and company having a different PAN has to take new registration. ABC and company has to cancel its registration. Cancel its registration. So you have to be very careful with that particular point. Now, amendment in core field shall be applicable where you are talking about same PAN. Same PAN when you are talking about your legal name, partners change and all, it is mandatory. So when you are talking about place of business, you are going to take a huge risk if you don't go for amendment, because any place of business which is not there in your registration certificate is treated as unaccounted place of business, and the consequences will be huge. Any stock inside it will be said to be deemed to be supplied. Deemed supply. You have many hidden deemed supplies. One hidden deemed supply we have discussed in your job worker. One hidden deemed supply we have discussed in your sale on approval basis. Sale on approval basis, 6 months time. Right. This is another hidden deemed supply which may be there. Now what is the effective date of amendment? Now when you talk about effective date of amendment, normally it tells that it is the date when the change occurs. But when you get the final amended RC, you will find that registration, whenever it is amended, it will be only from the date of submission of application. Only from the date of submission of application. If you want that to be an earlier date, which means you want it to be date when actually change occurred. You have to take the approval of commissioner. So if change occurred on 1st of October, whether I apply within 15 days or apply after 30 days, if I apply on 12th October or apply on say 28th October, my effective date of amendment will be 12th October or 28th October as the case may be when I am submitting the application. If I want it to be effective from 1st October, whether I applied on 12th October within 15 days or 28th October after 15 days, if I want it to be effective from 1st October, I need to take approval of the commissioner. This point we have discussed with the example of ABC company and DEF company. If it is same PAN, amendment. If it is different PAN, old firm has to cancel registration and new firm has to take new registration. So that is everything about your amendment. So when you talk about your cancellation of registration, again you have to bifurcate that into two parts. One, cancellation which can be done both by assessee as well as department, registered person as well as officer. One which is suo motu cancellation which can be done only by proper officer. Now we are trying to see the grounds on the basis of which cancellation can be done. So when you talk about cancellation which can be done by assessee as well as officer, they are very simple basic scenarios where the assessee has discontinued the business itself is stopped, or assessee has transferred the business including death of a proprietor. So one is a scenario where you have stopped your business, other is a scenario where you have sold your business by way of normal transfer or sale or amalgamation or demerger or merger including death of a proprietor. One, you are talking about a person where you are no longer liable for registration. See, one, no business. One, sale of business. One, business continues, but I am no longer liable for registration. I am no longer liable for registration, or I was never liable for registration. Someone guided me or misguided me, or I took registration. Now I want to opt out for that voluntary registration. See, when I tell no longer liable for registration, which means I was liable sometime. It may be a scenario I was never ever liable, but I took registration, voluntary registration. Now I want to come out. Yes, you can come out. You can come out. See, if you see the first point and the last point, which were discontinuance of business, no one is doing the business. Transfer of business or sale of business, including amalgamation, demerger, that someone else is going to do, I am not going to do. So again, I am out of it. But third, business continues. I am no longer liable for registration. My business will continue. Or I took voluntary registration. Now I am coming out of that voluntary registration. And finally, you are talking about change in constitution with change of PAN. We have discussed in that amendment part this example already. If ABC and company is transferring the business to DEF and company and their PAN are different, DEF and company has to take new registration, ABC and company has to cancel the registration. Again, it is now not into existence, so there's no use of any registration. 4 scenarios. Now when you talk about ground of cancellation only by proper officer, suo motu cancellation, though the numbers here written are 6, in total they are 10. In total they are 10. Now first is the scenario, again someone misguided you, you registered voluntarily, but you are filing nil returns again and again. You have not started your business for the first 6 months. After you take registration, you are continuously filing nil returns for more than 6 months. So proper officer tells there is no use. I am proceeding for cancellation. Once you start your business, you come back again. Right. Other is a scenario where you are not filing your returns, which means you are doing your business, and initially you might have been filing your returns properly, but suddenly you are not filing your returns. If you are a normal person, 6 months. If you are under composition scheme, 3 quarters. 3 quarters. This tax period is 3 quarters. Normal person other than composition person 6 months. Composition taxable person 3 quarters. 3 quarters. See, there's a difference. First year, in the first point that we have discussed, it was you have taken voluntary registration, condition number 1, and for the initial 6 months you are filing returns but nil returns. This scenario, you have taken normal registration, you would have filed your returns initially, suddenly after 2 years or 3 years, now you are not filing your returns. It is not talking about initial 6 months and all. Suddenly for a continuous period of 6 months, or for composition scheme dealer 3 continuous quarters, you are not filing your returns. Next, you are doing business but not from declared place of business. You are doing business but not from declared place of business. You are doing business from some other place which is not declared on your registration certificate. Or you have obtained registration itself voluntarily, fraudulently, or by misrepresentation of facts or suppression of facts. These 2 are separate points. 1, you are doing business but not from declared place of business, and second, you got registration by fraudulent means. And the next, you are talking about bogus or dummy invoices, bill trading. You are giving invoices but without supply. Criminal proceedings will also start. You are giving invoices but without supply. There is no supply. You are just giving invoices but there is no supply. Bill trading. Now if you see these points, these are totally 3 points. These are totally 3 points. Now when you see the next category, you will find that we are talking about various conditions. You are violating section 16. You are not going by ITC conditions, or you are violating section 171, anti-profiteering clause. Anti-profiteering clause, which means if you are getting more credit, you should give that benefit to the customer. You have to reduce your pricing, but you are not doing that. You are giving the same pricing, anti-profiteering clause. Or rule 10A, after getting the GST number, you have to update your bank account details within 45 days, or due date of first return, whichever is earlier. You are not doing that. Or rule 86B, if at all your monthly turnover is more than 50 lakhs of taxable supply, other than exempt supply and zero rate supply, in that month you have to pay minimum by cash ledger 1%. You are not doing that. So if you see this particular point, there are totally 4 cases. There are totally 4 cases. So you will find those 4 cases covered here. So you are talking about section 16, 171, rule 10A, rule 86B. And finally, you are talking about a very serious scenario where your outward supplies in GSTR 1 is more than your GSTR 3B. Maybe basically 1 and 3B will be there. So validated on 39 is 3B. Your sales is more in GSTR 1, but your GSTR 1 is only reporting. Payment happens in 3B, but your sales in 3B is less. Right. So if at all now you make a count, you will find totally 10 points. In the first category, there was 1 point. In the second category, 3, 4, 1 and 1. So you will find totally 10 points. You will find totally 10 points. Are you clear with this understanding? Now, the moment your registration proceedings are cancelling. What is the cancellation proceedings? We'll discuss. But initially, the moment cancellation starts, suspension will also come. You'll also be going through the process of suspension. So we are now talking about suspension. Now, suspension of registration pending cancellation proceedings, which means your cancellation proceedings are in progress. Final order is yet to come. Whether it will be cancelled or not will be decided. But during that cancellation proceedings, suspension will happen. Cancellation proceedings will start and it will end. It will take some time. In between that, during that, your suspension may be that. So when you talk about that scenario, first is a scenario where suspension, where cancellation is initiated by assessee. So there are 4 grounds where assessee can also start cancellation proceedings, isn't it? 4 scenarios where assessee can go with cancellation proceedings. In that case, your suspension will start from the later of date of application or date from which cancellation is sought. Which means assessee is giving cancellation application say on 1st October. But he is willing to have cancellation with effect from 1st January. So whichever is later. Whichever is. So he is making cancellation application on 1st October, clearly telling that I want my cancellation to be done with effect from next 1st of January after 3 months. So suspension will also start from 1st January. It will start. It will end when? Till the completion of cancellation proceedings. Starting point is the date of application or the date from which cancellation is sought, whichever is later. Ending point is very simple, till the date completion of cancellation proceedings. Now next is a scenario where proper officer is initiating cancellation proceedings. Where proper officer is initiating cancellation proceedings. Now you will find here 2 cases. One normal case and one is special case. First we will discuss about normal case. Normal case, there will be a show cause notice for cancellation. And in normal case, suspension is not mandatory. It is optional. Why? See, officer thinks that your registration should be cancelled. But assessee may fight the case. Correct. So here they have said that, okay, you have given a notice for cancellation. Suspension will not be automatic and all. First of all, it is option for the officer to do suspension. And second, whenever anything about cancellation will be decided by proper officer. It will start from the date decided by proper officer till the completion of cancellation proceedings. But a very important point is cancellation has started, notice for cancellation has been given, suspension may be there, not mandatory, may be there. And if it is there, what is the starting date? Decided by officer. What will be the end date? Till the completion of cancellation proceedings. Now, there is a special case of suspension where you are talking about comparison of your returns under 39, that is GST 3B with your 1 and 2A. Simple. Outward supply is more in 1 compared to 3B. Input tax credit is more in 3B compared to 2A to B. Outward tax is more in GST 1 compared to 3B, means you are paying less. Input tax credit is more in 3B compared to 2A to B, which means you are claiming more credit. That is showing significant differences. Small differences will be ignored. Significant differences or anomalies leading to cancellation. Leading to cancellation. Now, in this case, point number 1. Why it is called a special? Point number 1. It is mandatory suspension. Officer cannot have, is not having a mandatory suspension will start. And very special point. Normally, cancellation starts, thereafter suspension starts, isn't it? But here, suspension starts by intimating the differences. Thereafter, cancellation will start. Suspensions will immediately start from the date of intimation of differences till the completion of cancellation proceedings. So this special case is special for multiple reasons. Reason number 1. Normal scenario, cancellation followed by suspension. Here, suspension is followed by cancellation. Reason number 2. Normal scenario, suspension by officer is optional. In this it is mandatory. Reason number 3. Normal scenario where suspension is optional, officer will decide from which date. Here it will start from the date of intimation of, the moment they are intimating a difference, automatically suspension starts. Suspension, it is a very, very, very serious scenario. Right. And please mind that they will not do it for small differences and all. There should be significant differences. Significant differences. Now, what will happen during suspension? Now you know what are the total 3 cases. 1 by SSC, 2 by officer. Cases of suspension, when it will start, when it will end. Now what will actually happen during suspension? During suspension, you can make supplies, but you cannot issue tax invoice. You are not required to file any returns. Actually, these are the advantages for the assessee. If at all assessee goes for it, you are not required to raise tax. You can supply, you give normal invoice, but you cannot give, which means you cannot collect tax. You cannot collect. It is not that you cannot do business and all. You can do supply, but no tax invoice. You are not required to file returns. Now, one disadvantage is refund will not be granted. But this point is only in suo motu case. When office is starting, refund will not be. You can apply for refund, but pending cancellation proceedings or pending the suspension thing, refund will not be granted. Grant will not be there. You can make application. Granting will not be there, and this point is applicable only for suo motu case, which means only for officer case, not for assessee's case. Now, whether suspension will be revoked, possible. If assume that finally cancellation proceedings are dropped. If finally cancellation proceedings are dropped, whether started by SSC or started by officer, don't you think that suspension is automatically revoked? Right, so suspension will be revoked on completion of cancellation proceedings. Whether cancellation is successful or failure, it will get revoked. It will get revoked. Only thing is, when cancellation is successful, suspension is revoked, but GST number is cancelled. If it is cancellation proceedings are dropped, if it is a failure, suspension will get revoked with effect from which date? With effect from a date when it happened. Right from the date when suspension happened, it is revoked from that date. It is revoked from that date. It is revoked from the date of suspension. It is revoked from the date of, so it is retrospective revocation. Retrospective revocation. Now, revocation will happen anyways, whether cancellation is successful or cancellation is failure. If cancellation is successful, your GST number itself is gone, nothing to discuss more. But if the cancellation is failure, which means cancellation proceedings is dropped, your GST number is not cancelled, then suspension is also revoked from retrospective effect, from the date of suspension. From the date of, now the problem is, you have GST number alive. Cancellation started, your GST number was suspended, but again cancellation is dropped, your GST number is alive. But during that time, you have suspension, you did not give any tax invoice, you did not file any return. So, welcome to the concept of revised tax invoice and first return. Revised tax invoice, and for the period of suspension, you will be converting your accounting invoice to tax invoices. You will be converting your accounting invoice to within 1 month. Within 1 month of what? Date of revocation of suspension. Within 1 month. Convert your accounting invoices where you have not collected GST to revised tax invoice, GST invoices. And you have to file your first return. First return will not be first return is always for group of months together. So that first return will be for 2 months or 2.5 months or 3 months or 3.5 months will be filed together. That details of 2 months or 2.5 months or 3 months or 3.5 months or 5 months, that will be filed together. Revised tax invoice and first return will come during birth and rebirth. During birth and this is the case of rebirth. And what if cancellation is successful? That has to be asked, right? What if cancellation is successful? If cancellation is successful, then you will have some stock. We have already discussed it in ITC. You will have stock of inputs and capital goods. On that stock, you have to reverse ITC as per for capital goods as a formula, multiplication method, or output tax payable, whichever is higher. Vishal Jain registered is different from Vishal Jain unregistered. We have discussed that, right? So that again will come into picture. And make one thing very clear, that whether even if your cancellation is cancelled, registration is cancelled, that does not mean that you are relieved from your liability. They can still, after 2-3 years after cancellation, they can still recover the old dues. You cannot tell that my cancellation is done, I am not going to pay anything. Even after cancellation is done, they can collect old dues. They can collect old dues. Are you clear with this understanding? That is all about your cancellation process, cancellation grounds and suspension. Now we are discussing the timeline of cancellation. Timeline of cancellation. First scenario, cancellation is started by assessee. So when cancellation is started by assessee will file cancellation application, and as the cancellation application will be filed within 30 days of event warranting cancellation. Whatever has happened, say business is discontinued or transfer, etc. So within that 30 days, he has to file for cancellation application, and officer will decide within 30 days. But here in cancellation, there is first point, there is only one innings. Second point, there is no deemed to be approved and all. Officer may do it within 30 days or may do it, he may take 3 months, 1 year. There is no deemed to be cancelled. There is no deemed approval and all. Very serious affair. Therefore, they don't tell that it is deemed to be the cancellation application deemed to be approved is not that. Right. So assessee is having 30 days for filing cancellation application. Officer is having 30 days to decide whether to accept cancellation application or to reject and make it alive. Now, if officer is starting cancellation, he will give a notice. Now, assessee will have time to reply to show cause notice. Actually, normal time limit is 7 days. Assessee has 7 working days to reply to the show cause notice, and after replies, officer will have 30 days to consider the reply. Again, only one innings. 7 working days, 30 days. When assessee is going, assessee is having 30 days, officer having 30 days. When officer is starting, officer will give notice. Assessee having 7 working days, officer having 30 days. No concept of deemed to be cancelled at all. But there is one more scenario which we have discussed, special suspension. There what will happen is assessee will have 30 days to reply to that intimation of differences. 30 days. And officer will have 30 days. Officer will have 30 days. Are you clear with this understanding? Are we clear with this understanding? So there are no 2 innings. This is normal scenario, optional suspension. This is special scenario, mandatory. So normal scenario, 7 working days, 30 days. Special scenario, 30 days, 30 days. Right. Now understand that when assessee starts cancellation process, revocation of cancellation is not possible. But when officer is starting cancellation process, revocation is possible. Which means even after your GST number is cancelled, you can make it alive. Suicide case, no revocation. Murder case, you can go for revocation. When you're talking about revocation, it is possible only when your cancellation is started by officer. Either the first category, 7 working days, 30 days, optional suspension, or the special category, mandatory suspension, 30 days. Either or, officer starting. Now, revocation time limit is very simple. Revocation time limit merge the time limit of cancellation by assessee and cancellation by officer. So when you want to go for revocation, assessee has to apply for revocation within 30 days of cancellation order, which can be further extended by 30 days by ACDC and further extension by 30 days by commissioner. So 30 plus 30 plus 30. Basic time limit is 30. But it can be, the first time extension is 30 days by additional commissioner, joint commissioner. Second extension by 30 days by commissioner. Basic time limit is 30 days. Then officer will get 30 days time to either accept revocation and make your GST number alive, or give show cause notice. And if officer is giving you show cause notice, then you have 7 working days to reply to the show cause notice. And after you reply, officer will have 30 working days either to accept your revocation and make GST number alive, or reject revocation. Your GST number is also already dead. Nothing will happen. So if you see, now there are 2 innings. First innings, you can remember by understanding the time limit for cancellation when assessee goes. Second innings, you can remember it by remembering the dates of cancellation when proper officer starts, normal case. Proper officer starts, normal case, optional suspension. Right, so 30, 7, 30. But make one thing very clear, that this revocation is possible only if officer is starting cancellation. Officer starting cancellation. Within how many days you have to apply? 30 days. Extension 30 plus 30. Now, you may find one more part which is left out in your entire registration, but this particular point is applicable only for one type of cancellation proceedings. See, in total, officer can cancel your registration in totally 14 cases. 4 cases where assessee can go as well as officer can go. 10 cases where officer only can go. So totally there are 14 cases. Out of that, there is one case where you are not filing your returns. You got the point? There are totally 14 cases. Out of that, we are talking only about one case where you are not filing your return. What is that case? Non-filing of returns. For 6 months, normal scenario, 3 quarters, composition scheme. Now, please understand that in that scenario, the condition, what is the condition? You have to apply within 30 days. If it is a normal case, other cases of cancellation, there is only one condition. We have done with the revocation. You please make application within 30 days. That's it. But if your cancellation is because of non-filing of returns, then there are special points. I'll make it very simple. Totally out of 14 cases, 13 case and 1 case. 13 cases and 1 case. For 13 cases, nothing more. Application within 30 days. Application within 30 days. Here, for 1 case, before application you have to do something. After also you have to do something. Again, 30 days are coming, but they are different. Right. So here, there's only one condition. You have to make revocation application. That's it. Within 30 days. Here, you have to file your pending returns. Pending returns as on which date? As on the date of cancellation order. Supposing cancellation order is 12th February. Pending returns means up to what? Right from the time we have not filed your returns till what? Cancellation order is 12th Feb. Till what? Supposing cancellation order is 12th Feb 2023. You have not filed your returns from July 2020. So you will file your returns from July 20 till cancellation order is 12th February 2023. 12th February 2023. So what are your pending returns as on the date of cancellation order? December 22. January 23, the due date is yet to come. You get the point? Pending returns as on cancellation order. If cancellation order is there, that cancellation order is say 22nd Feb 2023. Then right from July 2020, you have to file your returns from July 22 Jan 23, because Jan 23 due date has gone. Pending returns as on cancellation order. Right. Plus revocation application. When I tell you have to file your pending returns cannot be filed without payment. Obviously, you have to make the payment as well. Returns cannot be filed without payment of taxes. Clear? This is first condition. And after your revocation order is given, you have to file balance pending returns. As on the date of revocation order. I'll continue the example. Right from July 2020, you have not filed your returns. You have got revocation order on, cancellation order on 12th February. So from July 20 to December 22, you have to file your returns. returns. So if I take this particular example, you have not filed your returns from July 2020. Cancellation order is on 12th Feb 2023. This is returns not filed. And you are talking about now cancellation order. Now please understand that within 30 days of 12th Feb, you have to do two things. One, file all the pending returns from July 20 to December 2022. Plus, you have to make revocation application. This 30 days can be extended by 30 days by joint commissioner, additional commissioner, 30 days by... Now, supposing finally revocation order comes, which means it is you are successful. Your GST number is again alive. Supposing revocation order comes on 12th November 2000, I'll make it a bit different. 22nd November 2023. Now again within 30 days. Now no extension. Now there's no extension. Within 30 days, you have to file your balance pending returns. What are the balance pending returns? Jan 2023 to October 2023. That's it. Simple. Are you clear with this understanding? Go on your QR infographics. Example is given. I'm making it more simple. Are you clear with this? Theoretically, this actually cannot be explained. It's highly complex to go with the wordings and all. Now, I'll just make one small change. If I tell that this cancellation order was retrospectively effective from July 20, whether it will make any change? Yes. In that case, you cannot file your any returns. You cannot file your any returns because it is retros. Normally, prospective means if it is from cancellation orders on 12th Feb, it is effective from 12th Feb. Now, if I tell that it is retrospective applicable right from July 2020, then portal will not allow me to file my any returns. So, within first 30 days, all I have to do is give revocation application. Then, what is the second change? After revocation order is successful, then I have to file all my pending returns right from. So whatever I am writing in red is the change that will be there in the answer. That will be the change in my answer. Why? Now it is retrospectively applicable from July 2020. So for the first, when I am making revocation application, I cannot file any my returns. I have to just give my revocation application. After revocation order is there, within 30 days, I have to file all my balance pending returns. My balance pending returns starts from July 20 till October 23. That's all about this particular case. So this special point is there only in this one case. What is this one case? You have not filed your returns. You have not filed your returns. Because if you don't understand that, you will read this thinking that this is for all the cases of revocation. No. Cancellation can be started by officer in totally 14 cases. Out of which, in 13 cases, the process is very simple. Just make a revocation application. That's it. But in one case, it is a two-step process. It is a two-step process. So that needs to be understood here. So this, whatever is given here, we have discussed in a very, very simple manner. And the example which is given here, I have made it more simple by given one example and all the ifs and buts are also discussed. So that is everything about your cancellation process. Friends, now let us discuss about the last area of your registration, where you are talking about special provisions of registration for your CTP, NRTP. There's a small difference between both. We'll be discussing that. UIN, and when you're talking about TDS registration and TCS registration, GST TDS and GST TCS registration. So once you're talking about CTP and NRTP, one thing that you have to keep in your mind is the common point is you're talking about temporary purposes, participating in business exhibition or trade fair, where you're undertaking transaction and supply of goods or supply of services. Occasionally, the word occasionally is extremely important. Occasionally, it's not for permanent purposes. Occasionally is the word. Now, other differences, supposing you are there in, you are a regular taxable person in Tamil Nadu. From Tamil Nadu, you are going to Gujarat for a business exhibition or a trade fair. The moment I say is talking about business exhibition trade fair, the hint is it may be about CTP and RTP. Now, what happens is, you are a regular taxable person in Tamil Nadu, in Gujarat, where you are not having any branches, any place of business in Gujarat. You are a casual taxable person. Assuming if you are having place of business in Gujarat, you are having branches in Gujarat, then there is no concept of CTP. What you will be there in Gujarat is also regular taxable person, and the place that you are going for business exhibition or trade fair, you will be adding that as your additional place of business. Now, supposing from USA, you are going to Gujarat for a business exhibition or a trade fair, then in that scenario, obviously USA person will not be having any GST number in USA for sure. You will be having some number in of USA as per the laws of USA. Now, this person is NRTP in Gujarat because he is not having place of business or place of residence throughout India. So, understand the difference. CTP means you are a regular taxable person in one state, and in the other state where you are going for business exhibition trade fair, you are not having any place of business. In that state, you are CTP. Whereas NRTP means you are coming from outside India, you don't have any place of business or residence throughout India. You are coming for a business exhibition or trade fair in Gujarat. Now in Gujarat, you are NRTP. Right? CTP will file a normal registration form. So, registration form for CTP is normal registration form, whereas NRTP you need to file a special registration form. So, there will be a special registration form when you talk about your NRTP. These are the differences. Now, one more difference which is there in CTP, NRTP with respect to your registration is CTP. When I am telling you are going to file a normal registration form, it will be based on your PAN number. Whereas NRTP, it will not be based on your PAN number. We have already discussed that. It will be based on PAN of another person. So, NRTP, what will happen is when you are applying for NRTP, the person who is applying for NRTP will give his self-attested copy of passport if at all that person happens to be individual. If at all that person happens to be a business entity, then instead of valid self-attested copy of passport, that person will give tax identification number. Supposing it is Trump, Mr. Donald Trump, then he'll be giving self-attested copy of the passport. Supposing it is Trump Incorporation, then Trump Incorporation will submit the tax identification number which is there in USA. So their own document will be either, if you are an individual, self-attested passport. If you are not an individual, if you are an artificial person, then it will be copy of tax identification number in that country. Now, when you are talking about NRTP, one very special point which you have already covered already, NRTP is not based on the non-resident's PAN number. It is based on PAN number of authorized signatory. It is based on PAN number of some other person. It is based on PAN number of some other person. This authorized signatory should be an Indian resident and having a valid PAN number. So NRTP registration is not based on PAN of non-resident, but because obviously you will not be having any PAN number, whether it is individual or a body corporate of USA. So it will be based on PAN of authorized signatory. Condition is that authorized signatory should be an Indian resident plus he should be having a valid PAN. Now coming about certain common points about CTP and NRTP with respect to registration. Just think of the normal provisions and get the answers yes. Normally, if at all you are talking about a regular taxable person, just think of that. The moment you are liable for registration, you have to apply for registration within 30 days. Within 30 days from the date you are liable for registration, which means you are getting a breathing time of 30 days. Whereas NRTP, CTP, now we are discussing about common points. They don't have breathing time. They have to apply for registration, advance application for registration 5 days before the commencement of business. If you are a regular taxable person, the moment you are liable for registration, you have 30 days time to apply for registration. But if you are CTP and NRTP, the moment you start your business, advance application for registration at least 5 days before commencement of business, you have to apply for registration. Normally, once you are applying for registration, normal case, regular taxable person, you have a breathing time of 30 days to apply, and your effective date of registration depends. If you have applied within 30 days, it is date when you are liable for registration. If you have applied after 30 days when you are liable, then the effective date of registration is date of grant of registration. But here it is always date of grant of registration. You can commence your business only after date of grant of registration. To put it more very clearly, supposing you are from Tamil Nadu, you are having a normal registration in Tamil Nadu, regular taxable person, you are going to go to Gujarat, participating in the trade fair or business exhibition in Gujarat. You don't have any place of business in Gujarat, so you are CTP in Gujarat. So supposing that business exhibition is starting on 1st of April. Now you have to apply for registration as CTP minimum 5 days in advance, which means you have to apply for registration on or before 26th of March. 5 days in advance you have to apply before commencement of that trade fair. Assuming that you have applied on 20th of March, which means you have applied before 5 days of commencement of business and you got the registration certificate only on 5th of April. Then even though you have applied before 5 days, advance application was made minimum before 5 days of commencement of business, that is commencement of trade fair, even then you can participate in business exhibition only from 5th of April. Even though you have done the work in time, they said that you have to apply for registration 5 days in advance. You have done that. Even then you can participate in that business exhibition only after the grant or issuance of registration certificate. So that is the first special point. Now normally, once you are getting your normal registration, there is no concept of deposit. You need not pay any deposit. So when you are getting normal registration, first 30 days breathing time, here there is no 30 days breathing time, 5 days advance. Second, normally if you apply within 30 days, effective date of registration is date when you are liable. If you don't apply within 30 days, then effective date of registration is date of grant of registration certificate. But in this case, even though you apply 5 days in advance, then the effective date of registration is date of grant of registration in all cases. Third, normally if you are a regular taxable person, you need not pay any deposit. There is no concept of paying deposit for getting the registration. But for CTP and RTP, they have to pay an advance or deposit in electronic cash ledger, which is estimated, which is nothing but estimated liability, and the liability is not gross liability, estimated net tax liability. So gross tax liability will be too much because net tax liability is your gross output tax minus input tax credit. So what is your estimated turnover and gross output tax, and what is your estimated input tax credit? So gross output tax minus input tax credit is your estimated net tax liability. So whatever is your estimated net tax liability that you are going to pay by cash ledger, you have to pay that as deposit. So that's the concept of deposit which is not there in your normal case. So third difference. Now fourth, normally when you go get registration as a regular taxable person, registration is valid until it is cancelled. But here CTP and RTP registration is valid for 90 days from the effective date of registration or the last date mentioned on the registration certificate, whichever is earlier. So the registration certificate may give a last date till which it is valid, or maximum validity is 90 days from the date of grant of registration, whichever is earlier. Right? If at all you have got the registration certificate on 5th of April, 90 days from 5th of April, or the registration certificate may tell that it is valid only up to 30th of April. So registration is effective only till registration is valid only till 30th of April because it is earlier. Right? Can you go for extension? Rather, this is the fourth difference that you have. Now, the fifth point is understanding that normally, in normal case, your registration is valid till it is cancelled. But here, there is a validity. Can the validity be extended? Yes. But the validity, when it is extended, there are two conditions that you need to satisfy. One, you have to apply for extended validity before the original validity is over. Two, again you have to pay estimated net tax liability. So there are two conditions. Apply for extension before the original validity gets over, and again second time you have to pay deposit in electronic cash ledger. And the validity of extension will be the same concept. 90 days from the date of extension, from the completion of original validity or the last date mentioned on the registration certificate, whichever is earlier. So understand that extension validity is again the same thing. 90 days now will start from the date of completion of original validity or the last date mentioned on the registration certificate, whichever is earlier. So first time extension is possible. Conditions are two. First condition, make sure that you apply for extension before original validity gets over. Condition number two, again you have to pay estimated net tax liability deposit in electronic cash ledger. Now Finally, last question. Can the validity be extended for the second time? No. The validity cannot be extended for the second time. If at all, validity can be extended only once. If at all he wants to continue for exhibition for a longer time, then more than 180 days basically, then he has to go for normal registration. So validity can be extended only once. Second time extension of validity is not allowed. So that you need to remember. Also understand that once your exhibition is over and you have filed all your returns, your registration also is cancelled, then whatever balance is there in your electronic cash ledger, if at all there is a balance, which means your estimated net tax liability, you estimated more and paid more in electronic cash ledger, whereas your actual net tax liability was lesser. Right, in that scenario, you will be having some balance in electronic cash ledger that you can apply for refund, but you have to make sure that you have filed all your returns properly, then you can go for that particular refund. So that is all about your CTP and RTP. Now talking about the second special aspect of registration. The first special aspect was all about your CTP and RTP. Now you are talking about your unique identification number. Finally, we will be talking about your TDS TCS. Now talking about UIN, understand that UIN bifurcate into two categories. The first category is talking about your specialized agency of United Nations organizations or any multilateral financial institution or organization under United Nations Privileges and Immunities Act 1947 or consulate or embassies of foreign countries, which means you are talking about international representatives. If you see all the three aspects, the first point talks about specialized agency of United Nations organizations, whether it is World Trade Organization or World Health Organization or you're talking about your UNESCO, right? All these specialized agencies will come here. The second point is talking about multilateral financial institutions and organizations which are under United Nations Privileges and Immunities Act 1947. Again, you're talking about international bodies. Third, again, you're talking about consulate or embassies of foreign countries, representatives of foreign countries. So that is the first aspect. The second aspect is any other notified persons by commissioners. Right. Now when you talk about the first aspect, please understand that the first aspect, this UIN is for entire India. We have discussed in the beginning that this certain UINs, it will be pan-India one registration. So the first category, international bodies, pan-India, there will be one registration, pan-India one registration. Whereas when you're talking about the second category, notified persons by commissioners, they have to apply state-wise. Two special points when you talk about the first category, UIN is throughout India one UIN and PAN may or may not be that. Second category, it is state-wise you have to apply for UIN and it will be based on PAN. Now also you need to understand that when you talk about UIN, normally when you talk about registration, either you will apply for registration, same is true for UIN, or officer will recommend you for registration, home motor registration, again it is true here. Third special aspect, at times registration here will be given on recommendation from Ministry of External Affairs. So this is a very special aspect. Either the bodies will apply for registration or proper officer will so moto give the registration, or registration will be given on recommendation of Ministry of External Affairs. So this last part is a special aspect. Now when you talk about the third special case of your registration, which is TDS, GST TDS number, GST TCS number, understand that GST TDS number will be taken by your governments and GST TCS will be taken by your electronic commerce operator. Now at times you may have GST TDS number, TCS number in a state where you don't have any physical presence, which means you will take GST TDS number, TCS number in Maharashtra where you don't have any physical presence. Let me give it in a bit different manner. There is an electronic commerce operator who is applying for GST TCS number, which is having physical presence in Maharashtra but not having physical presence in Tamil Nadu. So it is going to apply for GST TCS number both in Maharashtra and in Tamil Nadu, because it is going to do business in both the places. In Maharashtra, both part A of the registration form and part B will contain only Maharashtra. But when it is applying for GST TCS registration in Tamil Nadu, where it is not having any physical presence, only for GST compliances it is taking GST TCS number in Tamil Nadu. So one state it has got physical presence and it is applying for GST TCS number. Other state it is not having physical presence but it is applying for GST TCS number. Second category is special. In the second category, in part A, they will give Tamil Nadu state. Part A of your special registration form GST REG 07. If they are applying for GST TCS number in Tamil Nadu, they will give the state of Tamil Nadu. In part B, they will give the state where they are having the principal place of business, where they are having the head office, which is different. So understand that Amazon, which is supposing you are talking about, say, Amazon or Flipkart, which is having physical presence in Maharashtra, getting GST TCS number in Maharashtra, normal. Part A as well as Part B will contain only Maharashtra. But the physical presence is in Maharashtra, but it is getting GST TCS number in Tamil Nadu. Part A will contain Tamil Nadu. Part A of GST REG 07 form will contain Tamil Nadu. Whereas Part B will contain Maharashtra, where it is having physical presence, but which is different from the state where you are going to take GST TCS number. So that you need to understand. Now, you are talking about certain differences between all the four categories that we have discussed here. One is your CTP, NRTP. The next is UIN, and finally you are talking about TDS, TCS. CTP registration, as discussed, it is a normal registration. You apply for normal registration form. There is no special registration form. Just like regular taxable person, normal registration form. NRTP, you are going to go with a special registration form. So normal procedure is also applicable, but registration form is special. It is given in rule. The registration form for NRTP is special because NRTP will not have PAN number. NRTP registration will be based on PAN of another number. So it is normal procedure read along with special procedure. UIN registration, this is again very special, and as it is for international bodies, it is given within 3 working days from the application date. Right, very fast, very quick. And when you are talking about TDS TCS registration, again the same is granted within 3 days from the date of application, because it is only about payment in cash ledger. The person who is deducting TDS or collecting TCS will pay from cash ledger, opposite person will get in cash ledger. Now, this is all about registration for all the 4 categories. When you talk about cancellation, CTP, normal procedure, just like anyone else, normal procedure for cancellation. Even for NRTP, normal procedure. If you see CTP and NRTP, both are very same. Cancellation for CTP and NRTP, normal procedure. But when you talk about registration for CTP, fully normal procedure. Registration for NRTP, normal procedure plus special procedure, because it is based on PAN of another person. Whereas UIN, there is no procedure specified. There is no procedure. Because it is to international bodies, there is no process to be applied. It may be given on the application of international bodies or the suo motu by proper officer, or a very important point, on recommendation of Ministry of External Affairs. So there is no procedure which is there. In terms of registration, you have to apply within 3 working days. In terms of cancellation, there is no procedure. So when you talk about cancellation, understand that UIN number need not be cancelled, because UIN holders are required to file returns only when they are going to get refund. So there is no need of cancellation. So there is no cancellation procedure given for UIN. Registration, they will be given within 3 working days. But cancellation about UIN, law is silent. To be very precise, there is no need for cancellation of UIN, because UIN holders will file their returns only when there are some transactions and they want the refund of taxes on inward supplies. And TDS, TCS, proper officer can cancel it as per rule 22, but here TDS, TCS, who can cancel? Assessee cannot cancel, only proper officer can cancel. Only and only proper officer can cancel TDS or TCS number. So that is all about all these 4 aspects: CTP, NRTP, and you are talking about UIN, and finally TDS, TCS, both about registration as well as cancellation. This is completing our entire registration chapter. Yes, when you talk about payment, one thing be very clear. Payment is all on portal. First your liability is stated by way of electronic liability ledger. Then you can discharge your liability by credit ledger or cash ledger. So it is all on portal. Your liability ledger will have liability created by you as per your return. Also liability created by the officer. Either yourself or by the officer. That liability can be closed by paying by way of credit ledger or cash ledger. Right. And when you talk about liability created by officer, either You can reduce your liability by going to appeals. See, if liability is created by the officer, you can reduce it by going for appeals. Or if you see demand and recovery chapter, if you pay your liability within a particular time, penalty will be reduced. Penalty will be, so there are time before show cause notice, after 30 days, within 30 days of show cause notice, within 30 days of demand order. So first liability of penalty will be used. Tax and interest will remain the same, but penalty will be reduced. Right, so that is liability of officer. When you talk about your credit ledger, how you get your credit and credit ledger? You get your credit and credit ledger by filing your return. By filing your returns. Only when you file your returns, you will get the credit. You will get the credit. Right. Or there's one more scenario that we'll discuss with a small example. Or in a case where your refund is rejected. If you have applied for refund of credit ledger, that amount would have decreased. So when you apply for refund, amount decreases. When it is rejected, again it is added back. So this is true both for credit ledger as well as cash ledger. For what you use the credit ledger? For paying your liability. For paying your, but one important point, credit ledger can be used only for tax liability. Interest, late fees, penalty, any other amount, RCM, composition tax, TDS, TCS, they all can be paid only by cash ledger. They all can be paid only and only by cash ledger. Getting that point? Now what about cash ledger? Cash ledger, how you get the amount in cash ledger? By depositing in challan, cash ledger. Right. Also you get that amount in cash ledger by your TDS, TCS. The person who pays TDS, TCS has to pay it by cash ledger, and the opposite person, the deductee or the payee, will get in his cash ledger. What is the purpose of cash ledger? Cash ledger can be used for discharging any liability. Tax, interest, late fees, penalty, any other amount, RCM, composition tax, TDS, TCS, it can be used for any liability. If you claim refund of cash ledger, whether it will decrease from cash ledger or increase. If you are claiming, it will decrease. If that claim is rejected, it will increase, just like your credit ledger. There was one very special point here which we have not touched. If you are paid extra tax, if you are paid, supposing for a month I have to pay 5 lakhs but I have paid 50 lakhs. I have to pay 5 lakhs, by mistake I have paid. Liability itself I have typed it wrong. Liability itself I have typed it wrong. Not cash ledger payment or credit. Liability itself I have typed 50 lakhs. Then I tell no, I have liability. My liability was my output supply was not pertaining amounting to total liability of 50 lakhs. It was only 5 lakhs, but I have paid extra. That 50 lakhs contains 45 lakhs excess liability and 5 lakhs current liability. 45 lakhs you will claim the refund. Understand that in that month you would have paid something by cash ledger, something by credit ledger. You have to take that ratio. Whatever you have paid by cash ledger, supposing in that month the payment by credit ledger was 40 lakhs, you had huge credit, and 10 lakhs was cash ledger. So what was the ratio? 4:1. 4:1. Right. So you are claiming refund of how much? 45 lakhs. 45 lakhs multiplied by 4 divided by 5 will come back to credit ledger. 45 lakhs multiplied by 1 divided by 5 will go to your bank account. Not cash ledger. Don't tell cash ledger. Will go to your bank account. Will go to your bank account. So that is given here. Now, certain other important points. Understand, challan can be created only online. There's no offline challan. Challan can be created only online. Challan is always by portal. Whether you are registered or unregistered, you need to understand that challan can be created only online. There's a point given somewhere here that challan are always created online. Yes, here. When you create a challan, what is the first thing that you get is common portal identification number. Common portal identification number. It is only on portal. It will have common portal identification number, CPIN. It contains how many digits? 14 digits, which is valid for 15 days. Which means within 15 days you have to make the payment. And once you make the payment, it will get converted to CIN, which is Challan Identification Number, which is given by the banks on successful payment against CPIN. And that will be 17 digits. 14 of CPIN plus 3 bank branch code. Right. And correspondingly there will be a bank reference number, BRN. So on payment, there will be 2 reference number, one on portal CIN, one on bank BRN, so that at times payment gets deducted from your portal, but it is not reflected. It gets deducted from your bank, but it is not reflected in portal. So they will have cross check. Now what is TIN? TIN is, even if you are unregistered person, you can make the payment only by creating a challan on portal. Offline challan, there is no facility. Even if department is catching hold of an unregistered person and telling that pay this amount, even he cannot create offline challan, online challan. That online challan will be called as temporary identification number. Temporary identification number. Challan is always online. Is always online. Payment can be online or offline. What is online payment? Internet banking, credit card, debit cards. Online. Offline payment, NEFT, RTGS, any amount. Technically it is offline. It's not online. NEFT, RTGS technically it is offline. Technically it is offline. That is someone who cross verifies fast or slow. RTGS or NEFT. So that is different. Some authority is there to check. Now, other than that, when you are making the payment by way of check or DD or cash, that is called as over the counter payment. That is allowed, but only up to 10,000 per challan per tax period. Per challan per tax period. This limit is that. If you are making by cash per tax period, that is month or quarter, or per challan, it can be only up to 10,000. But this limit is not applicable for whom? For government, persons notified by the commissioners, or when you see point number C, D, E, just forget about the technicalities. You are not paying on your own, officer is demanding. You are not paying on your own, officer is demanding. So then this limit of 10,000 per challan per tax period does not hold good. He can ask even 10 lakhs, he can ask even 10 crores, he can ask even 100 crores. You can pay it by cash, check or DD. That is allowed. That is allowed. Now, liability ledger, certain special points. Liability ledger set off. First, liability you have to close of previous month, then of next month. Previous month, then of current month. First, you have to give priority to your self-assessed liability, then of officer-assessed liability. So, first priority is to self-assessed liability. Then the priority is to officer-assessed liability. And it is self-assessed liability. First, it is of preceding tax period. Then it is of current tax period. Officer-assessed liability, even though it may pertain to 2 years back, that will be closed only in there. First, you close your own liability, previous period, current period, then close officers assessed liability. When you're talking about liability, it is not only tax, it is also interest, late fees, penalty, etc. All the liabilities. Utilization of credit sequence, we have already discussed that in your ITC chapter. Cash ledger. Important question that ICA asked twice or thrice. Very simple question. It was, even if you see your old ICA middle, the answer was different because amendment was there. That was an exam question, but you cannot rely on that answer because amendment is there. In cash ledger, you have five pockets. Other 4 main pockets, 5 sub pockets. 4 main pockets. They are IGST, CGST, SGST or UTGST or CES. 4 main pockets. 5 sub pockets in each of them. Tax, interest, penalty, fees, others. Totally 20 pockets. Totally 20 pockets. 4 major heads, 5 minor heads. 5. Understand that cross utilization even today is not possible. If I have an amount in CGST penalty, I cannot use it for CGST tax. I cannot use it even for CGST tax liability. Cross utilization is not at all allowed. I repeat, if I have CGST, if I have cash amount in CGST penalty, I cannot even use it for paying my CGST tax liability. But what you can do, you can transfer the amount from CGST penalty to CGST tax, then pay it. I repeat, if I have to pay CGST tax 1 lakh, but if I see my cash ledger is CGST penalty 2 lakhs, I cannot use it. First what I have to do, CGST penalty I have to transfer it to CGST tax, then pay the CGST tax liability. Right? When it is done within CGST, no issues. But if I tell this example, think and answer. If I have liability of CGST tax, but amount is there in SGST penalty, I have to pay CGST tax 1 lakh and I have amount in SGST penalty cash ledger 1 lakh. Let me keep the amount same. First I have to transfer the amount from SGST penalty to CGST tax. SGST penalty to, then close the liability. So when I transfer the amount from SGST penalty to CGST tax, SGST penalty will become 0, CGST tax will become 1 lakh and I have to pay 1 lakh. I can easily use it. But that will be problem between the governments. When I transfer from SGST pocket to CGST pocket, actually I have paid only to state government, but I am using it for paying central government. What will happen? That state government will in the back end pay to central government. I have paid to state government, but I transferred it and used it for central government's liability. So in the back end, that state government will pay to central government, not central government. I paid to whom? I initially paid to state government by depositing in SGST penalty, but I used for paying which liability? Whether central government got anything in cash? No. I just transferred from SGST penalty to CGST tax, then closed my CGST tax liability. I never paid anything in cash to central government. I should have paid in cash to central government. I never paid. I have already paid it to state government, which I have transferred. Now what will happen? That state government will in the back end reimburse the central government. If it is ulta example, the answer would be reverse. Right. So these are all the points, and coming to the last point for which we started this chapter, the most important point, calculation of interest. Interest is on gross liability, that is gross output tax, or net liability, that is output tax minus ITC. Interest is on my gross output tax or net output tax. If my output tax is say 10 lakhs and if my ITC is say 6 lakhs, 4 lakhs, assume that I have paid late. Supposing this is say April month's transaction, I have paid on 22nd June. 22nd June. What was the due date? Normally for April month, what is the due date? 20th of May. So when I have paid actually? So how many days interest will be there? How many days interest will be there? 11 days of May plus 22 days of June, 33 days. So I know that I have to pay interest multiplied by 18% per annum multiplied by 33 divided by 365 on what? Normally it is on 4 lakhs. Can it be on 10 lakhs? Yes, in exceptions. If there is a notice under section 73, 74, thereafter which I am paying, or if it belongs to previous period. If it belongs to, which means April month liability, if I pay late, then it is on net output tax liability. But if April month liability I never report it, I report it in December. Then it is on gross output tax. In 2 cases, it will be on gross output tax. What are those cases? 1, it is after officer is giving me notice under section 73, 74. Obviously, I did not find it out, officer found it out. 2, 1 month's liability reported in next month. Then it will not be on net output tax, it will be on gross output tax. It will be on gross output tax. So that you need to remember. But normally if the question is silent, it will be on net output tax liability. You have to assume that it is not a section 73, 74 case, and you have to assume that it is April month's liability reported in April month. If I tell this April month's liability was reported in May month, then it would have been on 10 lakhs. Though I have ITC of 6 lakhs, though even then I should ignore it, I will pay that interest on 10 lakhs. Are you clear with this understanding? So that is all about your interest calculation, and we have discussed this due date of payment in your return filing chapter. Normally due date of payment is exactly the same as due date of return filing. Exception 1, composition scheme. CMP 08 is 18th after the end of the quarter. Exception 2, QRMP scheme. QRMP, the due dates are different. For the first 2 months of the quarter, it is 25th after the end of the month. For the last month, it is 22nd or 24th after the end of the month, depending on which part of India you are in. Southern India 22nd, Northern India 24th. So that you need to remember. So that is all and all about your payment chapter. Yes friends, now let us quickly complete the last part of payment chapter, where you are talking about one aspect where you are talking about blockage of using your input tax credit or restriction and utilization of your input tax credit. So we're basically talking about 86A and 86B. Rule 86A talks about when your input tax credit will be blocked. Some portion of ITC you cannot touch it. So when you're talking about the grounds on which 86A will be invoked, please understand that the following should be the grounds. Either the credit is fraudulently availed or it is ineligible. So there are certain grounds on which this officer, commissioner or an authorized officer not below the rank of ACDC can invoke that. What are the grounds? Either you're talking about the recipient is not in possession of the document, or the recipient is not in possession of the goods or services. So here you're talking only about the recipient, or the supplier has not paid the tax to the government. So if I am the recipient, I have not received the document, say for example tax invoice, or if I am the recipient, I have not received the goods or services, but I am still availing the credit. That is the situation. Or if I am the recipient, my supplier, you are my supplier, you have not paid the taxes to the government. These are actually the conditions for taking input tax credit also, but they are again brought down here. And if you see the last part, either the supplier, my supplier, you are my supplier, either you or myself, the recipient. So understand that whenever you're talking about the ITC, it is only from the angle of recipient, but now there are certain points that recipient has to take care. He has to have the document, but in this case I may not have the document, but credit is taken. I may not have received the goods or services, but the credit is taken. My supplier has not paid the tax, but I have taken the credit. Or either my supplier or myself, they are non-existent, we are not there, or we are conducting business from a place where registration has not been obtained, which means I am carrying on the business from a place which is not in my registration certificate. Either we are not existent, or I am not conducting business from the place which I am there in my registration certificate. I am conducting business from any other place which is not there in my registration certificate. So these are the 5 situations or 5 scenarios where you are talking about 86A can be invoked. Now who invokes 86A? 86A is either invoked by commissioner or an authorized officer by him, but not below the rank of assistant commissioner. And what actually happens when 86A is invoked? Understand that I cannot use my input tax credit. My credit continuously will be availed. So credit will be added to electronic credit ledger, but I cannot use my credit to pay the output tax, or I cannot use, I cannot claim the refund of the credit which is there in my electronic credit ledger. So understand that credit availment is not stopped. What cannot be done is, the credit which is availed, I cannot use it for paying my output tax, I cannot take the refund, I cannot touch that credit. So my credit intaking is allowed, but my credit utilization or credit refund is not allowed. Now, Till how long this will continue? This restriction will continue as long as the proper officer is satisfied that whatever the reasons were there for dissolving the credit, they are no longer existing. So proper officer is convinced that recipient is having all the documents, recipient has received all the goods, services, supplier has already paid the tax. Either the supplier or the recipient, they are existent and they are doing business only from the declared places of business in the registration certificate. If he is satisfied, he may rule it out, or maximum this restriction can be there 1 year from the date of imposing such restriction, which means this 86A, rule 86A is without any principle of natural justice. So it cannot continue forever. Either once proper officer is satisfied that whatever he thought that the credit is fraudulent credit or ineligible credit, now that is not into existence, he'll remove that blockage, or maximum it can be there only up to 1 year from the date of imposition of such restriction. You need to understand that this 86A, as I said now, there is no principle of natural justice. There is no notice, nothing. Directly officer will tell that no, we feel that you are covered by one of the 5 grounds in 86A and we are blocking one portion of your credit, not the entire credit, one portion of your credit which you cannot use it for paying output tax, or which you cannot even take the refund. Now please understand that 86A, as already discussed, is not disturbing my availment of credit, it is just disturbing my utilization or refund. So that is everything about your 86A. Now coming to your 86B, which is basically restriction on utilization of your credit. So it is talking about restriction. So now you can use your credit. So there's no blockage. You can use your credit, but there's some restriction. Understand that this 86B will hit you only if your taxable supplies. Taxable supplies means supplies not including your exempt supply, not including your zero rated supply. Exempt supply, why you are not counting? Because it will not have any tax. Zero rated supply, again, either you will be paying output tax and getting the entire refund, or you are not paying output tax because you have gone under letter of undertaking or bond. So you are not going to count. You are not going to count your exempt supply and zero rated supply. So you are talking about your taxable supplies, not including the exempt supply and zero rated supply, is more than 50 lakhs in a month. So please understand that 86B will be applicable only if in that month your taxable supply is more than 50 lakhs. Taxable supply, as I said, don't count exempt supply, don't count zero rated supply. Only in that month you have to be worried about 86B. Now understand that what is the restriction they are telling. They are telling that in that month minimum 1% you have to pay by cash ledger. You might have full of credit, you may not even touch your cash ledger, but minimum 1%. If you are paying more than 1%, no worries. If you are paying less than 1% of your output tax by cash ledger, they are asking you to pay minimum 1% by cash ledger. 99% can be paid by using credit ledger. So that they are not worried. At least pay something in cash. So government is telling that please pay something in cash. Minimum 1% you have to pay by cash ledger. Again I repeat, when this will happen, this will not happen every month. Only when the person's taxable supply turnover in a month is more than 50 lakhs. And I'm talking about taxable supplies turnover in a month is more than 50 lakhs. Don't count exempt supply, don't count your zero rated supply. Also, you need to understand that you are not going to take into account your RCM, because when you talk about your RCM is always paid by cash ledger. So don't consider, when you're talking about minimum 1% has to be paid by cash ledger, don't include RCM. RCM, by the way, is not your outward supply, it is your inward supply. So it will not be included in your aggregate turnover or taxable supplies of 50 lakhs. So because you're talking about our outward supply there. One thing, RCM is your inward supply, so nothing to do with your taxable supplies more than 50 lakhs. Second thing, RCM is always paid by cash ledger one hand, and if you are eligible, you will get the credit ledger in other hands. So when they are telling that your payment in cash ledger should be minimum 1%, obviously don't include RCM in that. So RCM is always paid by cash ledger, do not include that calculation there. Now two different things. See in a month whether your taxable supply other than exempt supply, zero rated supply, that is outward supply, sales, is more than 50 lakhs. Yes, then pay minimum 1% of output tax by cash ledger. Balance you can use your credit ledger. And when you're doing this minimum 1% by your cash ledger, obviously your RCM will not be counted because it is not your outward supply, it is your inward supply, always paid by cash ledger. Now please understand that there are some exceptions where this provision is not at all applicable in spite of the fact that your taxable supply is more than 50 lakhs in a month. One, this provision is not applicable to government department, public sector undertaking, local authority and statutory body. So government first has said that we are outside this rule, which means they can use, they can pay their entire output tax liability only by credit ledger. They need not even touch the cash ledger. So for government department, local authority, statutory body, public sector undertaking. Government department, that is central government, state government, local authority, public sector undertaking and statutory body, this provision is not applicable. Or this provision is also not applicable where you are talking about your income tax payment is more than 1 lakh in last 2 financial years. Last 2 financial years where the due date of income tax return has expired. So don't take exactly last 2 financial years. Supposing you are into financial year 22-23. Necessarily last 2 financial years will not be 2021 and 21-22 because supposing you are there in somewhere say August 2022. August 2022 and it is an audit case of yours. So your due date for 21-22 has not yet expired. So if at all you are there in 2022-23 and assume you are there in August 2022 and second assumption you are there in January 2023. So when you are talking about last 2 financial years in the first scenario, it is financial year 1920 and financial year 2021. In Jan 2023, the last 2 financial years symbolizes financial year 2021 and financial year 21-22. Why? When you are starting in the month of August, understand that for financial year 21-22, the due date of IT return is yet to come. So understand last 2 financial years will vary depending on which month you are in. So you're talking about your income tax payment is more than 1 lakh in the last 2 financial years for which the due date has expired. Now understand that whose income tax payment. If at all you're a proprietor, then your individual income tax rate is more than 1 lakh in last 2 financial years for which due date has expired. If you're HUF, either the HUF's income tax payment or Karta. If you are partnership firm, either you're talking about partnership firm or 2 partners income tax payment. If you are a company, either company's income tax payment or managing director's income tax payment or 2 whole-time directors. If you are association of persons or trust, either the trust income tax payment or 2 members of association or 2 board of trustees income tax payment. So to put in a very simple terms, if at all you are a proprietorship concern, if you are a HUF, if you are a partnership firm or LLP, if you are a company, if you are an association of person or if you are a trust, whose income tax payment you are going to check. If you are a proprietorship concern, income tax payment of proprietor you are going to check. If you are HUF, check either HUF's income tax payment or to partner or to rather or Kartas, not partners, or Karta's income tax payment. Either HUF income tax payment is more than 1 lakh in the last 2 financial years for which due date has expired, or Karta's income tax payment is more than 1 lakh in last 2 financial years for which the due date has expired. If it is a partnership firm LLP, so either it is partnership firm LLP or 2 of the partners or designated partners. If it is company, then either it is a company or managing director or 2 whole-time directors income tax payment is more than that amount. If it is AOP, either it is AOP's payment or 2 members of managing committee. If it is trust, either trust income tax payment or you are talking about 2 board of trustees income tax payment. So that you need to understand. Now the next exception where you are talking about in first year 2 you are talking about government department, second your income tax payment, next your refund of ITC, your refund of input tax return is more than 1 lakh in previous financial year. Now understand that again here it is refund of ITC, second more than 1 lakh, but third previous year. So if you are into financial 22-23, you are just looking at financial year 21-22. So here there is no last 2 financial years. Here it is only previous year and directly previous year, whether it is August 2022 or January 2023, previous year for August 22 as well as January 2023. The previous year is financial year 21-22. So refund that you have received is more than 1 lakh in the previous financial year. Refund of unutilized ITC. Refund of unutilized ITC only two persons can get: zero rated supply or inverted duty structure. Right, now there are differences. Here in the previous point where you are talking about income tax payment more than 1 lakh, here it is ITC refund. There it is income tax payment, here it is input tax credit refund. Right, more than 1 lakh, more than 1 lakh. There it is income tax payment more than 1 lakh in the last 2 financial years for which the due date have expired. Here it is ITC refund only in the previous financial year. Don't check anything, just previous financial year. Right, there are multiple permutation combination, either the registered person or so and so, so and so. Here it is only of the registered person. Right, then the fourth point you need to check. This fourth point is a very special point. It is talking about cumulative checking. So in that month your payment by cash ledger may not be 1%, but cumulatively if it is exceeding 1%, cumulatively it is exceeding 1%, in that month you need not apply. So to understand this, let us take this scenario. Supposing your April month's our total output tax liability is 10,000 and credit is 8,000. You have paid 2,000 by cash. May month total output tax liability is 10,000. Input tax credit is 7,000. You have paid 3,000 by cash. Your June month total output tax is 20,000. Your input tax credit is 19,000. You have paid 1,000 by cash. If you look at cash payment, 1% year of 10,000 is your 100 which you have paid by cash. Again 1% of 10,000 is 100 that you have already paid by cash. 1% of 20,000 is 200 that you have paid by cash. You should have paid 100 by cash but you have paid 2,000. You should have paid 100 by cash but you have paid 3,000. You should have paid 200 by cash but you have paid 1,000. So no worries. But when you enter July month, your output tax liability is 5 lakhs. Your output tax liability is 5 lakhs, and you assume that in that month you need not pay anything by cash ledger. You are not required to pay anything by cash ledger because you have sufficient credit. Assume that you have sufficient credit. Your credit is more than 5 lakhs. Now, when your credit is more than 5 lakhs, please understand what is happening. This 1%, this 1% would be your 5,000 you should have paid by cash ledger, but you are paying only nothing by cash ledger. You should have paid 5,000 by cash ledger, but you are not paying anything by cash ledger, which means in the first 3 months 1% was satisfied. Now suddenly 1% is not satisfied. Why? You should have paid 5,000 by cash but you are paying nothing. Now cumulatively you have to check. When I check cumulatively, what is happening? Now I am going to check April to July. My total output tax liability is 5,40,000. So 40,000 April, May, June, and 5 lakhs here, 5,40,000. 5,40,000 multiplied by 1% is 5,400. 5,400. Already I have paid 6,000 by, in the first 3 months itself I have paid 6,000 by cash ledger. So I am satisfying cumulatively from April to July, 1% will satisfy. If I see only and only July month, 1% is not satisfied. But if I see April to July month, 1% is satisfied. I have already April to July total output tax liability is 5,40,000, 1% is 5,400, and in April to June itself I have paid 6,000 by cash ledger. So 1% is satisfied. So that is this exception. And the last exception is not of any use. A proper officer may remove the restriction. If you may approach proper officer and he may remove that restriction. So that's point is that. Now please understand how this actually works. Now take a scenario where your output tax liability is 10,000, input tax credit is 12,000. Assume there is no RCM. First we'll understand without RCM. So your ITC is more than your output tax, but they tell that minimum 1% you have to pay by cash. So what you are going to do, first you decide what you are going to pay by cash. You are going to pay by cash 900 rupees. If this rule was not there, you would have paid entire 10,000 by credit ledger and 2,000 would have been carry forward of your credit. But now minimum 1% you have to pay by your cash ledger, and carry forward of credit will be, normally carry forward of credit would have been 2,000, but now it will be 2,100. How 2,100? Because now when I tell that you have to pay minimum 1% by cash, credit utilization will be only 9,900 and not 10,000. So when my credit was 12,000 and I have used only 9,900, so balance will be 2,100, which is carry forward. So normally what I decide my credit, I use the payment, I make the payment by credit ledger, and then balance I pay by cash ledger. But in this case, first I have to decide, okay, this amount I have to pay by cash ledger. So the balance amount I have to set off in credit ledger. Assume this scenario, I reverse this, I add RCM. So same example, 10,000 is my output tax liability, 12,000 is my credit. RCM is special here. RCM I have to pay 1,000 rupees. Please understand that RCM you pay by cash ledger in one hand, and other hand you get the amount in credit ledger. So now once this is a scenario, in a normal scenario what would have happened? Normal scenario, RCM I would have paid 1,000 by my cash ledger, and I would have got 1,000 in my credit ledger. So I would have paid it by cash ledger and got it in my credit ledger. And normal scenario, when I'm talking about my output tax and my input tax today, my output tax was 10,000. I had ITC of 12,000. I'll be using only 10,000. So I need not pay anything by cash. Now what is my payment by cash ledger? My payment by cash ledger is 1,000 plus 0. So my total payment by cash ledger is 1,000 is by cash ledger. What is the amount which is left in my credit ledger? My credit ledger was 12,000, which was there, plus RCM will be added to my credit ledger, and balance out of this total 13,000 I have already used 10,000. So my credit balance will be 11,000. It will not be, sorry, my credit balance will be 3,000. It will not be 2,000. How? I had 12,000 credit, 10,000 I have used it, so 2,000 left over. Also understand that RCM I will make the payment by cash and I will get in my credit ledger. So that also will be added to my credit ledger. But now what they are telling? They are telling no, this should not happen. You have to pay minimum 1% by cash ledger. So they are telling that what is your RCM? RCM will not change. Your RCM will not change. No change in RCM. So RCM you have to pay 1,000 by cash ledger and get 1,000 in credit ledger. So this will remain the same. But your output tax and input tax, you had 10,000 to be paid, and you have to make sure that 1% you pay only by cash ledger. So 1% will be paid only by cash ledger. So how much of credit will be utilized? Only 9,900. So now how much I am paying by cash? 1,000 is of RCM and 100 is of output tax. I am paying 1,100 by cash ledger. How much will be there in my credit ledger? I had 12,000 plus RCM 1,000 is added, minus how much I have utilized. I have used only 9,900 because I have to pay 100 by cash ledger. So now it will be 3,100 will be carried forward. So my cash ledger payment will be 1,100. My credit ledger will be increased. So it's not 3,000 now, it's 3,100. So that is explained how this 86B actually works. So that is all about your 86A and 86B. We'll start with our written filing chapter. Now, written filing chapter, we have made it very simple by comparative analysis. What are the different types of persons who are required to file different types of returns? So, first category, we have periodical returns. And another category which will be there is your other special returns. Other special returns. So, first we'll talk about normal returns, periodical returns. Now, who are all taxpayers in your GST? Who pay taxes actually? One is regular taxable person, one is composition taxable person, one is CTP. CTP will always come along with regular taxable person. One is NRTP, one is OIDRS from outside India, non-taxable territory to a non-taxable online recipient. Foreign company paying taxes in India under FCM. Right? These are all taxpayers. Then you have something called as tax distributors. Tax distributor, ISD, will take credit, pass on credit. Take credit, pass on credit. Nothing more. Tax debtor, you have GST, TDS. Tax collector, you have GST, TCS. GST, TCS. Now, when you talk about the reference, section numbers, rule numbers are given, we will not focus on that. When you talk about the returns, when you talk about your regular taxable person including CTB, they file GSTR 1 and 3B. They file two returns, GSTR 1 and GSTR 3B. Normally the frequency is monthly. But it can be quarterly as well if at all you are under QRMP scheme. Normally the frequency is monthly. It may be quarterly if you have opted for QRMP scheme. Right. Then you have composition taxable person who will file again two returns. One is CMP 08, which is quarterly payment, and GSTR 4, which is yearly return. Oh, it is unlike 1 and 3B. 1 and 3B will be each month or each quarter. Here it is CMP 08, first on quarterly basis for payment. CMP 08 is basically for payment, not a return. And GSTR 4 is yearly return. Then you have NRTP who will file GSTR 5, monthly return. Then you do have OIDRS who will file GSTR 5A. 5A, A stands for automatic. Automatically details will be there. Right, based on the software that they use, automatically details can be easily extracted. Monthly return. Then for tax distributor and tax detector, tax collector, you have GSTR 7, GSTR 6, 7, 8, and all are monthly returns. They don't pay taxes. They own taxes. TDS and TCS, there will be taxes but not their taxes. It is tax of some other person. Just like your income tax TDS and income tax TCS. Method is the same but concept is totally different here. Now, what is the due date? Now, when you talk about due date, regular taxable person and casual taxable person, we are talking about monthly due dates. Quarterly due dates will take it separately under QRMB scheme. Monthly due dates will see. Monthly due date for GSTR 1. Monthly due date for GSTR 1. 11th of next month. GSTR 3B, 20th of next month. This we are talking about a scenario where you are going for MRMP scheme. Monthly return, monthly payment. Monthly due date. Right. What about QRMP? We'll just take it as a separate discussion. We are not touching this QRMP scheme here. Now, composition taxable person, CMP 08, quarterly payment. 18th after the end of the quarter. 18th after the end of the quarter. And yearly return, GSTR 4, 30th April after the end of the financial year. 30th April after the end of the financial year. NRTP, very special. NRTP, monthly return, 20th of the next month, which is basically the same. Or 7 days after the end of registration certificate, whichever is highly possible. That for 2 months. For 2 months you have the same due date. For 2 months you have the same due date. So highly possible. So just remember this. 28th after the next month or 7 days after the end of registration certificate, whichever is earlier. So highly possible for the last 2 months of their registration, they have the same due dates. OIDRS, normal answer, 20th of the next month. 20th of the next month. ISD, we have already discussed, it is 13th of the next month. TDS, TCS, 10th of the next month. 10th of the next month. Now, one important question comes up. If they don't have transaction, should they file their nil returns? Mostly yes, but not all for all the cases. 1 and 3B, you have to file nil returns even if you don't have transaction. CMP 08 and GST 4, you have to file nil return even if you don't have transactions. NRTP, GST 5, same answer, even if you don't have transaction, file nil return. OIDRS, same answer, even if you don't have transaction, file nil return. ISD, even if you don't have any distribution, file nil return. But for TDS and TCS, only if that is TDS and TCS, you have to file returns. You need not file nil returns, very similar to your income tax, isn't it? If there is no TDS or no TCS in a particular quarter, you are not required to file any TDS return or TCS return. Very similar to your income tax. So for nil, earlier if you recall 5-6 years back, I'm sure that you would not have started your internship. But there were scenarios where in income tax, even if you have no transaction, you are required to file nil TDS, nil TCS return. Now it is not there. So it is very on similar line of your income tax. Now what are the late fees? What are the late fees that you have to pay? 100 rupees. If you file late, what are the late fees that you are required to pay? 100 rupees per day or maximum of 5,000, which means whichever is lower. CGST late fees, copy paste, SGST late fees. So this is CGST late fees, copy paste, SGST late fees. Same. But understand that there is no late fees for CMP 08 for a very simple reason that CMP 08 is not for return, it is for payment. If you are doing it late, interest will be there. Interest will be there. Are you clear with this understanding? But wait, again, another area where you can expect questions is late fees, because this is the basic late fees which is now rationalized. When I tell which is rationalized, they have reduced the late fees. Normal answer is rupees 1,100 per day subject to a maximum of 5,000. CGST late fees, copy paste, SGST late fees. But there is reduced late fees for your GSTR 1 and 3B. What is the reduced late fees for GSTR 1 and 3B? Same concept, rupees 100 per day, but if it is nil return, maximum can be 250. So maximum is not 5,000, maximum is, this is CGST late fees, copy paste, SGST late fees. If it is not nil return, other than nil return, you have to see aggregate turnover in previous year. Up to 1.5 crores. Then maximum can be, which means rupees 100 per day, maximum of 1,000. CGST late fees, copy paste, SGST late fees. If it is more than 1.5 crores but up to 5 crores, rupees 100 per day subject to a maximum of 2,500. CGST late fees, copy paste, SGST late fees. If it is more than 5 crores, previous year aggregate turnover, then normal, rupees 100 per day subject to a maximum of 5,000. Right? So they have given on the basis of first categorization is nil, normal. If it is nil, do not see previous year aggregate turnover. Maximum is 250. Rupees 100 per day subject to maximum 250. If it is normal, rupees 100 per day subject to maximum of 1,000 or 2,500 or 5,000 based on aggregate turnover. Up to 1.5 crores, 1.5 crores to 5 crores, more than 5 crores. If it is composition taxable person, GSTR 4, then if it is nil return, 250. If it is normal return, see, understand that it will be obviously less than 1.5 crores because you are under composition scheme. You need not buy at it separately. Here there's no categorization of previous year aggregate turnover, but obvious, if you are under composition scheme, your previous year aggregate turnover could not have crossed. So don't try to buy art and all. It's 1000. First slab only is relevant, so it is 1000. And when you're talking about your GST as 7, tedious. Here, be very careful. Normally, rupees 100 per day remain the same, but here they change even that. It is rupees 25 per day, subject to a maximum of. See, in all other places, rupees 100 per day they do not change. They change in only the upper limit. Here, they have changed both. Rupees 25 per day, subject to maximum of 1000. So this is only for tedious, not for TCS. Only and only for tedious. Are we clear with this rationalization of rate fees or reduction of late fees? Wherever you may ask what about other returns? When for other returns there is no relaxation, you will go with what? Rupees 100 per day, subject to a maximum of 5,000. Whichever is lower. Subject to maximum of 5,000 means whichever is lower. Now, due date of payment. Due date of payment is connected with due date of return filing. So due date of payment, again we are discussing only for monthly scheme when you talk about regular taxable person and casual taxable person. Due date of payment is due date of GSTR 3B. Due date of GSTR 3B. Which means 20th of next month. If that due date of 3B is extended, this due date of payment is automatically extended. Due date of payment for regular taxable person and casual taxable person. Due date of payment for composition scheme we already discussed. CMP 08, 18th after the end of the quarter. Due date for NRTP. Due date of return filing and due date of payment is exactly the same. Even for OIDRS, due date of return filing and due date of payment is exactly the same. ISD, you cannot have any payment. TDS, TCS, due date of return filing and due date of payment is the same. So it is the same. Actually, due date of payment and due date of return filing is different in QRMP scheme. Because if I see this line, if you go through this line, you will tell that automatically it was covered. Then why this line? It is different for your QRMP scheme. Now why this due date of payment is relevant? Because only based on your due date of payment, you will have interest. For late payment, you will have interest. Right. Next, filing by SMS. Can you file by SMS? Automatically, mobile phone message is sufficient. Yes, but two conditions, it should be a nil return, and this is facilities available only for 1, 3B and CMP 08. Even for nil returns, it is applicable only for 3 cases, 1, 3B and CMP 08. If it is GSTR 4 nil return, go to portal. GSTR 5 nil return, go to portal. 5A nil return, go to portal. 6 nil return, go to portal. 798 nil return, you need not file it. 798 nil return, you need not even. So forget about SMS or go to portal. Are you clear with this understanding? Are we clear with this understanding? So that you need to understand. Now, if at all you are a non-filer, whether you will be given a notice. Yes, if you don't file your return on time, you will be given a notice which you have to, and after you are giving notice, you have to file within 15 days. So if you are not filing your returns, after some time you may get a notice. The moment you get a notice, file all the pending returns within 15 days. After you get a notice, even after 15 days, if you don't file the return, best judgment assessment will be done by the officer. So you will get a notice if you are not filing your returns. The moment you get a notice, be very cautious. File all your pending returns within 15 days of notice. If you are not complying with that, officer may initiate best judgment assessment. But this notice concept, notice will not come for your GSTR 1 and CMP 08. CMP 08 notice will not come because it is not about return filing, it is about payment. GSTR 1, government is happy if you don't file GSTR 1 because opposite party person will not get any. Think of it. Government tells that I am not worried. Don't file your GSTR 1. I am very happy. Why? Opposite person will not get credit. So when you read this again and again, you understand, oh, government has done this purposefully. First you will feel that, okay, by mistake government has missed this out. Then you realize, no, it is done purposefully. So government is least bothered. Why should I give notice? I am very happy. When I am happy, why should I give notice and bring to your attention that you file GSTR 1, your opposite person is waiting for credit. Why should I do that? The recipient will fight with you. Why should I bring my minds there? No. Again, this here also you will find funny thing about GSTR 1. Again, in the next point. Normally, if you don't file your previous month return, you cannot file your current month return. Which means, normally, if I don't file GSTR 3B of April, I cannot file GSTR 3B of May. If I don't file GSTR 5 of April, I cannot file GSTR 5 of May. If I don't file 5A of April, I cannot file 5A of May. If I don't file 6 of April, I cannot file 6 of May. Likewise. 7 and 8 is not applicable because nil returns, you need not file it. So you have to understand that. But it is implied. But for GSTR 1, it is very peculiar. Even if you don't file your GSTR 1 of April, you can file GSTR 1 of May. So this point is not applicable for GSTR 1. GSTR 1. But GSTR 1 is connected with 3B. Look at the understanding. They are telling that I can file my GSTR 1 of May without filing GSTR 1 of April. Without filing GSTR 1 of April. Government is not, government is okay. April you have missed out, I am happy. May you are filing, okay, I am not happy but you can file. April you have missed out, but I am May. But what they do? They tell that if you don't file GSTR 3B of preceding month, you are not allowed to file GSTR 1 of current month. Why? If you are not filing GSTR 3B of previous month, you are not paying your taxes. If you are not paying your taxes, the government is not allowing you to file GSTR 1. If they are not allowing you to file GSTR 1, opposite person will not get the credit. He will call you, he will call you to file your GSTR 1, but you can file GSTR 1 only after you file 3B, which means you have to make payment first, file 3B, file 1. You are getting the point? Normally, a return of previous month has to be filed for filing the return of the next month. But this is not applicable for GSTR 1. For GSTR 1, an indirect connection is established. How indirect connection? I don't file April month GSTR 1, I can still file May month's GSTR 1. But if I don't file April month's 3B, I cannot file May month's 3B, I can also not file GSTR 1 of May. Are you clear with this understanding? So that is the way that they lock me. Now, if at all there are any errors or omission, repeatedly asked point, can I rectify them? Yes, I cannot file revised return. I cannot file revised return. Revision is not possible in GST, but I can rectify them. But there are two conditions. These error or omission should not be found by the officer. Should not be found by the officer. And it should be rectified within the time limit. What is the time limit? Due date of September month of next financial year or actual date of annual return of that financial year, whichever is. So, when you talk about error or omission, point number 1, revision not possible. Point number 2, rectification possible. Two conditions for rectification. 1, you should find out the error or omission, not the officer. 2, it should be done within the time limit. It should be done within the time limit. Are we clear with this particular understanding? Right. And the last point which is given here is all about switching over from composition scheme to regular scheme and switching over from regular scheme to composition scheme. You will have doubt what returns I have to file. So when you are talking about your regular scheme, you are under regular scheme, you are filing 1 and 3B. Now you are switched over to composition scheme. Now you are switched over to composition scheme. So first you are under regular scheme. Now you are under composition scheme with effect from say 1st April of next financial year. Now till March I was under regular scheme. Actually composition scheme I can enter only 1st April of next financial year. Understand that I have still 1 and 3B pending. I have still 1 and 3B pending. the last date to file my 1 and 3B is due date of September month return or actual date of annual return, which was earlier. Which means I can file 1 and 3B of previous year up to March till that date. Why this point is given? This point is few people will file their returns late. Those who are filing their returns late, they should be aware that they can file their 1 and 3B only up to a particular point, after which portal will not allow. Till what time? Due date of September of next financial year or actual date of, because after March you will never file 1 and 3B. From April onwards you will file CMP 08 and GST 4. So they are talking about their old returns. So if you are filing late, no worries. You pay interest, you pay late fees and file late returns and make late payment. But you should do within due date of September of next financial year or actual date of filing of annual return of that financial year, whichever is earlier. Whichever is earlier. You are getting that particular point. So this is a special point therein. Now, ulta scenario. You are switching over from composition scheme to regular scheme. Say from 15th number. You can go outside composition scheme in between of a year. Now when you do that, understand that when you have walked out 15th number, in between 15th number. So 15th number is in between of a quarter. In between of a, understand that even for the part of the quarter, the due date remains the same. See, April to June, you have to file CMP 08 on or before 18 July. July to September, CMP 08, 18th October. October to 15th November, CMP 08. CMP 08. 18th of Jan. Though it is part of the quarter, due date remains the same. Now, I am under composition scheme, not for the full year. I am under composition scheme only for 1st of April till 15th of November. Still, my due date for GST 4 remains the same. 30th of April of next financial. See, what are they trying to tell? Even though in between you have exited composition scheme, due date of CMP 08 and due date of GST 4 remains the same for part of the quarter or for part of the financial year. No change. No change. Are we clear with this understanding? Are we clear with this understanding? So that is all about that switch over concept. Obviously, November month I will also file 1 and 3B. From 16th November, I will file GST 1 and 3B normal. So for part of the month I will also file GST 1 and 3B. So that is under normal scheme. So that is everything about your due dates of various types of returns and other concepts. Not only due dates, we have discussed various other concepts related to different types of return filing. Now, when you are talking about your regular taxable person and casual taxable person, they have an option to go for QRMP scheme. They have an option to go for QRMP scheme. But, can everyone go? No. If my previous year aggregate turnover is up to 5 crores, only then in current year, only then in current year, I can go for QRMP scheme. And a very interesting point, QRMP scheme is GST Invoice. Normally in different places we have understood different concepts, so here we will be tending to go by that concept. Which means if I am registered in 2 states, one state I can go for QRMP, one state I can go for MRMP. One state I can go for QRMP, one state I can go for MRMP. You getting that point? Quarterly return, monthly payment, one state. Another state, monthly return, monthly payment. Payment is always monthly, by the way. Are you clear with this understanding? But for me to be eligible, whenever there is a concept, is it aggregate turnover or state turnover? Whenever there is a conceptual point, it is pan-India, aggregate turnover should be up to 5 crores. So that is the first condition. Second condition, I have to opt in. I have to opt in. That's another. For entry, there are 2 conditions. First, previous year aggregate turnover. Previous year aggregate turnover. That's one more condition. When I opt in, that's a time. In that time frame only I have to opt, only then portal will open. What is that time? I have to opt in for your QRMP scheme between first day of the second month of previous quarter. First day of second month of previous quarter. Last day, first month of current quarter. Let me make it very simple. If I want to go for QRMP scheme from January, first day of second month of previous quarter means 1st of November. 1st of November till last day, first month of current quarter, 31st of Jan. So if I want to go for QRMP for Jan to March quarter, I have to opt between 1st November to 31st of Jan. This is the window. This is the window that I get. Why this window? If you understand due dates, you will understand that windows are carefully designed. Because after 31st of Jan, automatically portal will show me monthly 1 and 3 week. Right, so this is the window that they give me to opt. And whenever I am opting, I should not have any pending returns. I should not have any. There should be no pending returns. Supposing I am opting on say 22nd of Jan and my December return is not yet filed, I cannot opt. On 25th of Jan, I file my December return. Then I can go for QRMP. Till 31st of Jan, I did not file my December return. I cannot go for QRMP for Jan to March quarter. So condition number 1, previous year aggregate turnover up to 5 crores. 2, that's a window. Previous first day, second month, previous quarter, last day, first month, current quarter. And in that window, whenever I am opting, whenever I am going, I should not have any pending returns. I should not have any pending returns. Otherwise, portal will not allow me. Can I go out of QRMP scheme? Yes, this is all about entry. This is all about entry. So whatever we have discussed was all about entry. Now we are talking about exit. Yes, I can go out. Optional opt-out. Optional opt-out means I am satisfying all the conditions but still I am not happy with QRMP scheme. What I will do? Again, window is the same. Window is the same. What is the window? First day of second month of previous quarter, last day of first month of current quarter. So if I want to opt out of QRMP scheme from April, I have to select between 1st of February till 31st of May. Opt out. This is optional opt out. One is mandatory opt out. What is this mandatory opt out? Mandatory opt out means I am not opting out. Portal is throwing me out. The moment my current year aggregate turnover exceeds 5 crores. Supposing current year aggregate turnover exceeds 5 crores on 28th of Feb. I am automatically not thrown out immediately. From next quarter onwards, April onwards, I will be outside QRMP scheme. See, in between, if my turnover is crossing 5 crores, even for that quarter I can be under QRMP scheme. From next quarter onwards, I will be thrown outside QRMP scheme. Right, so this is an example that is given below. Whatever we have discussed is given in form of an example. So if at all I am registered newly on 1st of February and my previous year aggregate turnover is up to 5 crores. I want to opt for QRMP scheme for Jan to March. Can I opt? No. Why? My registration is from 1st of Feb. And if I want to opt for Jan to March QRMP scheme, it should be done between 1st of November till 31st of Jan. So I cannot go for QRMP scheme. That window is closed. Though I am newly registered, but unfortunately, if my registration came on 28th of Jan, I could have gone for QRMP scheme. Right. From next year, for next year, April to June, I want to go for QRMP scheme. Can I go? Yes. What I should do? I have to opt from 1st February of 1st February to 30th April. And when I am accessing the option, I should not have any pending returns. I want to continue for QRMP scheme for the next quarter. When you are continuing, there is nothing to be done. For continuation, you are not required to do anything. assuming that I want to opt out from QRMC scheme October to December. If you see, this registered person wants QRMP scheme in quarter 1 and quarter 2 and he wants to go outside regular scheme in Q3. He is not interested. Is it mandatory opt-out or voluntary opt-out? So voluntary opt-out means I should go for opting out between 1st August till 31st October. Optional means I have to do something. I'll be under regular scheme. Next quarter, which is Q4, I want to go for QRMP scheme. The question is very clear. For Q1, Q2, I want to go for QRMP. For Q3, MRMP. For Q4, QRMP. But wait, the question tells that my aggregate turnover crosses 5 crores on November. So when it crosses 5 crores on November, from next quarter onwards, even if I want, I cannot think of QRMP. Now, I want QRMP for Jan to March, but I cannot. Because my aggregate turnover has crossed 5 crores in previous quarter. Next year, can I go for QRMP scheme? No. Why? Because in my previous year, the aggregate turnover was more than 5 crores. I have to be happy only with MRMP scheme. And that is all about your opt-in and opt-out. Now I'll make things very simple. Right. So you're talking about your MRMP scheme and your QRMP scheme. MRMP, QRMP. I'll have a comparative analysis. So if at all you're talking about IFF, GSTR 1, payment, GSTR 3B. Again, here also you have all the 4. IFF, GSTR 1, payment, GSTR 3B, QRMP. MRMP, you don't have the concept of IFF, isn't it? Supposing if you're talking about April month, May month, June month, tell me the due dates. In MRMP scheme, I will never have IFF. Invoice furnishing facility is not there in MRMP. It is there only in QRMP. What is the due date for GSTR 1? 11th of May. For May, 11th of June. For June, 11th of July. Payment and GSTR 3B same due date. 20th May, 20th June, 20th July. If at all I am under QRMP scheme, then my due date for IFF 13th May. Extra days 13th May, 13th June. 8. In the third month, tell me no IFF, it will be only GSTR 1. It will be only GSTR 1. Again 13th, no 11th. So when you're talking about your QRMP scheme, whether it is IFF or GSTR 1, it will be only 13th. That benefit is retained. 13th of July. 13th of July. For the first 2 months, IFF. For the last month, GSTR 1. Quarterly GSTR 1. Payment is different. 25th of May. For April. 25th of June. For May. And final payment will be along with GSTR 3B, which will be 22nd or 24th of July, depending on whether you are in northern India or southern India. Southern India at 22nd, northern India 24th. You're getting the point? 3B will be finally. Payment also will be there last. But payment and 3B will be together then. Will be together then. Are you clear with this understanding? Are we clear with this understanding?
Yes, sir.
Alright, so this will be strictly that. Now IFF, what is invoice furnishing facility? Certain special points about invoice furnishing facility. Certain special points about invoice furnishing facility. It is optional. It is optional. You cannot file after due date. Therefore, there cannot be any late fees. It will only include only B2B. And the maximum value can be only 50 lakhs. So there are restrictions. Many people will not even opt for QRMP scheme because of all these unwanted restrictions. It is optional. I need not file it. If it is optional, there cannot be any due date. There is no late. The due date is there. But if after that date you cannot file, there cannot be any late fees. You cannot file it after due date. You cannot file it after due date. Therefore, question of late fees is ruled out. And it will only include B2B. And maximum value that can be there only 50 lakhs. You may have a doubt. What if there is B2B 80 lakhs? You include it in next IFF or pending portion you include it in quarterly GSTR1. What if there is that B2C? You finally include it only in GSTR1. Whatever is reported in IFF of April month and June month will not be reported, April month and May month will not be reported in quarterly GSTR1. Leftover portion. There may be something left over of April month's IFF, May month's IFF. It may be part of B2B, B2C is fully left over. It will be automatically come in quarterly GSTR1. So that is all these points that you have to take care. Are you clear with this understanding? Payment. When you talk about payment, first 2 months payment is 25th May and 25th of next month, 25th of next month, first two. Now here you can go for two methods. Self-assessment method, that is output minus input, or fixed sum method. Whichever you want. But finally when you pay for quarterly, it is only and only self-assessment method. It is only and only self-assessment method. So this chart will make a lot of points very simple. Very simple and basic. Right. So I am not taking all these points. When you talk about your GSTR1, IFF, I have covered all these points. When you talk about your payment, yes, I need to cover these points because you are talking about for the first 2 months you have option either self-assessment or fixed sum. Either self-assessment or fixed sum. Self-assessment is nothing but output minus input. What is fixed sum method? Fixed sum method, it is only applicable for first 2 months of a quarter. For last month, for the entire quarter you have to do self-assessment. Not only for last month, for the entire quarter you have to do self-assessment. Now what is fixed sum method? Fixed sum method is a rough percentage. Rough percentage. If your previous return was quarterly, then you have to pay 35% of cash liability that you have paid in the previous quarter. They tell that, see, previous quarter was your QRMB scheme. So you have to paid something in cash liability in previous quarter. Take that and multiply by 35% because you are paying for a month. So 1 month will be equal to 33.33%. So they tell that let us not go with 33.33%, we'll make it 35% cash liability. If you are in your previous quarter you are under MRMB scheme, then you pay 100% of cash liability of the last month of the previous quarter. Now your base is not quarter, your base is month. So when your base is month and you are paying for a month, it is 100%. When your base is quarter but you are paying for a month, your base is 35%. Your base is 35%. And one condition for fixed sum method is, see, you are taking the base as previous quarter or previous month. That should be full quarter or full month as the case may be. Complete tax period. Because you are going for approximation. So your previous quarter cannot be only November and December. It should be right from the beginning, October to December. if it was under QRMP scheme, or your previous month, that is if you are in Jan month, previous quarter is October to December, previous month if you are under MRMP scheme is December. So if your previous quarter was under QRMP scheme, the base is October to December. It should be complete. The transaction should be right there from 1st of October to 31st of December. But if your previous quarter you are under MRMP scheme, now the base is December month. You should have worked throughout 1st of December to 31st of December. So that is because it is approximation. Quite logical, this point is there. Now payment is not required. You need not make the payment. Very logical points. If there is nil tax liability, if under regular self-assessment method itself you are getting 0, why you are going for FSM? Because it is 0. Or if you have adequate balance in your cash ledger credit, if you have adequate balance in your cash ledger credit ledger, why you are paying extra? If you see that this should be the liability and adequately you have that amount in your credit ledger or cash ledger, as the case may be, you need not pay extra. And whatever you are paying, you cannot go for refund until you file your quarterly GST or 3B. Because that is now timing. It is not fully settled. Normally, if you pay anything in cash ledger, you will get the refund immediately. If you want, you can apply for refund. But here, if you are paying under QRMP scheme for the first 2 months, whatever you are paying, you cannot touch it till you file your quarterly GST or 3B. After that, if you have any surplus, you claim it as refund or you can take it over to next tax period. Right. So that is everything about your QRMP scheme. Everything to know about your QRMP scheme. Right. Obviously, when you talk about your QRMP scheme, there is an example which is given here. Whatever we have discussed is given in this example. Maybe interest portion I will take here. I will not explain the entire example. Interest portion I will try to explain. Now, interest portion, I can go for FSM or SAM, self-assessment method. First 2 months I have an option. I am only focusing on interest. I am not focusing on your IFF, GST. I have explained it very clearly. If you see the example, you will automatically understand. Now, let us see this Jan month. My output tax was 10.8 lakhs, ITC is 6 lakhs. What would have been my tax liability under self-assessment method? It would have been 4.8 lakhs, correct? 4.8 lakhs. For Jan month, I should have paid before 25th of Feb. What if I went for fixed sum method? Assuming for fixed sum method, they should give me extra information, correct? So they have given me extra information that October to December month I was under QRMP scheme and tax paid to cash ledger was 10 lakhs. So what will be the amount? It will be 35% of the last quarter cash liability, which is 3.5 lakhs. I have to pay by 25th of Feb, which is beneficial. Going for self-assessment method or fixed. This is beneficial. I can plan my cash payments. I will go for fixed sum method. Next month my output tax liability is 11.7 lakhs and input tax is 11 lakhs. Self-assessment method I will end up paying only 0.7 lakhs. I have to pay before 25th of March. We are talking about now Feb month. But if I go for fixed sum method, 35% of previous quarter, which is 10 lakhs, 3.5 lakhs. Now, which is beneficial? Self-assessment or fixed sum? Self-assessment is beneficial. I can do. But when I go for the last month, assuming I am not going with the example which is given here, it is assumed that I am going for same method throughout. Finally, it is explained. Finally, if you see this note in yellow color, it is explained how should I select. I am directly explaining that point. So, first month I went for FSM, which is more beneficial. Second month, self-assessment method. Now, third month when I enter, March, my output tax liability is 16.56 lakhs, ITC is 16 lakhs. I will not see only March. I will see Jan to March now. I'll see Jan to March. What is my total output liability? Total output liability 10.8, 11.7, 16.56. Someone use calculator. This is output tax liability. What is my input tax credit? 6 lakhs, 11 lakhs, 16 lakhs. So my input tax is 33 lakhs. My output tax is 28, 38, 38, 39 point. So finally I should pay. For the last month I don't have an option. I have to go for a self-assessment method for the entire, not for that month, for the entire quarter. So what should be the tax that I should end up paying? It should be 6.06. Out of the 6.06, I have already paid 3.5 and 0.7. 3.5 and 0.7. So which means I have already paid 4.2. So I have to pay only the balance. 1.86. I have to pay only this much amount. Are you getting this particular point? Right. So this is the way I need to work. What about interest then? What was my due date for the first month? I had to pay 3.5 lakhs, which is more beneficial for me on or before. If I don't pay before that, from the next date interest will start 18% from the next date till I make the payment. For the second month, what was more beneficial? 0.7 lakhs. I had to pay this on or before 25th of March. If I pay before that, okay, well and good. If I don't pay, from 26th of March till I pay, I have to pay interest at the 18%. Now what is the final payment I need to make? 1.86. The due date is 22nd or 24th of, sorry, it's April, right? You're talking about Jan, Feb, March. Depending on southern India, 22nd, northern India, 24th. So I have to decide. I have to decide and take a call. Which one is more beneficial and go for the same. Go for the, if I don't pay before this due date, on this 1.86 lakhs, I'll end up paying interest. Interest is normally only on the cash ledger. Normally, only on the cash ledger. Are you clear with this understanding? So I said initially that a question worth 6 marks can be beautifully asked. Giving the data for the entire quarter, asking you whether what is beneficial to go for fixed sum method or self-assessment. We are giving you the data even for the actual date of payment, trying to work out in even interest. Even interest. Right. So this is all about your QRMP scheme. QRMP scheme. 2A to B, a detailed discussion is given. One thing you need to understand, 2A is dynamic, it keeps on changing. 2B is static, it freezes. Whether you download on the same day or the next day or afterwards, it is freezed. 2A has got extra information. What are the details that 2A will contain? 2A will contain whatever your supplier has filed in GSTR 1, GSTR 5, that is regular taxable person, casual taxable person, NRTP. In GSTR 6, ISD, 7 and 8, TDS, TCS, import, SEZ. That will be there in 2A. 2B will contain all these details except that cash ledger portion. So whatever your supplier has filed in 1 or 5 or 6 or import of goods, SEZ, everything will be there. Credit portion alone will be there. Cash ledger details will not be there. See, TDS filed by the opposite person, TCS filed by the opposite person will come and sit in your cash ledger. So that will not be there in your 2B. What you have to do while filing your 3B? Whether 2A is relevant or 2B is relevant? 2B is relevant. 2A will be relevant when you are filing your annual return. So what is relevant is 2B. 4A. 4A is relevant for composition taxable person. Not that much. whatever their supplier has filed in their 1, 5, 7, it will come. Moreover, for them it is not at all relevant because they cannot take the credit. They cannot take the credit. 6A will come for ISD. ISD will get the invoices from some suppliers, right? So that 6A will be received by ISD based on the supplier filing is GSTR. So that alone you have to understand, and thereafter all the details. This outward supplies, inward supplies, all the details will be there. Rather, basically it is inward supplies that will be fetched in your 2A and 2B. What is relevant for your filing of 3B is GSTR 2B, not 2A. You are required to see 2B, which is static, not 2A, which is dynamic. To make one thing very, very simple, one simple example. April month's return, my supplier may be under a QRMB scheme or MRMB scheme. Maybe he may file GSTR1 or IFF. Right? If they have filed their GSTR1 within due date, that is before 11th, IFF within due date, that is before 13th of next month, I'll get in my 2A as well as 2B of April. 2A as well as 2B of April. If you have filed after the due dates, in 2A it will go and again sit in April, but in 2B it will go maybe in May or June depending on when you have filed. So that understanding you need to have. Right, so that is explained, this entire discussion, what is relevant, what is not relevant, and the examples that are there is given below. Not at all relevant. The crux of that we have discussed now. The crux of that we have discussed now. Now, something more about your GSTR 1. Now, when you talk about something more about GSTR 1, you will be giving the details of outward supplies. Even IFF, you will be giving the details of your outward supplies. So, when you talk about outward supplies, if it is B2B, you have to give it invoice wise, whether it is intrastate or interstate. If it is B2C, then if the invoice value is more than 2.5 lakhs, first we are talking about interstate, more than 2.5 lakhs, invoice wise, up to 2.5 lakhs, state wise consolidated. For each state, Tamil Nadu to West Bengal, B2C consolidated. Tamil Nadu to Maharashtra, B2C, one line item. Tamil Nadu to Maharashtra, B2C, one line item. Right. But if it is intrastate supplies, that is Tamil Nadu to Tamil Nadu, you don't check whether it is more than 2.5 lakhs or up to 2.5 lakhs, one line item. Actually, B2C is simple. Same state, forget about 2.5 lakhs or more than 2.5 lakhs, one line item. Other state, for each state, you have to check. If it is more than 2.5 lakhs, line wide, invoice details. For all the invoices up to 2.5 lakhs, each consolidated one line item, state wise. You need to give that. Right. So that completes your normal returns. Now you are talking about your other returns or special returns under GST. One is your first return. One is your final return. First return has got no special number. We will understand why. And final return GSTR 10. One is your annual return 9, 9A, 9B. 9C is an attachment. One ITC 04 which you have done thoroughly when we saw job worker, and one written by UIN, that is International Bodies Holding Unique Identification Number, GSTR 11. Now when you talk about who is required to file first return, first return is required to be filed by every registered person who is registered for the first time. First time. Normally, first return was there only when you are registered for the first time, from the date on which you are liable for registration till the date registration is granted. Now, after few years of GST, they thought that first return is required even in one more place. See, I will tell this in a very simple way. First return is in two cases: birth, rebirth. This is birth. From the date you are liable for registration till you are getting the registration. Rebirth, from the date your registration is suspended till again when it is made activated. Revoked. Suspension is revoked. So that is first. First return is not a separate return by itself. It can be your 1, it can be your 3B, it can be your 5, 5A, 6. It can be any of these returns, it is filed for a few months together. Filed for a few months together. That is first return. It is not a separate return. It is not a separate return. Therefore, when I tell it is not a separate return, there cannot be any due date separate. Whatever is applicable for 1, 3B, it is applicable for first return year also. What is applicable for 4, it is applicable here. So, same wise you have to understand. How many cases you have first return? New registration, suspension of registration revoked. Right, birth, rebirth. Final return. It is a separate return by itself. GSTR 10. GSTR 10. It is a separate return by itself. Now you need not remember who are not required to file. You remember in this way, who are required to file. Who are required to file? Regular taxable person, casual taxable person, NRTP not required, composition taxable person not required, all these persons not required, OIDRS from non-taxable territory to non-taxable online recipient. These 3 persons are required to file. These 3 taxpayers are required to file. Now, what is the due date for them? First, is it a routine one-time activity or multiple time activities? First return, also it is very rare, but 2 cases. Final return, only 1 case. What is that? Cancellation of registration. You have to file that within 3 months from the date of cancellation or effective date order of cancellation, whichever is no. That's a mistake here which you are repeating. Later. I got the cancellation order on 18th of October, but it is effective from 1st of Jan. So 3 months will be from 18th of October, whichever is later. Whichever is later. You getting the point? 3 months from the date when I get the order or effective date of cancellation on that order, whichever is later. Whichever is later. Whether there will be late fees? Yes. Same late fees, 100 per day, subject to maximum 5,000, copy paste for, this is CGST late fees, copy paste for SGST late fees. No relaxation. No relaxation. Now, what about your 9A? 9 is required to be filed by your regular taxable person. And for 9 rather, I have written for 9A. 9 is required to be filed by regular taxable person. 9A, composition taxable. CTP will not file GSTR 9. Normally, wherever regular taxable person comes, casual taxable person will come. But here, CTP will not file GSTR 9. GSTR 9. Even OIDRS from outside India to India is not required to file 9A. It is exempt. Right. So only these 2 persons, 9A. And 9B, it is by ECO, electronic commerce operator. So 9 is by regular taxable person, 9A is by composition taxable person, and 9B is by electronic commerce operator who is collecting tax, TCS. Due date 31st of December after the end of the year. Late fees, yes, but a different late fees. 100 per day, subject to a maximum of 0.25% of calculation means state turnover. This was CGST, copy paste for SGST. Copy paste the same for this GST late fees. Are you clear with this understanding? Job worker, ITC 04, who will file it? Principal. It is either half yearly or yearly. Half yearly or yearly. Half yearly, we have discussed the due date. It's not 25th of September. 25th of October, 25th April. Yearly, 25th April. Who has required to file half yearly? If your turnover is more. If your aggregate turnover in previous year is more than 5 crores, frequency is more. If your aggregate turnover in previous year is up to 5 crores, you are a small person. Yearly. Yearly. And any late fees? No. There's no late fees. There's no late fees. Who is required to file your UIN? UIN. UIN is by international bodies. International bodies. Person who are holding unique identification number are required to file GSTR 11. Monthly. That too only refund when refund is applied. See, there's one thing special when talk about ITC 04. ITC 04 is filed only when the goods are sent or received, which means nil return not required. GSTR 11, nil return not required. Is there any due date? No due date for GSTR 11. They are required to be filed. GSTR 11 is filed only when refund application is filed or when it is demanded by proper officer. No late fees. Now, two important points about your ITC 04 and GSTR 11. One, if there is no transaction, no need to file nil returns. Second, even if there are transaction, even if you file late, there will be no late fees. Third, you will not get any notice. You will not get any. All the other returns, if you don't file, you will get a notice asking you to file within 15 days. So this notice concept is not applicable for CMP 08, GSTR 1, ITC 04 and GSTR 11. So if you are not filing, you will not even get a notice. Right. Can you file by SMS nil returns? Yes. Only and only 1 3B CMP 08. Others no. No. So first return may have 1 3B CMP 08. So that is possibility. Otherwise, GSTR 10. No. GSTR 10 can be nil details. No closing stock, no reversal, but still you have to file only by way of portal. Is there any provision for rectification for all these returns? No. There is no specific provision for rectification on any of these returns. Specifically, there is no provision. If you have done any error, specifically they are not speaking about any rectification point. Now, what is 9C? 9C is actually a reconciliation statement or an attachment to GSTR 9. Reconciliation statement. Right. Earlier, reconciliation statement need to be certified by a chartered accountant. Now it is self-certified. Self-certified. No need of CA/CWA certificate. Right. What it will do? It will reconcile the value given in annual return and annual audited financial statement. It will reconcile the figures of GSTR 9 and your audited financial statements. Is it required to be filed by everyone? No. Only if your aggregate turnover exceeds 5 crores in that financial year, you are required to file 9 along with 9C. There is no separate late fees for 9C. 9C is only an attachment to 9. Without filing 9, you cannot file 9C. It is only an attachment to 9. Now, who are all exempted from filing 9 and 9C? Exemption. Central government, state government, local, they are very clear. First, let us exempt ourselves. Right. Central government, state government, local authority are not required to file both 9 and 9C if their books are audited by Comptroller Auditor General of India or any other statutory auditor. OIDRS from outside India to non-taxable online recipient, they are also not required to file both 9 as well as 9C. So this relaxation is there from both 9 and 9C. What about relaxation only from 9C? Which means they have to file 9, but 9C is not required. 9 is required, but 9C is a foreign airline company covered under Section 381 of Companies Act. If at all, there are certain conditions. If a chartered accountant, here no CA, no CWA, chartered accountant gives a certified statement of receipts and payments in respect of its Indian business operations for each of the GST number separately before 30th of September. Then the foreign airline company need not file 9C, they have to file 9, but they need not file. So say for example Lufthansa Airlines, right, they have to file their 9 for the Indian business operations, but they need not file their 9C if CA is giving a certified statement of receipts and payments for the Indian business operation, but for each GST number separately before 30th of September. Before 30th of September of next financial year. 9C don't file, but continue filing 9. So that you need to understand. So that is all about your written filing basic concepts. GSTP not so important, you can walk through. Miscellaneous concepts, very basic points. When you talk about portal, how many portals are there actually? Three portals. One is normal portal, www.gst.gov.in, which is managed by GST network, where you do the basic work, taking registration, filing, making payment of taxes, filing returns, replying for notices, filing appeals. That is done on normal portal. Then you have a special portal, e-waybill portal, www.ewaybill.gst.gov.in, which is managed by National Informatics Center, not managed by GST network. National Informatics Center. Only purpose is generating e-waybill. Then you have another portal, e-invoice portal, gst.gov.in till it is 10. But you can only see first portal. Second to 10th portal is used by GST Suvidha providers for their automation invoicing. You cannot go to second portal, third portal. So basically, a few of my students have tried telling that, see, sir, second to 10th portal is there. When we access, we don't see. You cannot see. That is for what? Normally, invoicing is done automatically by the software that you're using. They will never touch first portal. Few people who are doing e-invoice manually, they will touch first portal. And these GST Suvidha providers, automatically they will be using the other portals. This is also managed by GST network, not National Informatics, GST network. Right. GST network is a Section 8 company, special purpose company, a non-profit company which is owned by government as well as banks. It is a common portal throughout India which connects everyone, right from taxpayer to a tax professional to bank to central government, state government, other reporting authorities. Everyone is connected on the same portal. Being in Tamil Nadu or being in Maharashtra or being in Delhi, you don't log in to separate portals. Right. So that is the purpose. Right. And the other purposes of all the three portals are again repeated here. Now, what is GSP and what is ASP? I'll make it simple. GSP are GST Suvidha providers. They are information technology companies, GST Suvidha providers, who will make your job easy by connecting you directly to portal without logging into portal. Without logging into, classic example is Tally. GST Suvidha providers. They can make you customized products as well. Then what is ASP? Application Suvidha providers are solutions which will talk to GSP, which will talk to GST network. Say for example, if you go to any hotel, say Annapurna or any hotel, they will not be using Tally and all. They will be using their customized software for their billing. That customized software will talk back into their final account software, which may be Tally or some other software. So ASP talking to GSP. ASP takes only sales details. That will talk to GSP. Now you will in GSP automatically all the sales details will go, and other details will be directly feed into the GSP, which will directly communicate to the portal. You need not go and log on to the portal. Right. So GSP and ASP. Whether e-returns are mandatory? Yes. Gone are the days where you can file manual return. Only electronic returns. Only electronic returns. Whether e-signature is mandatory? Yes. Yes. There's no mandation of digital signature certificate anymore. Either it is by way of digital signature or electronic verification code. E-signature is not effective as of now. Aadhaar based OTP is not effective as of now. Either DSC or EVC, electronic verification code. You can opt either. Earlier for companies in NLP, DSC was mandatory. Now it is removed. Even for companies in NLP, you can go with electronic verification code. Can revision be done? We have discussed this already. Can revision be done? No. Revision cannot be done. You can go for rectification, but no concept of revision. And finally, there's a special return called as information return under section 150, which is required to be filed by taxpayer, local authority, central government, state government, income tax authority, bank, electricity board, registrar, companies, registrar of motor vehicles, registrar of companies, registrar under your normal land and buildings registrar. So all the registrars are required to file. Collector, when you talk about right to fair compensation and transparency in land acquisition, depository, stock exchange, RBI, GST network itself. GST network itself, UIN holder, any other person. Now other bodies are helping you out to report your transaction. It is very similar to your annual information return which you have in your income tax. Right, you get certain information on your annual information return which are reported by other persons, and you have to verify whether you have reported that. Very similar to that. Very similar to that. If proper officer finds their return to be defective, not everyone, commission will notify and they have to file. If their return is defective, they will intimate the defect and give an opportunity to rectify within 30 days plus extension. If you don't rectify, then it is treated as not to be filed. If you are not filing the return, proper officer will serve you a notice required to furnish the returns within 90 days. And if you don't comply, then penalty of 100 per day subject to 5,000 will be that. So they are given an option. If you are not filing, they will give you information. After that you have to file, and even after that you are not filing within 90 days, then there will be penalty. Technically it is not late fees, technically it is penalty. Right, so that is all about your written filing chapter.